because after a while, we're hearing about de-escalation, at least a pause to that ongoing war. And, that's typically a good scenario for risk on assets like equities. What's your take, Matt? I recall you telling us you're still holding some cash because even if the war comes to an end, things will still be a very, very sketchy and continue to remain uncertain. How do you approach trade today? We're expected to see a big gap up.
That's right. Good morning, Nigel. It's always great to join. And that's exactly right. I think this is certainly a big step forward. It's one that obviously the market had ascribed lower probability to see transpire. I think the challenge going forward after a day like today, I think today signifies that the market is looking for some sort of relief valve for all of the negativity that's been out there. Positioning has been washed out. So I think there's a desire for investors to finally start to put money back to work. I think that can be the case very selectively. I do still hold quite a bit of cash in portfolios, but in a way such that I'm able to keep up on updates for this market. And I think the biggest question that we'll have to monitor in the coming days is with respect to the Strait of Hormuz, because we're seeing significant moves in oil prices. And I think that's what's driving a lot of the upside in equities, especially the Asian equity markets this morning. But the biggest issue is, will Iran, with those caveats that you mentioned before, are they actually going to allow ships through the Strait for countries that are associated with the US, not just those that Iran deems acceptable to move through? And so I think that's going to be the telltale sign of how the ceasefire can progress, or if we see kind of an escalation again, which has happened before, because we've been in this exact scenario just a couple of weeks ago, negotiating a 5-point plan between both countries, which descended into further fighting. So hopefully that's not the situation. I think what's most important is that earnings season is coming up during this potential ceasefire. So hopefully we'll have the chance to assess companies at the fundamental level and really dig into their outlooks going forward with respect to this conflict and how they plan to preserve earnings and profitability going forward.
Hi, Matt. Good morning. Point taken there. So I want to just understand a bit more in terms of Strait of Hormuz, right? Because it's a conditional, maybe a ceasefire that comes in, like you are also mentioning. Everything depends on that. Now, today we did see those Brent crude oil prices slide down because of these news flows coming in. But are we one bad line away from maybe those prices going up again, concerns coming in, or anything moves not the way one is expecting? Then again, there's a bit of a worry maybe for energy traders as well.
There is, Vinny, and I think that's a really good point, because we've seen extreme volatility across the energy and commodity complex. And I think traders are still going to be on edge with respect to how many ships actually start to move through the strait, what countries they're associated with, and what the caveats are that Iran might actually start to impose. So I think regardless of when ships actually start to move, the end game to me is still, at least for the medium term, going to be higher for longer energy prices. Because even if there's a negotiated settlement where Iran, it seems like it's very intent on collecting some sort of toll, whether it's between Iran and Oman, if something like that is allowed to stand, that's still going to put upward pressure on energy prices, at least in the medium term. And if you don't start to see significant shipping activity move through, you're going to continue to see the backlogs. You're going to continue to see a lot of the infrastructure offline in the Middle East. And that takes a lot of time to bring back. And let's not forget about the damage that's already been done to natural gas facilities, oil facilities across the region. So all of that's going to take time to repair. So this big move down, I think, is a relief sigh. But after that, I think further declines in prices are going to be harder fought, simply because of the state of reality that is the infrastructure in the Middle East right now.
All right. Matt, you've liked various counters in the past, and some of them have pulled back. Case in point being in Interglobe Aviation, solid market share. They have getting deliveries with regard to the fleets as well. I think 1 per week for the next 5 years. So they're going to be continuing with their market share. The problem was ATF prices spiked up. And because of this ongoing war, people would have pulled back a little bit on their travel plans. That's one of the top names you would look to get into, or would there be other names? If I had to list a few stocks today that would be top of mind, one would be L&T, then there could be an Interglobe Aviation, paint stocks as well as OMCs. Do you like any of these?
Yes, so Interglobe is an interesting name, Nigel, because they do continue to gain market share. I think the theme of Indian travel, both within India and around the rest of the world, is only going to increase significantly over the longer term. The question is, how impacted are they by the current crisis, and how impacted are Indian consumers by this? So I would probably wait until we hear earnings from the company and actually hear the management team provide updated guidance. I'm okay being a little bit later because of what a discount the stock is trading at. But I think what I would approach the Indian markets is I would almost do kind of a barbell approach where you have names like Bharat Electronics that is sold off, but where defense and the increase in defense spending in this fracturing geopolitical environment, that's going to continue to see gains. And so I'd look to get in perhaps on some of the weakness, perhaps not as much as other names in the market, but there's still a better entry point that you're looking at, and perhaps ballast that sort of name where there's a clear, durable, long-term trend with a name, say, like an Adani Ports or a name like an M&M, like we've talked about in the past, where you've seen a significant sell-off, but the segment of consumer that they sell to is probably a little bit more insulated. They're leaning into electrification, premiumization, and they have that significant exposure to the agricultural economy where they've already been driving significant margin expansion, or an Adani Ports that doesn't have a tremendous amount of exposure to the Middle East, but where they're really leaning into India, expansion in India, and broadening their ability to capture wallet share from their clients. So those names look very interesting to me on the dip, especially to add to if we get a little bit more certainty about where geopolitics are going to go.
Matt, thank you so much for joining us this morning, giving us an understanding in terms of the news flow that's come in, as well as some of the names that you're keeping an eye out on. Thank you so much for joining in.
Thank you.
But on that note, let's just slip into a very short break. After the break, we'll come back with cues in the world of commodities. Stay tuned in for that.
Welcome back. You're tuned into Power Breakfast here on CNBC TV 18. Well, equity markets are signaling risk on, but there's plenty happening in the commodity markets with the sharp decline we're seeing in crude oil prices and the surge we're seeing in gold. Manisha joins us to run us through a neat wrap of what's going on. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, yes, with the U.S. president delaying the threat to attack Iran's civilian infrastructure by 2 weeks, and perhaps a potential agreement could be finalized and implemented within this time, is what really has seen a reversal and in positions in sense of market there. And as you said, yes, the crude oil prices have declined anywhere between 12 to 15%. Heating oil is down 18%. Gasoline is down 10%. This is very important because the U.S. is soon getting into a summer driving season demand. And with the gasoline prices that have been prevailing, it seemed perhaps you could be looking at demand destruction. But this clearly changes all of that. Now, interestingly, the 10-point agenda that Iran has sent to U.S. and other allies does also talk about uranium enrichment. That is a question or point that markets perhaps would be debating on. The other thing is, even as the 2-week ceasefire is on and the Strait of Hormuz would be open as before, but remember earlier it was 100 to 120 ships that would pass through that every single day. Now, markets believe that it wouldn't be more than 10 to 12 that you would see go by in these 2 weeks. So that is something that the street will have to watch out for. But at this point in time, yes, it's an absolute relief and is the reason you're looking at gold up 2%, silver is up 5%, platinum is gained up by 4%, palladium is up 5%, copper is gained up by 3%. So everything that had been on a decline is seen a surge today in the Asian markets.
Everything on a decline has seen a surge in today's market, whether equities or commodities. Manisha, thank you so much for joining in, as always, and telling us what's happening in the world of commodities. But on that note, we're going to step into a very short break. After the break, we'll talk about overnight cues. How are they going to be impacting our Indian market? We have our team of research who will come and post the break. Welcome back to Power Breakfast on CNBC TV 18. Now, how are these overnight cues going to be impacting our Indian market? We have a team of research joining in with us to set you up for trade, tell you which are the important stocks to watch out for in the trading session as well. First up, we're going to be watching out for important cues in the world of F&O as well. Sudarshan, Nifty implied open, a cap up start finally. What are the cues there?
You know, there's a shair in Hindi. आंखें तरस गई थी तुझे देखने को. This is the perfect day. And it has come at the right time, just ahead of the earnings. 2 weeks ceasefire has been announced by both US and Iran, and that has led to a big surge across the market in the globe. You talk about Asian markets, you talk about US futures, when all the major indices in the US futures are trading with a gain of in the range of 2 to 3%. And in contrary, the biggest indicator for us, one of the biggest indicators is the crude. We are seeing a sharp fall over there. Both NYMEX, that is WTI, and Brent are currently trading with a cut of more than 13% each. And if you take a look over the last few days, we have been seeing a big gain in the market, and also there is a fall in the volatility index. Yesterday also there was a fall of around 3 to 4%. And now if you take a look in the on the FI side, in the index futures, yesterday they have bought more than rupees 1300 crore. And the surprising part was they have added long positions and they have reduced short positions. And on the long side, exposure is increased to 18%. On the short side, it has come down to 82%. Now come to the options data. On the put side, 22,500 and 23,000 were the most active ones, and on the call side, 24,000 and 23,500 were amongst the most active options, where we have seen an increase in the open interest, healthy increase. Now support. So for yesterday's intraday low of 22,720 would act as the important support. Resistance, will see how the market behaves, because obviously over the last 3 to 4 days we have been seeing that market has been moving higher, and today also GIFT Nifty is suggesting that we are going to see with a gain of almost 700 to 800 points. Some of the stocks that will be in the focus, one stock is in the band, that is Saman Capital, and keep an eye on all the names like OMCs, BPCL, HPCL and IOC, and also like L&T, Petronet LNG, and all the other names like Asian Paints, Bazar Paints. These stocks will act after this 2-week ceasefire.
All right. Thanks a lot for that, Sud. And net short market is something you love on days like these, because the shorts in all probability will have to scamper for cover. But the man who's going to be in focus all through the day is going to be Hormuz. He's going to be getting us all those data points, those tidbits as well, market capitalization gain and various stocks moving around. But he's probably going to be the only person in red. The screen could be green. Hormuz, tell us all the cues we need to track and how is market set up?
Well, not all contra trades are the best ones, right? Maybe even that goes for your wardrobe as well. But of course, nobody has even spoken about the fact that today is the RBI policy as well. That's possibly taken a back seat right now. But that, of course, remains the other major monitorable to watch out for. But as Sudarshan was highlighting, right, you're seeing a 700-point gap up. It's not very often that we've seen this, particularly so over the last 12 to 15 months with the kind of moves that the market has seen. And of course, now the big monitorable continues to remain oil, right? Brent, WTI, both are down 14%. Yes, they're still at 95, but you would take a 95 any day compared to 120 or 115 on crude. So that's a positive. The other major positive, of course, is going to be what happens to all of these beaten down names, all of these, the L&Ts, the HDFC banks. When index heavyweights perform, the index will do well. So we'll watch out for all of these names as well. Now, of course, the first major takeaway is the fact that this 22,500 to 22,000 has become a firm base now for the index. Now, where to go on the upside, that remains to be seen, of course, after this kind of a gap up. Of course, 24,000 is now in sight. But for the Nifty Bank, of course, the 1,000-point moves are not uncommon anymore with the kind of moves that we have seen recently. So 54,000 on the Nifty Bank is now become a distinct probability. And that 51,000 to 50,000 mark, of course, has now become a firm base for the index as well. So the other major point from the policy is going to be what are the statements that come in on the growth forecast, the inflation forecasts, and the consequent impact on the currency and the bond yields. But for now, we have a 700-point gap up. Policy is going to be watched out for. The OMCs, the oil sensitives, they'll be watched out for. And of course, the currency, the impact on bond yields, and then the impact on the rate sensitives as well.
Okay, thank you so much for that, Hormuz. But let's move on and talk about important stocks you should be keeping on your radar today as well. We have Upasana joining in with us for that. Good morning.
Well, good morning, Winnie. Well, a lot of pharma and real estate stocks in focus today. First up, let me start with Biocon. It announces US commercial launch of its biosimilars, hence the stock will be in focus. Next up is Aurobindo Pharma, even that will be on our radar, as the company gets US FDA approval for dapagliflozin and even metformin hydrocolloid extended release tablets. Lupin will also be on our radar as it has received US FDA approval for its abbreviated new drug application as a bioequivalent to Farxiga. Infosys also in focus as Infosys and Harness announced a strategic collaboration to unlock value for enterprise transformation and modernization programs. Next up is Phoenix Mills will be in focus on the back of its update of FY26. Company has achieved an all-time high retail consumption of nearly about 16,578 crore is what they've indicated, with a growth of nearly about 20% on year-on-year basis. Arvind Smart Spaces also in focus as it signs its largest high-rise project in Mumbai, offering a top-line potential of nearly about 2,400 crores. AB Realty is the next one on our radar as the bookings for the company cross nearly 1,600 crore is what they have said at Gurugram project, and 97% of the units are sold as of now. CleanMax Enviro also in focus as the company commissions 185 megawatt wind solar hybrid project in Gujarat, and company has also said that it plans to add 165 crore annually to its FY27 revenue once the project is stabilized. GAIL is the next one. It signs a long-term charter party agreement with Alpha Gas for an LNG carrier. And lastly, Swan Defence also in focus as it backs the order in the range of 1,500 to 3,000 crore from Energy One. So all in all, these are the stocks that remain on our radar today.
Appreciate you joining in, Upasana, and running us through all those key stocks that we should be tracking. But it's the day for the RBI monetary policy outcome. Concerns over import inflation amid the tensions in West Asia, they loom large. Ritu joins us to tell us what do we expect from the central bank later today. Ritu, take it away.
Going into this RBI policy, the macro backdrop has turned significantly more challenging in the last few weeks. What was earlier a Goldilocks phase of strong growth and low inflation has been disrupted by global shocks, particularly the ongoing West Asia conflict, which has pushed up crude prices sharply and triggered volatility across markets. Now, the impact is already visible. The rupee hit record lows near 95 per dollar before recovering, pressured by oil import costs and heavy foreign outflows, while bond yields have hardened amid inflation concerns. Now, this leaves RBI facing a classic trade-off, managing imported inflation and currency pressure without derailing growth. Against this backdrop, the policy expectation is very clear. 100% of the respondents see the RBI holding rates in April. Nearly 80% do not expect any action through 2026, though the longer the war drags on, the higher the expectations of a rate hike coming sooner. Now, in terms of where we're starting from, RBI's FY26 numbers are behind us. Growth at 7.4%, inflation at 2.1%. Those are unlikely to be revisited. The RBI has also indicated a moderation ahead, with the earlier FY27 trends pointing to first half growth just under 7% and inflation moving back above 4%. Building on that, the FY27 outlook does reflect some tempering. Growth expectations are largely clustered in the 6.9 to 7% range, while inflation is seen normalizing in the 4.1 to 4.5% band under the new series. On the rupee, however, there is a clear bias for action. Around 60% see the RBI stepping in, but largely through non-rate tools like dollar liquidity measures, NRI inflow schemes, or a dedicated window for oil companies. On bond yields, the views are evenly split, some expecting liquidity support through OMO purchases or Operation Twist, or even broader infusion measures. Now, overall, the policy stance is expected to be cautious, reflecting the current environment, and beyond the headline decision, the real focus is going to be on communication, how the RBI signals its approach to managing liquidity, supporting the rupee, and navigating these external headwinds while keeping growth on track.
Absolutely, Ritu. Thank you so much for that. But on that note, we're going to slip into a very short break. After the break, we'll get chatting with Aryadini, President at Aryadini Research, as well as Srikanth Kundapalli, who is a professor of China Studies at JNU, to continue the conversation on the ceasefire. Welcome back to Power Breakfast on CNBC TV 18. While we obviously started this morning by talking about the ceasefire for 2 weeks between the US-Israel-Iran war that's coming in, that's a positive news. Conditional opening in terms of Strait of Hormuz as well. We'll discuss more of that with Ed Yardeni, President of Yardeni Research, as well as Srikanth Kundapalli, who is the Professor of China Studies at JNU, joining us now to discuss more on this one. Good morning, gentlemen. Thank you so much for joining us on the show. Mr. Yardeni, I would start with you. I believe, when in the past you were talking to us about this war, quoting you had said the fog war is something that remains thick and there is actually no way to predict the outcome. But at least as of now, for 2 weeks, seems like that fog is moved away. What are you making of this? What should we be seeing in terms of oil prices as well?
Well, actually, on Tuesday of last week, I concluded that evidence was mounting that the war, in fact, would end sooner rather than later. We saw some reports that both sides were negotiating, not directly, but indirectly, and that President Trump clearly was under a lot of pressure to get this war done because the midterm elections are coming. And then we had this big relief rally on Monday with still a tremendous amount of pessimism. And so that all kind of came together, and I concluded that we probably would see a deal done. And here it is. And so the reaction of the markets is really quite predictable. A tremendous relief rally in the stock market, a big drop in the price of oil. Bond yields have even come down somewhat. And all in all, I think the markets are concluding this will be more than a ceasefire, that it'll actually lead to a peace agreement.
Well, we live in hope. Good morning, gentlemen. And certainly it's a good start to the day. And, besides equity markets and other financial instruments, you want this war to, just cool off and people get on the table and, settle their conflicts. That said, Ed, we've pulled back considerably. A couple of quick points besides the equity markets. What do you expect in terms of Fed rate action from here on? Because yields have moved up, inflationary worries will come back on the table. And also, if you would give us your outlook on gold. Gold pulled back close to 20% from the peak. But we have seen this in the past. If I trace back to 2008, 2011, we had big drawdowns in gold before coming back in a even more ferocious way. Do you think that happens again? So your take both on the Fed as well as gold. Please go ahead.
Well, on the matter of the Federal Reserve, I think the Federal Reserve is done for a while. I think they're going to be on pause for a while. We're clearly going to have an inflation pickup over the next several months. The economic data actually looks pretty good, and the war just didn't really last long enough, assuming that it's basically over, to really have an impact on the U.S. economy, which seems to be really quite strong going into the war. With regards to gold, I've been predicting that it would get to $6,000 by the end of the year, and then with the war, I was surprised, like everybody else was, that you would think with the war, the price of gold would go up instead of went down. Apparently, the Central Bank of Turkey sold a lot of gold in an effort to defend its currency when the war broke out. And now we can see that, once again, the gold is acting different than you would think. With the ceasefire, gold is actually up a lot. And so I think we could... we're not that far away from 5,000, and 6,000 might still be a target by the end of the year. And I'm still shooting for 10,000 by the end of the decade.
Okay, 10,000 by the end of the decade, 6,000 by the end of the year, 5,000, 6,000 for gold by the end of the year. Surely keeping an eye out on those levels. Professor Srikanth, coming to you. A ceasefire, 2 weeks coming in there. And this one, as of now, brokered by... not a superpower, but Pakistan has been a part of this as well. Where does this leave us in terms of India-Iran relations? How are you seeing this?
I think this 2 weeks ceasefire is a good news in terms of calming down the nerves, but it is not clear whether this is going to be sustainable, because we have seen before some such statements and also firing on both sides. Iran targeting some of the multinational corporations in Dubai and other places, while Israel and the United States have stuck on the infrastructure projects, bridges, and so on. So we have to see whether this is going to be sustainable. From an Indian perspective, of course, this is very good news because the Strait of Hormuz, if this is opened up as part of the agreement, then we will probably have the LNG and crude oil shipments on a regular basis. It is not clear whether Iran still insists on that $2 million per ship in renminbi, Chinese currency, whether that is off the table and normal commerce will take place. It is still not clear on that aspect. There is also some news that the United States is going to put some conditions for transit through the Strait of Hormuz. So that would also be weighing on Indian mind. On the proposals for ceasefire, you saw the Pakistani foreign minister going to China on the 5-point agreement, but that is only very general, meaning ceasefire from all the sides, sovereignty, territorial integrity, opening up the Strait of Hormuz and others. It appears that there are some interested parties for that kind of agreement. For instance, Pakistan and China conducted Sea Guardian 4 naval exercise on March 26th to April 1st, an interoperable naval exercise for helicopter landings and so on, which indicates that China and Pakistan are interested in the conflict scenarios rather than in terms of the resolution of this issue. So there are ominous signals on a lot of sides, China, Pakistan, Turkey, Egypt, and so on, while you have the larger picture of the United States elections, midterm elections, as well as the reassessments regarding the conflict in Iran.
Sure.
So too many signals here, which means that we need to be observing the situation live.
That's true, Professor. And it's going to be interesting to see how Trump navigates from here on, because his popularity clearly has dropped. And one wonders what has he gained from going ahead and attacking Iran. Time will tell on that front. But Ed, let me come back to you. From an India market perspective, we have pulled back a good deal. Now, we know that we are very, very sensitive to crude because most of it is imported. However, post the period of underperformance, do you think it's time that India actually outperforms from here on? I ask you this in the backdrop that the FI selling in the month of March was the highest we've ever seen. And April as well, they have started off on the front foot. They are selling lock, stock and barrel. Time for them to come back?
Maybe it's wishful thinking, but I think we can kind of go back to where the markets were before the war. And our strategy before the war was, in fact, to overweight the overseas markets and be less exposed to the U.S. market, simply because the U.S. market had become 65% of the market capitalization of the MSCI. So it's already kind of overweighted, and it seemed to us that the valuation multiples also made the going overseas very attractive. And we particularly like emerging markets, including India, not so much China, honestly, because of the difficult business environment there. But certainly India, I think, will benefit from lower oil prices. That'll be a plus. And there was some concerns also about fertilizer and what that implies for food prices. But I think those issues will be resolved now that the strait's going to be open for at least 2 weeks. And I think it'll remain open.
Okay. Ed, as well as Shrikant, thank you so much for joining us this morning, speaking with us in terms of markets as well as what this means for overall the geopolitical issues as well. Thank you so much for joining. But on that note, we're going to slip into a very short break. After the break, we'll get you updates from the world of AI as well as tech. Stay tuned in.
Welcome back. You're tuned into Power Breakfast here on CNBC TV 18. As we've been telling you, the gift Nifty suggesting a big gap up, and equity markets across the globe are celebrating a bit of a ceasefire now between the United States as well as Iran. But let's get you the latest updates then from the world of tech and artificial intelligence in our segment, the AI Pulse. We have Rachna, who joins us as always to take us through that piece. Morning, Rachna.
Well, good morning. Today is the intersection of technology, security and geopolitics, which isn't new. But what's changed is the speed and the stakes. Let's start with Anthropic. The company behind Claude has developed its most advanced artificial intelligence model yet, but it isn't releasing it publicly. Instead, it is being shared with a closed group that includes Apple and Microsoft. And the reason is what it can already do: identify thousands of serious vulnerabilities across widely used systems. So the concern is that the same tool could just as easily be used to exploit them. That risk is already playing out elsewhere because US agencies are warning that Iranian-linked hackers are stepping up attacks on critical infrastructure from water systems to power networks. This was, of course, before the ceasefire was announced, but there's already been disruption, as we know, and officials are calling it a deliberate escalation, which won't be the case going forward. But at the same time, the focus is now shifting to who controls the scale of artificial intelligence, because Elon Musk's Terafab project, which is a multi-billion-dollar push to build AI chips, now has Intel on board. That gives the project a manufacturing credibility as it tries to lock in massive compute capacity all under one roof. And speaking of Musk, he has now decided to escalate his legal battle with OpenAI. This is a day after ChatGPT maker alleged anti-competitive practices by Musk. Now this is a case that could have far-reaching implications for how AI companies are structured and governed, because Musk has now filed an amended complaint seeking to remove CEO Sam Altman and President Greg Brockman from their roles. This is a part of a lawsuit that goes to the heart of OpenAI's transition from non-profit to for-a-profit model. But Musk is now seeking $134 billion in damages, alleging he was misled during the shift. But the plot twist is here that he says any damages should not go to him, but to OpenAI's non-profit arm, and is asking that Altman and Brockman give up any equity or financial gains tied to for-the-profit entity. Jury selection is set to begin April 27th in Oakland, with both executives expected to testify. It will be one of the most closely watched legal confrontations in the AI industry. And on the consumer side, Apple is continuing with its next hardware shift. Despite reports of delays, its foldable phone is still expected later this year, which will be a high-priced limited supply launch that signals where the market could be headed. That's where things stand in the world of artificial intelligence for now. We'll continue to track how these developments unfold.
Okay, Rachna, thank you so much for that. But let's quickly look at what the Asian markets are doing as of now as well. Charlie has opened up on a strong footing, whether you look at the Nikkei, Taiwan Index, Hang Seng, all of them holding on to very, very strong gains. Taiwan Index is up 4.3%. Hang Seng up almost 3% as well. Nikkei managing to hold on to gains of more than 4% as well. We have the Korean Index Kospi that's also holding on to very good gains. So overall, all in all, we've seen a very strong start coming in for the Asian markets, given that this morning, IST 5:30 a.m., we did see the announcement that came in that there will be a ceasefire for 2 weeks between the Iran-US-Israel war. So that is something that's keeping the markets chirped up in trade. Nifty implied open obviously indicating a 663-point uptick for the Indian markets. Brent crude has come off from the highs as well. So Brent crude also now is trading around the $95, I beg your pardon, $95 per barrel mark as well. Below that $100 mark. So seems at least a good day that we're shaping up in terms for the markets.
It's going to be a fabulous start to the day, Vinny, and hopefully it'll be a good end as well. So to sum things up, there's been a ceasefire that's been announced. You have equity markets globally that are doing well. Indian markets as well are set to participate. Brent crude prices are down and gold prices are twinkling yet again. But that's all we have on this edition of Power Breakfast. You stay with us. Bazar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, good morning. What an eventful last couple of hours, right? From apocalyptic rhetoric of civilizations being wiped out, never to be brought back again, you can see a risk-on euphoria in the markets now. The two-week ceasefire, it's all happening.
You know, yesterday, even when Mr. Trump was putting out all the social media posts, I think the street was waiting for him to tackle. You know, you kept hearing about this, that, and the other, but I think they're saying that this guy is not going to bite this time around. At least that was the hope, and glad it played out that way. Equity markets aside, it's good for humanity. No one wants a war. You know, and hopefully the ceasefire does, holds out, and it's the end of the war, and let's get dialogues going.
Absolutely. And I think, have you guys seen the show The Apprentice? President Trump?
Yeah, long back. But
I think we should watch it, rewatch it. Basically,
now, yeah.
he played it to the T in terms of just taking it to the edge. And sounding like a madman, crazy man, and pulling back right to the brink, right? I mean, 90 minutes before the deadline, that pullback happened. So let's take it from the top. The two-week ceasefire with Iran, if Hormuz is reopened, that's basically the post from President Trump. And there is confirmation that the U.S. has stopped its attacks across Iran. I mean, the strikes and bombing, etc., has been stopped. Typically after a ceasefire, and we've seen this in other situations as well, you'll hear stray incidents here and there, but that's largely because the message has to go down and, so you may hear an incident or two, but that's kind of sort of normal. But the headline is there is a ceasefire. If this Hormuz is reopened immediately, as he says. Now, Iran's foreign minister has said that safe passage via strait is possible via coordination with Iran's armed forces. Iran essentially saying that negotiations with US will start Friday in Pakistan, Islamabad. So it looks like Pakistan has basically played a role of a mediator between US and Iran, taking messages back and forth, and both sides, of course, President Trump in his post and Iran in his post as well, recognizing that fact. Both is also saying, Trump and Iran essentially saying that they can extend talks beyond the two-week time frame. So while there is this two-week time frame, do you really need to fixate on the end of the 2 weeks? I don't think so. I mean, depending on how the talks go, it can be sort of continuing talks till a favorable kind of outcome is reached in that sense. So it's good news all around, and markets, of course, are rejoicing, right? Brent, look at just what's happening. 14% drop in oil prices to about 94. We've got S&P futures, which is up about 2% plus. Dow futures, which are up about 2% or so. And Asia this morning, of course, is jumping as well. So across the board, you look at Japan, Kospi, I think, was up about 4% and some of the other Asian indices are also looking up very, very sharply. There you go. These are markets which got hit very, very badly as well. So there is risk on kind of sentiment. You look at what's happening with gold and silver. Gold, silver prices, by the way, last night ended higher by about 2%, 3%. They're all reversing. So it's a bid for equities and everything else getting essentially sold. Markets will track the shipping data in terms of how many ships now start to pass through the strait, because that is essentially where the economic impact was coming through and the price of oil going up, etc. Prior to the war, 100 ships were passing through the strait, and that had dropped about 90% or so. So as oil starts moving through the strait, I mean, I think it's important that it starts to happen and is easily, by the way, trackable, as we've explained earlier here as well. So as that starts to happen, I think market will get more comfort that this is indeed the case. And of course, I mean, now we kind of go back to tracking what happens with these negotiations back and forth, et cetera, but don't fixate on that 2-week timeline. Most likely, perhaps that gets extended. If you look at the 10-point plan, which Iran is saying it wants, and what President Trump is essentially saying, I mean, there is still a wide gap. So how do you circle that square? That's the question. Just to tie in the levels here, we've had very good bounces, right? It started last Thursday from the lows, big bounce. Friday was a holiday. Monday, similar thing. And of course, yesterday as well, from the lows, we've had very, very strong bounce. An expectation, and I've been saying this for a week now, actually starting about Tuesday last week, that this is the start of a de-escalation. It didn't look like for a day or two, but it started eventually sort of playing out in that sense. So near-term targets, 23,283, which is the 20-day moving average. The swing high after that is 23,465. But, I mean, I think all of those levels will get, the GIFT Nifty is indicating a higher start. So you'll open at those levels, the swing high levels. And then eventually, I think we are headed to 24,100. Which basically is nothing but the extrapolation of the channel that the Nifty has been in. If you break out of the channel, you extrapolate that higher, and you get to about 24,100 or so. So I think it's possible you get to 24,100 before the market starts to stall a little bit. So looks like it's going to be a good session and a good close as well. At least a 2% higher close by 3:30. I think it's entirely possible and most likely as well. We'll get to stocks, etc. Remember, there is the RBI policy meeting as well, and must be such a relief for the Reserve Bank of India and the governor to hold the policy in the light of this ceasefire announcement and not fire and fury. And they've been battling a fair bit of fire and fury with the currency, etc. So we'll talk more about that. And of course, individual stock sectors where you perhaps see more covering, buying coming in, etc. as we go along. But Nigel has walked across with what the F&O positioning is looking like. Nigel, over to you.
Well, Trump does it again, right? As he had paused attacks on Iran for 2 weeks, like he had paused implementation of tariffs for 90 days, exactly a year or so ago. Well, equities, they are moving into risk-on mode. Yields, as well as crude oil prices, they have cooled off. That could signal that inflation worries, at least for now, well, they are taking a bit of a backseat. So that's encouraging to see as well. What to track in the Indian markets today? Well, you'll want to look at stability in the Indian rupee. That's been stable for the last few sessions. The key indices, Nifty and the Nifty Bank moving to around the 20 DMA, and the slowdown in the kind of FI selling that we've seen. Actually, let's pull up the 20 DMA levels up for you on the screen. We start above these technical levels, but you'll want the end as well to be well above these levels by the time we close out. Now, the FI selling, well, that's been extremely intense in the month of April 2026 so far. In fact, the selling so far, that we've seen in this month, that's exceeded the selling that we saw in January 2026 itself. Mind you, yesterday's, this number that we're putting up for you on the screen is X of yesterday's sell number, which was close to around $1 billion as well, because NSDL reports it with a bit of a lag. So intense FI selling is what we have seen. You want that to cool off. However, yesterday we witnessed first signs of some kind of short covering. Yesterday you saw close to an 8,000 contract swing on, from the FIs on index futures itself. Let's move on to the, the FI data on the index futures. They covered shorts, they added some mile long positions. They continue to remain net short, remember, with close to 82% of their positions on the short side. The FI shorts, well, they're holding at around 2.6 lakh contracts. So this market is aggressively net short, while the clients are net long at around 1.7 lakh contracts. By the end of today, I want to see that net short position from the FIs come down by more than 10%. That's more than 30,000 contracts. In all probability, we should see that getting covered in trade today. On the options front, two strikes are very active. 23,500 call, 23,000 put. And in today's session, you'll want to see the Nifty Bank will move ahead and conquer the 20 DMA decisively, and the Nifty taking out the 23,800 mark, which is a near-term technical resistance level as well. And stocks that got hammered out of shape, well, they could see an outsized rally today. IndiGlobe Aviation, paint companies like Asian Paints, OMCs, L&T, all of them, they'll be the big movers in today's trading session. So brace yourself. Today's session got the makings of a very, very good one. An eye on the RBI governor, though, in the initial part of trade. We start off 600 points higher. You'll want to end above that 23,800 odd mark.
Well, just a quick word on Asia, because you're seeing that GIFT Nifty, the gains in GIFT Nifty reflected across the rest of the Asian market screen. Kospi is up 6%, Nikkei is up 5%, the Taiwanese markets have surged 4%. Hang Seng is up nearly 2.5%. So across the board, a very powerful risk on, and the Dow Futures too is up 950 points.
Well, it's looking good, isn't it? Let's get in our first voice on the program. Samir Arora is founder and fund manager at Helios Capital. Samir, good morning. Great to have you with us here as always. And it's a good morning to chat, Samir. Otherwise, you were in this muddle of what's going to happen, not happen. But oh boy, what showmanship, theatrics, right, Samir? Another level.
And every time surprises us by going to the end. And even though you keep remembering, for example, on Feb, whenever the war started, 28th Feb, I thought in the next 2-3 days that already he's reached the brink and now he'll back off and they have achieved whatever goals they wanted. But this time they took it till the end. But you're right, total brinkmanship and succeeding more or less every time.
Yeah, and everyone buys into it, right? At some level.
Exactly.
You don't know, right?
Success only measured by the fact that we all start believing it again and again.
Yeah, although there is this niggling feeling, we've seen this story before, right? And it's getting tired. It's how many times will this happen? But you kind of sort of, what do you do?
Because this time the duration was longer.
Yeah.
Normally it's not 3, 4, 5 days, 7 days, but
yeah. So just the
well.
Yeah, Samir, just the shape of this in terms of now how this is likely to play out. Markets will just get to, but now this ceasefire will happen, talks will start, and they're already saying that 2-week deadline we can extend it if required. So
because actually the bid ask is very different. And even if you see, there were 2 statements from Iran, one from, what do they call it, Security Council or something, and one was from the foreign minister, I think. And the foreign minister one is a bit more diluted, but the other one is still pretty strong language. But now you have to assume for now that, that's not going to restart again just because they don't agree. So my guess is that whatever they had agreed before, in wherever they were meeting, I think the Omanis were organizing before 28th Feb, that should be the starting point, saying you had agreed to this, but since then we have done this war, so we have to give some compensation for that, and in return this, that, blah, blah, blah. But you can't go to zero and say remove everything in straight away in terms of removing all sanctions and removing US forces from Middle East, all that. If it is a real ask, then it is not happening, but I don't think it will be a real ask.
So it's showmanship, obviously, from both sides as well, and then eventually something.
In theory, you are hoping that this is the Venezuelan model, where as of now, previously it was a different model that you're changing the regime. Now you're basically saying keep the regime, but the top guy is a little bit more mellow, or he has done his bit and now he thinks there is no this thing. So the top few guys are changing and who may be a little bit they won't be as anti-US or whatever, and then life moves on. That is, I guess, the new outcome.
And this control of the strait, Samir, because Iran is very clearly saying that it'll be us. We will.
Because that is their only control. That is their only thing they can do. So, but you have to give something to them. Either give money and say it'll be paid, because you can't say we fought a war, we destroyed everything, and now have a nice day from tomorrow. There has to be reparation.
All right.
In whatever form, I don't know. So maybe not the control of the straits, because they will say that when after X number of years also you won't leave, even if it is for a defined period to recover some cost. But to say that you walk away now, you rebuild everything on your own, that is also, I think, very difficult.
Okay. So just to tie that before we get to the market, before we get to the market, we don't market generally, not just India but everywhere. They don't have to look over their shoulder that this thing is going to start escalating again. Now it's kind of on a steady slope of de-escalation talks, whatever, right? That's we can live with that. We can live with that. I'm asking you, will that be it?
I think that is a fair thing, but that normally you would not expect the whole thing to restart with the same fury again after 10 or 20 days, because in this time all the local, senators and congressmen and the Democrats and all who've been sleeping all this period, all of them will wake up. There'll be more thoughts. So I would think that is the way to do it. And actually, if you look at the market and the Indian market by Feb end, it was looking pretty good in terms of the US sanctions being basically gone to 10%, same as not sanctions, those tariffs. And also the quarterly results, if you see, of these consumer companies or auto numbers, it looks that a recovery was on the way, and then March may not have impacted directly, but was supposed to impact plus minus a few months. But other than that, it was looking good. And so I hope that maybe it doesn't go back exactly to that goodness because of certain costs which will be there for the next many months. But otherwise, it should be better for sure. Much better.
All right. So let's hope that this is not just a pause, but maybe a permanent end to the hostilities. So Samir, morning, Rima here. So what have you done in the last 37 days while this conflict has been on? Yeah. And are you looking to add risk today?
So actually, in my long short fund, I had come in very aggressive into March. My net was something like 74, 75, which after 10, 15 days, I reduced the oil and gas and refining things. And so, and a few others, and my net is now maybe 67, 68. Not much different, but it was actually lower. But, it's a long short fund and you have to react. But in the other funds, we are basically, I have a long only fund here, quite big here. And then we have the mutual funds there. And all of them would be 99% invested. I can prove it again and again. You can see the data for the last 1 year for all the guys who come on TV and on your channel and say, now we are becoming bullish. Now our model is turning green. Now we want to sit up. But their returns are plus minus the same in a period which should have helped the guys sitting on cash or thinking that valuations are this and that. In the end, a few days here and there, like today will be a good day, where if you're sitting on some cash, what you will lose is maybe 20 days of returns, and by that time, something else will happen. So we have realized that I forget my long short fund because that is just the nature of that and the way it is sold. Is that broadly being fully invested is okay. You change the stocks as you go, and therefore you can't say I am long term. I will never. I will time the market, but I will not change the stock because once I buy a stock, that I am always married to. If you are willing to change the stocks, it's okay to be fully invested.
So how have you rebalanced and churned your portfolio in this?
As I said, we have changed some of these energy-related stocks, and we bought a few means added, and maybe we added one new name to defense stocks. And I think that even though you may say today that the war is ending, but defense now people will realize that everybody needs to be more and more self-dependent. And secondly, in oil and gas and energy, you will have to find or put effort in trying to do something about gas, something about alternative, more than it was before. And other than that, we didn't change much. We actually added to the great stock, which fell 25% in the month or year to date. And we felt that the stories around it were more to do with egos of people rather than any scam that had happened in the company and stuff like that.
The stock that fell 25%, I think it would be the delivery company, Eternal.
No, HDFC Bank.
HDFC, the frontline name. All right, one of the two.
I'm saying we even added to that, including in our offshore fund in March.
So added positions in both HDFC Bank and Eternal, stocks that you've been positive
Eternal, I don't think we added. Maybe I added, but that was with new money. We didn't change the weights.
Got it.
But we are very, very bullish on it. And actually, it is even more bullish now. If you see on that the Tata guys are crying that Big Basket is not making money. And of course, many others are not. So that is less pressure. And at this valuation, the new IPOs cannot happen at the valuation they dreamt. So they will have to be less aggressive. Also, of course, now the market from today may have turned. But otherwise, till yesterday, you would have imagined that if this weakness lasts for 3-6 months and that IPO does not happen, then what would have happened? So you can already see that the pressure is less and there is no way you can avoid using quick commerce in your life, whether you are lazy or you are athletic and you have time and you are villa and you want to go shopping. It doesn't matter. That thing is now there.
All right. Samir, one niggling worry is the kind of selling we're seeing from FIs. As you said, till February, things actually were looking up, both on the economic front. If we look at dispatches, if we look at even heavy sectors like cement, steel, offtake was very good. And suddenly March, it put a bit of a spanner in the works. Now, the problem is the FI selling has got very, very intense. In March, it was very aggressive, but that was because we had a war that was ongoing. But the start of April as well, we have seen aggressive selling. Do you think you're reaching a point with some stability in our currency that actually we could expect them to come back, because $1 billion per day is a lot of pressure?
So actually in Feb, even though the IT sector fell some 18-20%, even then the index was up and FI flows were net positive and currency was also up. So we have to think that, okay, that was the default scenario and not what happened in March, where of course, it's negative for everybody, but for India, considered also very more negative, maybe because of oil imports and the fact that our currency, which was already weak, if the oil prices go up $30-40, then into 5 million barrels, so that is a daily loss. So the fact that there is some reasonableness in currency, and if these guys announce I think they should have a $50 to $75 billion NRI bond. In 2013, it was 30 odd billion. The cost of that extra cost will be maybe 2%. You have to give 2% more to greedy pigs like me, and you can get all the money, leverage money. And that is like $2 billion a year for 3-4 years. There's nothing to get that stability. But the FII flows actually have been negative, even very big negative in Korea and Taiwan. Actually, although their markets are up a lot, actually the Korea-Taiwan market have had bigger scale of selling by a proportion. I can send you the thing from a Goldman report, which I saw yesterday only. But like they would have had 30-40 billion of selling in the last few months. Okay, so it's pretty big everywhere. And we hope that it's now at least settles down to a 0 to plus, particularly if the currency is a little fair and steady and not cracking every day. As I told you last year, the currency was embarrassing. No, let me say it, even though I'm an India fund and I sell to foreigners, it is embarrassing to see how it fell for the last many years, 1 or 2 years. Yeah, it's pretty bad.
We'll see if that FCNR scheme comes through today, and it's possible.
It is not something to be hidden that, oh my God, egos will be hurt, but the currency is a very poor advertisement of what is happening, or was till a few days ago. Yes.
Till last week, right? Samir,
because even on days when the rest of the currencies were strengthening by 2%, we would weaken by 10 basis point or go up 5 basis point. I mean, you can be X% of ups and downs, but you can't every day, day after day be negative. It was a bit too much. And if it was driven by the banks, basically prop investing, then it has been a good decision to stop that, because that means effectively our own banks were fighting against the Reserve Bank of India in terms of having these, if it was that and not any other hedge of $30-40 billion. These things are big numbers for anybody and definitely for India.
Yeah. Samir, let's last question. If you are sitting 100% on cash, right? Forget about what you already own.
100%.
Let's assume you're a hot-blooded, you're a hotshot fund manager, not trader, but maybe in another lifetime. If you had to go in with news like this behind a tailwind, where would you focus? What does best from here? It's all relative, of course, but without any baggage.
One is you can look at the beaten up names, like L&T types, which are down, and knowing that one day it become okay and the orders will increase even more maybe, or at least your orders will come back. And also these other things where food delivery and all, of course, we always like. Even the banks and all, 25% down is not a normal this thing that this is because something happened and some chairman resigned for reasons which he can't even explain clearly to Shireen Bhan after 40 minutes. So things like that are very easy to just see the ones which were otherwise known, well known. And particularly if you think they've fallen 15-20% in this month or over this period from December end, and those are the initial starting point. Otherwise, you can give it to our mutual fund also.
Nice. Nicely done, Samir.
Nicely.
Well, and the funds have done well, so congratulations on that.
Yeah, they're okay. Basically, we didn't take any of these active big picture bets, and whoever took it and wasted everybody's energy. By the way, I have one more point. You should ask them these questions. I should be the guys who come and say, don't buy small cap. Or somebody will say, don't buy equities. He doesn't say, keep the cash. He says, by the way, I have a multi-asset fund. Oh, by the way, I have a new, whatever the other fund called, I don't know what it's called, multi-cap fund. Means they are not saying we don't like the equity markets, you keep the money. They say we don't like equities, but you can give the money to us for another fund that we have. Then what's the difference?
But we'll invite you Well, lovely conversation, Samir. Thank you very much. It's a good day. It's a better day, I should say. And let's hope.
Smiling. Bye-bye.
Let's hope it stays better. Thank you. We'll take a quick commercial break here. We come back and we run you through stocks with our research team. What should be in focus? That's the point. The story, of course, is the ceasefire, and I think everything trades in the backdrop of that big announcement which came through. Coming up.
Welcome back. It's possibly going to be an all-green screen today, given the powerful risk-on across markets. But let's drill it down to stocks where there is news. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Top of mind, all the oil and gas stocks. Sonal, hi, good morning.
Good morning, Reema. Well, stock markets could be in the green, but we've seen red across crude oil and gas prices. Overnight, crude oil prices have fallen below that $100 per barrel mark after the announcement around ceasefire and the passage from Strait of Hormuz would continue. And gas prices also have fallen by 4% overnight. Now, remember, Strait of Hormuz is around 20% of global oil, 25% of global gas. Gas continued to be a problem for multiple economies, so this has come as a breather. ONGC Oil India could see some decline, but the others, city gas distribution companies, oil marketing companies, could see some green.
Got it. All right, Sonal, thanks a lot for that. Let's hop across to Ria. She's here to tell us about select fertilizer and chemical companies that she'll be tracking. Ria, take it away.
Well, yes, this will be a positive move for fertilizer and agrochem companies across. Now, once the Strait of Hormuz reopens and remains open, the availability of urea will normalize along with the availability of ammonia, phosphates and sulfur. We will also see a correction in feedstock prices, which is natural gas and sulfur, and freight costs will also be cut down materially for these companies. And we will also see better output once the supply of LNG normalizes for these companies, which is the primary feedstock for ammonia and urea. Now, in terms of the specific financial impact for these companies, we will see easing of gross margins as well as volume recovery, and the working capital cycle will also see some easing along with the inventory losses that will be reversed going forward. But it is important to note that the complete normalization of the supply chain will be a gradual process, but on an immediate basis, the price impact will be an immediate relief for these companies. In terms of the companies that will be affected, this will include Coromandel, Paradeep Phosphates, Chambal Fertilizers, RCF, National Fertilizers, UPL, PI Industries, as well as Rallis Industries.
Thank you very much for that. Many companies, Indian companies, have exposure to the Middle East, the Gulf area. Vivek joins in with more on the potential relief here.
Well, that's right, especially when you're looking across the capital goods, the infra EPC space, rice companies, whole host of these names have material exposure as far as West Asia is concerned, and none larger than Larsen & Toubro. Larsen & Toubro, remember, almost 37% of the current order book comes in from West Asia, and 33% of the total order inflows of FY26 so far actually comes in from West Asia. Remember, the company said that almost 95% of the projects are operational as normal, but despite that, we could expect to see a sharp relief rally as far as L&T is concerned. Other stocks that we are tracking, remember, KEC International, 20% of the total order book is exposed to West Asia. 28% of order inflows in FY26 came in from that region. Kalpataru, 11% order book from that particular region, and almost 2% order inflows. But remember, the company is L1 in quite a lot of tenders that took place in West Asia recently. Along with that, one particular name from the rice pack that does stand out is KRBL. Almost 61% of the total annual revenue for that company comes in from West Asia. Now, along with that, there are other companies that do have material exposure to West Asia, names like Vatek Wabag, ABB India, Siemens Energy, whole host of other capital goods, and you could expect to see a relief rally across most of these names.
Thank you very much for that. Back to Sonal now for the real estate stocks.
Quarterly updates are coming in, and for Prestige Estates, it's been a stellar growth in FY26. Pre-sales are up 76%, crossing that 30,000 crore mark. In Q4, pre-sales are up 10%. The company says there's sustained traction across key markets, and they've seen these sales from existing projects and new sales as well. And this is the first time, of course, that the company has crossed the 30,000 crore mark, and they're optimistic about sustaining this momentum in the coming year as well. For AB Real Estate, they have clocked bookings worth 1,600 crore rupees in one of their new projects, and they have done these bookings in 1 month of the project launch as well, when 97% of these units are sold. So these two stocks will be in focus today.
Okay, all right. Thanks a lot for that, Sonal. Going across to Mangalam. Mangalam, we're tracking Titan. The update came in?
Yes, the update has come in, and along with the market, I think Titan will be a stock that will be shining today. Why is that? Because jewelry revenue growth for the company grew at 46%. Domestic jewelry grew at 42%. We saw good growth coming in there. Key segments, which is Tanishq, Zoya, Maya, as well as Beyond, all of them growing at 47%. The only fly in the ointment was Carrot Lane, which grew at just 24% as against its historical growth rate of upwards of 30%. Watches grew 7%. Eye care, emerging businesses around 16, 17% each. The important part, however, the company recorded a high single-digit buyer growth. And now that is a positive because over the last 3 quarters, the buyer growth was absolutely flat and most of the revenues were led by higher gold prices itself. Studded segment as well grew upwards of 30s. We saw good growth coming in the gold jewelry as well as coins, which tripled in sales. The only thing we have to track from here on also is the company said that the March business saw significant disruptions in the region on account of the war in Middle East. This is their international business, but their domestic business doing extremely strong. Expect the stock to see some green today.
And there's going to be a potential relief on the cost side for many of the consumer names that you track, Mangala.
That's correct. And the biggest beneficiaries obviously will be the paint companies. So we'll have, the likes of Asian Paints, Berger, etc. All of them having announced a 6 to 8% price hike already, with another one in the offing. Crude cooling off would be a big positive for them. Along with, these companies, we'll also have some companies which have, exposure to crude derivatives, the likes of palm oil, edible oil, etc., which moves in tandem with crude. So a lot of these food players will also do a lot better. And we will see some benefits coming in on account of packaging costs for FMCG companies, which account for nearly 20-25% of their overall cost basket, which will also cool off a little bit. So all of these, which were under pressure on account of higher raw material prices, will now start to normalize.
All right, Mangala, thanks very much for that. Well, here's a quick recap of stocks that we put out. So, positive side, oil marketing companies, city gas distributors, fertilizer, chemicals, FMCG, Gulf exposed businesses, Titan Prestige Estates, Aditya Birla Real Estate. And of course, it's a positive looking screen all across. And on the other side, specifically ONGC Oil India's oil comes off. So that's a bit. Now, RBI meeting today, MPC decision, and the environment is, I think I can safely say, sufficiently mellowed down a little bit. It's not fire and fury. It's a little better. Lata is here with top expectations. Lata.
It's a little tough to give the editor's take because when I last heard, the governor is hurriedly changing his speech. Well, jokes apart, clearly, recency bias is very important. Yeah. So if the same policy was yesterday, then the governor's speech obviously would have been different, and today it is bound to be different. What will the market watch out for? Does he lean more to helping growth? Now that the inflation fury is likely to be a little less, the assumption was, would it be over $100 average for the year? Now the chances are the scenario shifts to possibly $90 average for the year or $85 average for the year. So how pro-growth he sounds, and he is likely to sound pro-growth because the inflation fears are much less. Even if crude was at 100, considering we are starting from 2% inflation, there was no need to use the interest rate instrument anyway. So we should expect yields to cool because Indian yields had gone up all the way to 7.1. So there will be a bit of cooling off across the curve. The overnight index swaps, 6-month swaps, 1-year swaps, all of them, you will see the curve softening a bit. They did that yesterday as well. So his talk on pro-growth will be very important. And then his talk on what he may do about the rupee. Until yesterday, that part of the speech would have been important. Again, now this morning, any chance or likelihood of an FCNR simply goes out of the window. I didn't believe that there would be such an instrument in the first place. It is not called for at the moment when you have $700 billion of reserves. It's not called for at all. The steps taken with the banks, squeezing out the banks' long positions on dollar were good enough. And now, today morning, the NDF indicates that we are going to start at 92.45. Now, that is a 3% rise over the worst we saw about a week ago at 95.15 that the currency had touched. So I don't think he is going to, if we ask questions like, sir, will you ever use the interest rate instrument to defend the exchange rate? He will laugh us out of the room. We will ask, of course, but chances are the market will watch all this very closely. The biggest watch will be liquidity. Yeah. Does he intend to keep the liquidity? Because if he does continue to keep the liquidity, all the mutual funds will cry. If he removes the liquidity, the banks will cry. So that sentence will be very important.
All right, Lata, I don't think he minds changing the speech. Right?
Yes.
With
pleasure, I guess.
With pleasure, absolutely. Thank you very much, and we'll leave you to it. 1 hour, 25 minutes, the clock shows it. We'll take a break. Sunil Singhania of Abacus Asset Managers with us on the other side. Stay tuned. Coming up. Back, if you're just joining us, the big headline, of course, is the 2-week ceasefire. And importantly, both Trump and Iran have said that 2 weeks, don't hold us to it. It's possible we extend it. So already buying time. The 2 weeks may not be sufficient. Both sides, of course, there is a gap between what each side is ready to offer and give. And that's good, actually, that there is no, I mean, let's not fixate on 2 weeks in that sense. Markets, of course, are all reacting, responding like they should. Equities are up. Oil is down sharply, and gold, silver, etc. is getting sold a little bit. Sunil Singhania is founder of Abacus Asset Managers. He's with us. Sunil, good morning. Great to have you with us here. Thanks very much for joining us. So first cut, your take on the ceasefire and the shape of things for our markets from here, Sunil.
I think it's a big relief. Very few mornings in the past few weeks have looked so good. So it's welcome.
Absolutely.
Anyway, for mankind, it's good that the wars come to end, apart from ceasefire. However, as you rightly said, Prashant, it's a ceasefire. So let's see. I think from an India perspective, the relief is that oil is sharply down. Obviously, Indian markets, the way the futures are showing, are lagging the Asian markets, but that is fine. I think what was happening, Prashant, particularly last 2 days, is that bad news was not being sold into. So I think the markets were already bracing for some kind of relief, and I think this comes as a great relief. Obviously, given the rhetorics which we have seen, particularly from President Trump and the yo-yo over the last 4 or 5 weeks, there will always be apprehension of how this plays out. The other thing to watch out for is in this ceasefire, whether the Strait of Hormuz is reopened completely. And whether the supply of oil and gas resumes close to normalcy. I think that is more important because a lot of companies are now facing production issues because of non-availability rather than the price. So I think a good relief, but obviously we need to watch for the next few days of how the other things pan out.
Sunil, on a day like today, we'll start higher, right? You end with a say, I would imagine 2%, at least 2% kind of thing, right? And then you reevaluate and maybe the markets take a bit of a pause, and then you see how things are going, right? And then it's more, today it's everything gets a relief and bump up. Things which have been sold hard, etc. That's how it usually would play out?
Yeah, I think so. So the beta sectors like banking, obviously infra, real estate, capital goods, a little bit of, companies, impacted because of huge crude prices, they will all see a bump up. I think what we have to see now is whether the stance of global investors changes, particularly for India. I think India has been at the receiving end last a lot of months, but particularly the month of March and the first week of April. I think that stance needs to change, for India to meaningfully start to move up. But the good thing is that investors here have been pretty, I would say, resilient. Most of the funds, including us, have been more or less maintaining their investment. So I don't think there's a need for a quick change in the stance. But yes, after 2.5%, up move on opening, I personally believe that they will be building up on that move, and we might close up higher than what we open up.
Okay. Sunil, hi, morning. So can you tell us from the companies that are a part of your portfolio, the companies that you own, which of these companies face difficulties on account of the supply side issues? And what's the extent of the pain? And what are they telling you? If the conflict now is moving towards de-escalation, what would be the lingering pain these companies would feel? Because you would have a very close perspective on what's happening on the business side, on the operations of these companies.
So actually, March was not that bad because a lot of companies had, raw materials with them. The challenges were more on the supply side and the logistics side. And, it was across. It was not that it was, only one sector or some other sector, because plastic and oil is needed by everyone. Like FMCG, for example, they were not impacted because of demand, but because of packaging cost going up. So, it was across. And more importantly, I think the last 1 week, 10 days, companies were getting nervous because if this would have continued for another month or two, then the disruptions would have been pretty severe. Hopefully, this ceasefire gets extended, and the little bit of impact which we saw over the last couple of weeks gets negated. But it was more a sentiment impact, and in some sectors, obviously we all know which sectors did not have gas. I think there also there were challenges. Now we also have to see that even with this ceasefire, whether the gas supply, particularly from Qatar, gets normalized, because there will definitely have been some impact, some damage to a lot of crude assets. But I would say that it was across. It was not related to any one sector. For example, even banking faced pressure because there was this whole narrative about inflation going up and yields had already crossed 7%. So, all these kind of events cause impact across, barring a few sectors like IT and all, which are relatively immune. So, I would say it was general.
All right. Hi, Sunil. Good morning. Good to hear your thoughts. You're sounding quite optimistic, and hopefully we have a good session. I wanted to ask you about the crude oil prices, though, Sunil. I recall in March, you had put out on social media that silver went one way, 50 to 70, 70 to $120, and then it reversed. Will crude follow suit? You think so?
Yeah, that's why I think that was exactly. I am very optimistic that 31st of May, when we complete 2 months of crude hitting 120, we would be more like 70, 80. And it is already showing. Nigel, what is also happening is that because of this conflict, a lot of other supply side, actions have been taken. So Venezuela has started producing oil more than ever. Sanctions on Russia have been eased off. And with this truce, I'm very sure that something on the Iran sanctions will also ease off. And therefore the supply side action will be pretty dramatic. Demand is not going to flare up, for crude. And, hopefully there will be normalcy. Already the September futures for crude as of yesterday were $25 lower than this month. So there was already a $25 war premium, maybe out of which 15 has already got adjusted today. Let's see. But, I would stick my neck out and say that 31st of May, we should see oil anywhere between $70 to $80.
All right, so there are calls for ghee shakkar. Hopefully that happens, in the next 2 months. Sunil, what about the small caps as an asset class? We talk about the headline index pulling 10, 15%. The pain in small caps has been immense. Now, you all had raised some money as well in the small cap fund. What is the deployment strategy out there? Do you think small caps as an asset now can do better, given the cues that we have and given the kind of underperformance? And also, what would be your top bets out there? Would it be cap goods, engineering, real estate? Some of these sectors that have actually pulled back a great deal.
I think, Nigel, you're right. A lot of small caps have bore the brunt of the correction in the market, and largely also because they had moved up significantly far beyond their fair value. And there was a lot of FOMO, a lot of momentum which had built into this segment. However, if you actually see last 3 months, the sector has been performing in line with the large caps. In fact, slightly better than the large caps. For us, we were lucky. The funds were raised at a time when the markets immediately started to correct. I think we have already deployed 60-65% in this correction of the fund corpus, and it's been across the board. Obviously, we continue to be positive on the financials. Obviously, capital good is a core area. But a little bit of allocation, which we normally used to avoid, which we have been aggressive, has been on the discretionary consumption side. And particularly the smaller the consumer discretionary names, we were getting it at valuation, which we have not seen over the last 3, 4, 5 years. So I think it's been a lucky period. More importantly, impact cost also reduces. In good times, it's very difficult to buy stocks. And in times like this, it's a buyer's market, So I think that has also helped. We continue to be optimistic. I think India is a country of entrepreneurs. The country is definitely going to grow despite all these sporadic shocks which we keep on having. I would say entrepreneurs in India would look for faster growth.
Right. You said you're getting aggressive on some of the smaller consumer discretionary names now. Can you tell us which sectors?
No, across. Consumer discretionary itself is a sector, yeah. So, I think we are seeing signs of valuation coming to normalcy. Obviously, we have to see if demand gets impacted. But if this conflict gets resolved faster, then we don't see even demand getting impacted. March was pretty okay. April first week has been slightly slower, largely also because the wedding season is more or less done within in March, and it's been pretty hot in a lot of places. But I think companies are pretty confident that if this conflict gets resolved faster, demand scenario for the next 2 years on the consumer discretionary side looks pretty good.
Got that. So just one last sort of question for it's been an absolutely crazy, bizarre period, right? All the way from January 2025. Let's just hope it's more boring now for the next 2.5 years. And fingers crossed on that. For India, it's been generally a tough phase, right? Since the highs that we've had. Beyond this bump and 1 day, 2 day kind of thing, are we in a more constructive phase? Can we say that? With a lot of the negatives priced in and markets getting stress tested. So sometimes those things also work in your favor once you've experienced all that, right? So are we at that point now?
No, I think that is exactly what we said in February. In fact, we came out with a note saying things are falling in place. And then instead of things falling in place, the missiles started falling in place. But actually, if you see, the tariff thing is behind us. We are ignoring that. We are at 10% tariff. I think the exports to US should bump up pretty well. Middle East reconstruction, India has huge opportunity. I think here, because of the income tax and GST cut and because of this huge liquidity surge which RBI has done over the last 1 year, we have seen auto sales, cement sales, steel sales, a lot of retail sales. You see the numbers of the retail companies which they have declared in March, DMart and Titan and every retail chain has done better. So things were already falling in place. I think we got this root shock in the form of this Iran conflict. But hopefully, as I said, if this is resolved, and I am very sure it will be resolved, we are looking at a good 2 years. India has underperformed massively. If you look even year to date, Korea is up some 35-38%. India is down 11%. So in 3-4 months, we have underperformed 50%. I think the valuation premium of India compared to the emerging market peers is a 10-year low. The underperformance of India vis-a-vis the emerging market index is at like a 15-year high. We've underperformed by 30% over the last 1 year. All these point out that a revival is near. Foreigners have sold a lot now. I don't think they can go more underweight on India, particularly given the fact that India stands out as a diversified and the fastest growing large economy in the world. And that hasn't changed. So we remain quite optimistic.
Well, it's lovely to hear. And I hope, we remain broadly constructive. It doesn't have to happen all in 1 day, but, it can happen slowly. But the road is better in that sense. Sunil, thank you very much. It's always a pleasure and good getting that insight and thoughts and that confidence from you. Appreciate it. Okay, well, Sunil Singhania with perspective on markets and how things perhaps, broadly the shape of things and what happens from here in his opinion. We'll take a quick break here. There's 10 minutes to go for the pre-open session. Mitesh Thakkar and Sudarshan Sukhani with some technical trading ideas on the other side. Stay tuned. Okay, welcome back. There's 8 minutes to go for the pre-open session to kick off, and let's get the top story out of the way. Manisha is here with a roundup of the action from the commodity space. We've of course been fixated about oil. We'll start with oil, Manisha, but I mean it's showing up in other places as well.
It is, absolutely. But the big move has actually come in for the crude oil prices. A 14-15% of a decline as soon as the markets opened. This is becoming a very, very volatile market. From 117 to 97 of a decline in the matter of 3 days is what crude prices have given you. And much of that decline, of course, is coming in the overnight markets there. We've been discussing since morning on the U.S. president delaying threat to attack Iran by Iran's civilian infrastructure by 2 weeks. Strait of Hormuz opening is something that the street will watch out for, Prashant, because at this point in time, it's a knee-jerk reaction. But we do understand that every day, on a normal day that is, Strait of Hormuz has had 100 to 120 ships pass through. Now, the street believes that that is down to a trickle of 2 to 3 ships, as we've seen in the last month or so. And even in the next 2 weeks, the street does not believe that we would see more than 10 to 12 ships perhaps pass by in all of those 2 weeks, because there is just so much of checking happening there. So in the eventuality, you would see the crude oil prices getting support yet again. But yes, the other commodities also have seen a big jump, whether it's gold up 2%, silver is up 3%, copper up 3%, platinum, palladium trading 4 to 5% on the higher side as well. So metals are having a great day, and crude prices as of now as a knee-jerk reaction on a weaker side.
Thank you, Manisha, for that. We'll have to wait by to see the actual extent and normalization of traffic through the Strait of Hormuz. Even Iran has said that the passage will happen via due consideration of technical limitations. So that's going to be a key watch point. Get into a break. On the other side, we'll get in the pre-opening rates. We'll also be joined by Rakesh Arora of Go India Stocks to focus on the metal space. Welcome back. Good time now to get a handle on how you should position yourself after we get that gap up opening. 16 minutes to go before we open for trade. Today is also the RBI MPC minutes. 10 o'clock is the announcement and 12 o'clock is the press conference. Mitesh Thakkar, Sudarshan Sukhani, as always, join in now for some technical trading ideas. Good morning, gentlemen. It's going to be a good morning, hopefully. Once we have that gap up opening, Sudarshan, what would be the advice?
Yeah, good morning. Well, we've been talking about how the market has been building a base, hopefully. This gap up tells us that there is a decisive breakout from the trading range that was developing. It's far more than we would have liked, but that's how the markets behave. Now, this is not a buy on dips opportunity, it's a buy on breakouts opportunity. Today, I would suggest divide your positions in two parts. One, take April end options, call options, and position yourself in the first, let's say, half hour or 1 hour of market trading on the long side. So buy part of the Nifty for the April end calls and just accept the volatility that could follow in the next few days. The second is an intraday trade. Look to buy a small dip in the market. So for both kind of traders or both kind of trades, the trade is buy this breakout.
Got that. So divide your trading stance today in two parts. Mitesh, what would your trading approach be?
I think, last 2 days we have been biased on the long side, and that should pay out well today. I think on the upside, if you look at the targets, on the 18th of March, we got an intraday high of around 23,860, and during that move, I think the pivot form on the hourly to hourly chart was around 23,820, 2840. So if you look at a broadly 600 point kind of gap up opening, I think the market might open close to those levels. So around 23,800 odd levels, I would suggest people who have long to take profits. And as Sudarshan also suggested, I think we can then wait for a 150 odd point kind of a decline, and that will be judged during the market to take some long positions. So I think that's the way we'll approach. First idea would be to take profits, and second idea is to, if you get an intraday dip, well and good enough, add some long positions again, 150, 170 points lower.
Stocks, Mitesh?
Yeah. On the stock side, I would recommend all long positions, and with the gap up opening, you might have to tactically adjust, but let's see what we get post the opening. So Adani Green is a buy with a stop at 909, so targets of 970. Bosch has been moving up well. That's a buy with a stop at 33,000 for targets of 35,000. A buy on Federal Bank with a stop below 270 for targets of 288, and a buy on Woodco. That's a buy with a stop at 169 for a target of 180.
Got it. Okay. All right. And Sudarshan, what about you?
Well, again, it's an all buy list. BDL, that's Bharat Dynamics, is a buy with a stop under 1210. Phoenix is a buy with a stop under 1570. Hindustan Zinc is a buying opportunity with a stop under 530. CAMS is a buy with a stop under 660. You have to adjust the stops a little depending on the gap up. I also have a view that for 2 years, we have been struggling in a very narrow trading range in the Nifty. Hopefully this year we'll break out of that.
We live in hope, and hopefully that takes place. But have to admire the call you made on the day of panic, Sudarshan. I recall you saying that the time to be gutsy, the time to buy is now, and that's worked out perfectly. So kudos to you. Good call on that particular day. Well, thanks, gentlemen. We'll touch base in a few minutes from here on. Well, let's turn the spotlight though on metals. Rakesh Arora, founder of GoIndiaStocks.com, joins us on the show. Hi, Rakesh. Good morning. Good to see you in yet again. Rakesh, let's talk about the aluminium basket first. We have JPM and various other brokerages that have become very, very optimistic on aluminium prices. And all of them, they are factoring in aluminium prices at still sub $3,000 per ton, which is a sharp discount in comparison to what the spot rate is at. And as part of that, they are still bullish. What's your view on this entire aluminium cycle? And there have been various capacities in the Middle East that got impacted by this war. How soon does it take for these plants to come back on stream? Or are we looking at a prolonged period of 6 to 9 months?
So, Nigel, definitely, there's a war risk premium built into aluminum price at the moment. And we need to know, how long will it take to get these plants in Middle East up and running. But, when I look at second half of 2026, there's a big capacity expansion coming up in Indonesia. And number two is that the cost pressures have been, very benign on aluminum. Their main raw material alumina hasn't really moved up at all. It's stuck at around $300 or so. So, cost pressures are missing. And number three, I would say is that, there's a lot of focus on recycling in China. And they have put a target of 27.
Last minute, they will tell whether logo
They
and all
put a
is
target of
needed.
15.
Right, Rakesh, just coming back to you. Rakesh, just coming back to you. I think we have a bit of an audio snag out there. We'll just get that fixed as well. We want to basically understand about how long does it take for these capacities to come on stream, and what's the view post this recent big outperformance. If you would remember, on December 4th, we here at CNBC TV18 had said that 2026 could be the year when aluminium as it is will be in a bit of short supply. It moves into deficit because demand growth will continue while China was almost at optimum levels. But for the next year, there could be some capacities that are coming on stream. I think we have Rakesh back with us, and I think we have fixed that audio. Rakesh, please go ahead. You were telling us how long will it take for these capacities to come on stream. And as you were saying, Indonesia, there is some supply that's coming on stream as well. So what would you work with in terms of pricing and a deficit situation on aluminium?
So aluminum remains in deficit for, the first half of 2026 and maybe for another 3-4 months. But then the Indonesia supply comes in and, the China is also putting a lot of pressure on recycled aluminum. So they are targeting 15 million ton of recycled metal. So that's the second supply zone which is coming in. So 2027 there would be a mild surplus in aluminium, and that's why brokerages are hesitant to raise their assumptions beyond 3,000. If things normalize in Middle East very fast, I think aluminum can go down to as low as $2,600 to $2,700, which would be a fair range for this metal. So while there's euphoria, you hold on to the stocks. But maintain, stop losses.
But would you advise people to just book out, in this year itself, Nalco, Hindalco, Vedanta, they have given you returns of 20 to 30%. Take money off the table if you're expecting aluminium prices actually to come down?
So, Nigel, we are closer to top in aluminum prices rather than, bottom. So it could be a good strategy, especially when the rest of the market is so bombed out and there are so many, value picks out there.
Got it. All right. So aluminium may be time to book some profits after enjoying a good run. And given the supply that we have, aluminium market globally could move into surplus from a deficit in this year. Let's talk about the ferrous pack then. What's your sense, Rakesh? Let's break it up into three segments. The long focus guys, the flat focus guys, or would you stick to the miners? Because iron ore seems to be in a bit of a short supply. I met a smaller mining company just yesterday from Raipur, and they were telling us that the trends are looking very strong for the miners itself. So how do you approach the space?
So, Nigel, steel prices have moved first, and steel prices are now at par with import price. So I think steel prices also, for the time being, seem to have peaked out because we also head into a little bit of a lean season when rains start. So I think steel prices don't have too much of room from here on. Miners are now catching up. So you saw price increases being announced by NMDC, MOIL, etc., and they've taken sharp price increases. So, and those stocks have underperformed the steel companies if you look at a slightly 3 to 6 month period. So maybe there's some catch up for the miners out there. But remember all these metal companies will deliver good results for Q4. So there would be some tailwinds.
Okay. And in terms of stocks that you'll look at, I think you'll have a close eye on stocks, I think like Godavari Power and Ispat. That's done quite well. Even in a market like this, it's closer to the 52-week high, I think so. You have Lloyd's Metal that's bounced back as well. That's another bulk of the money comes in from mining. Sarda is another stock that you're looking at. What would it be in terms of a pecking order? Would you look at the large cap name? JSPL, Jindal Steel, apologies, the name has changed. They have large capacity that's coming on stream. Would you go in for that? Or maybe a JSW Steel?
So, Nigel, the names you took are all integrated players who are increasing their mining capacity in a big way. And that is why they are benefiting because their costs won't really go up, with the steel prices. So these are really, the ones which are doing much better. But as I said, for the moment, steel prices look peaked out. So probably, look for companies which are doing decent capacity expansions.
Right.
Okay. All right. So your short point is maybe it's time to take some money off the table, even in the ferrous pack?
See, the results will be strong, so that's the only thing which is keeping me from giving that call. Otherwise, from a commodity price perspective, both aluminum and steel seems to have peaked out for the near term.
And ferrous over non-ferrous?
See, longer term, it is always non-ferrous because of the tailwinds from, renewable and recycling and all that.
Right.
But, short term, difficult to say.
All right, Rakesh, we'll leave it there. Thank you very much. Good day coming up for the market and perhaps for this space as well. Appreciate it. Well, Rakesh Arora, founder of goindiastocks.com. Well, let's just quickly run you through the pre-open because we've come to the end of the pre-open rate, the session, and it's a 3% bump up on the Nifty. The Nifty Bank will come up. And we should also look at the medium small cap indices at the end of it. So 4% in the Nifty Bank, which is, by the way, been hit harder, much harder recently. The mid-cap index is up 3, and the small-cap index, I think, is also indicating a 3 3/4% pop. So, I mean, that is large, right? I mean, let's just look at PSU banks as an index. Maybe if you're able to quickly just run through the sectoral indices one by one, the PSU bank index is up 4%. So you get an idea where these gains are concentrated in. It'll be interesting to see defense, right? Because as the war hopefully cools down, winds down, private banks are up 4%. Defense is up 3.6 this morning. So it's everything. I mean, today it's everything up with little differentiation with regards to themes or this works, that works, etc. IT, for example, is up another, I saw 3% there. FMCG is up about 1.6%. Pharma is up about 1.5%. So the maximum activity seems to be the metals index. And we just had the chat with Rakesh, 2.5% on the Nifty Metal Index. PSE index is up 2.3%. So gives you a real color across the board with what is happening. But it's concentrated in banking, metals. Did we put up real estate? If you can just quickly put up the real estate space as well and, see what's happening there. It's a 5% pop. And that is essentially what Sunil was in the morning saying. It's been beaten down quite hard. Anyway, it was a big Actually, real estate was the top underperformer at 25, started this year weak. So it's a 5% gap up on the Nifty real estate space. All right, brokerage notes of the day, and Sud has been parsing through those, and he's got a few for us. Sud, morning.
Morning, Prashant. So two stocks where coverage has been initiated. First one is Pine Labs. JP Morgan has initiated coverage with a neutral call, and target here is 165 rupees per share. It's been a pioneer in-store payments, infra and affordability solution, and also built and bought out adjacencies in outline payments and issuing and fintech infra. It has large and growing TAM for digital payments with 23 to 25% CAGR over FY 24-29, and JP Morgan expects EBITDA margin to rise to 27% by FY 28. Next on ICICI Prudential Mutual Fund, HSBC has initiated coverage with a buy call, and target is 3,600 rupees per share. It says company is set to outperform peers on key operating and financial metrics and positioned to manage yield pressure while seeing positive operating jaws and core EPS growth to mirror AUM growth for the company, and it's well positioned to capture further AUM market share gain over medium term, and it estimates 20% CAGR in total AUM growth over FY 26-29.
All right. Thank you very much for that. So those are a couple of brokerage calls. Well, 9-10 calls with Sudarshan. Sudarshan, what do you have?
It's Hindustan Zinc, Hind Zinc buy with a stop under 530.
Hind Zinc is a buy. And Mitesh, what about you?
Yeah, I'll go with a buy on Adani Green.
Buy on REC?
Adani Green.
Adani Green, beg your pardon. Yeah, okay, Adani Green. Anything else as pre-open? You're looking at pre-open stocks and where they're all opening up, Mitesh. Anything else you want to highlight?
I typically wait for Prashant 9:15. I think that's the real rate. Pre-open it is slightly confusing for me.
Anything looking like it would? Or this is looking a little excessive. Is that what you're saying, Mitesh, across the board, across stocks, etc.?
No, not exactly excessive. The idea is that the rates typically take some time to settle, and that's why I wait for clarity to emerge before taking a proper call.
Okay, got that. Mitesh, thanks very much. Titan in focus. Mangalam is here with the spotlight on it. Mangalam, take it away.
It's a good update that has come in from Titan. We were expecting good updates from all the jewelry companies, and Titan was the one which was expected to report numbers, and it is pretty much on expected lines with a few positive things. What is a positive? The overall growth is about 45%. Domestic jewelry growing by about 42%. A large part of that growth led by, their key brands, Tanishq, Zoya, Maya, up around 47%. CaratLane has grown a little slower at around 24% as against its earlier growth rates of over 30%. But importantly, the buyer growth, that has returned to high single digit. And that's a positive because over the last 3 quarters, buyers weren't coming by. The number of buyers increasing was absolutely flat. And this time around, that is a positive, along with higher share of revenue coming in studded, along with, gold coins and gold jewelry doing well too. So higher gold prices, revenues increase, lower gold prices, buyers increase. All in all, a perfect position for someone like a Titan to be in.
Thank you very much for that. Let's just pull up Kalyan and Senco Jewelers. Yesterday, Kalyan Jewelers started very strong, but by the end of trade, it had ended in the red, despite the update being super strong. And Senco was also a big mover once it came out with their quarterly updates at the start of the week. The pre-open has settled, and it's settled at 23,855, which coincides with the 18th of March intraday high. And that, Mitesh was earlier telling us, that will act as a bit of a resistance to begin trade with. So we will have a very strong gap up opening straight away. Benchmark indices are suggesting a start with a gain of about 3%, 700 points up on the Nifty, and on the Sensex, it should be a start with a gain of about 2,700 points. But just to put it in context, before the war began, that's on the, prior to 28th of February, the Nifty had closed at 25,178. So that's the distance that we need to cover if this relief rally has to turn into a permanent resolution and markets can put the conflict behind. But just awaiting the actual opening rate now.
Yeah, 700 higher. We are closer to 24,000 than we are to 23,000, and it's a strong, very strong start. 4% on the Nifty Bank to begin today's session. Look at Interglobe, 4,600. I mean, everything will be 5-6% higher this morning. So portfolios will look better, much better compared to where they left off yesterday. So there we go. 3% across the board, 4% of the Nifty Bank, 23,840, 55.25 is where we are starting. ICICI Bank is up 5%, SBI is up 4%, PNB is up 4%, Federal is up 3.5%. You look at right out of the gates, it's very early, but 1,600, 1,700 stocks are higher and some 90 stocks are lower. So, as I said, this is everything up kind of a day with a little differentiation with regards to, the ceasefire. Nobody's going to ask the question whether this really does anything for this business or that company or that stock, at least not today. That'll happen tomorrow. So, 750 on the Nifty, 2,450 on the Nifty Bank. Mid-cap index, small-cap indices, all opening up. There are 2 names in the red. And actually, I think those are the 2 names we had on our top 10 negative list. So ONGC and Coal India, everything else is up big time. And the oil-sensitive Indigo is up the most. It's followed by Larsen. It's followed by Shriram, Adani Port. All the Adani names are doing very well. So 750 to begin this Wednesday morning. Rima.
Well, let's pull up the advanced decline ratio, because what I can see on my screen are 2,500 stocks advancing for 150 stocks declining. That is a fantastic advanced decline ratio. It's an all green screen to begin trade. The mid-cap index is up nearly 3.5%. Right on top is Interglobe Aviation in the large cap screen, 10% gain on Interglobe. One, of course, is the decline in crude prices, but 2, ERA has announced a 25% cut in flight landing and parking charges across major airports for a period of 3 months. So that will also help airline companies in bringing down the costs that they need to pay to the airport for docking and landing, etc. So twin positives, and Interglobe Aviation is the top gainer. L&T has moved up 7.5%, crossed the 4,000 handle in today's up move. Before the conflict, L&T was at 4,300, so it's still got about 300 rupees to bridge to get back to the pre-conflict levels. Shriram Finance is another big mover, 6.5%, and now it's erased all the year-to-date losses this month. Shriram Finance up 14%. L&T, as I said, is a big mover. Ultratech Cement is seeing some gains. Adani Group stock, so high beta, are seeing a lot of interest. Adani Ports, Adani Enterprises seeing buying. Auto names were hit on account of supply concerns, and you're seeing a powerful up move in Tata Motors, Maruti Suzuki. Stocks are up nearly 5%. M&M also up 5%. Along with that, you've got Tata Motors passenger vehicles. The Nifty banking index is straight away open. It's outperforming. While the Nifty and the Sensex are up 3.3%, the Nifty Bank is up 4.3%. ICICI Bank, Axis Bank, HDFC Bank doing the heavy lifting today. Reliance Industries will also come up for your new screen. Eternal was beaten down. The stock is still down 30% from its 52-week highs, and Eternal is seeing buying. IT is in the green, but the gains are very, very modest. So flattish open coming through for Tech Mahindra, Wipro. TCS is up nearly 1%. And on the way down, it's ONGC down 3.5%, Coal India down 2%. And along with ONGC, just spotting Oil India. But that's the one which is negatively impacted on the back of the decline in crude.
Well, that's right, Rima. Some of those crude sensitives, they are bursting up, and some of them that got hammered out of shape. A quick couple of words on stocks from the broader markets. You have ProStram, I think that was at the bottom of our screen. They've received a letter of award, so that stock is up more than 10% in today's trading session. Phenomenal move being seen on that particular name. Big move out there. A few more names that have done quite well. The OMC stocks, well, they are bursting in trade in today's trading session, doing very, very well. You have Interglobe Aviation as well, that's up. Ola is up close to around 2.5%, one of the top volume traded stocks that we normally see. Just take a look at Ashok Leyland. I recall out of all the auto names, that was a disappointing set of numbers that came in the past month. That stock is now up close to around 8%, so it's fighting back. Some of them are Motherson as well, bouncing up in trade. IDBI Bank, it hit a low of around 62 rupees. That's bounced up close to around 15% from the low. So big up move is what we're seeing. All in all, a solid start to the trading session. The Nifty has moved to around that 23,900 odd mark. You'll want to end somewhere around here. And the biggest positive, telling you the pulse of the market, is the India VIX. Last week at 29, today at around 19. So that's the kind of cooling off in the India VIX. Good for sentiment, good for the markets. The fear index is cooling off. That's pretty good news from a market perspective. And the rupee as well, if I saw that correct, that strengthened by around 20 paise. Guys, good times. It's been a while. It's been so long.
I thought that now you're going to break out into a song.
I was wondering whether to, but I think I'll hold that for a little bit later. The morning we did Britney, oops, he did it again. Now it's been so long.
All right. I think, there's a bonus from LIC as well, 5% higher on LIC as we start the day. So it's a good-looking screen. And as Lata was saying, right, at 10 o'clock we'll get the RBI decision. The governor would not mind changing his speech, what he wrote yesterday to, of course, to reflect the new realities starting this Monday. But of course, from a regulator perspective, the idea is not to kind of sort of time this or react to one-day events, and take a longer-term view in the best interests of the economy, financial stability, currency, etc. So, we'll see what happens. But as Lata said, very, very unlikely, especially now with the strength in the rupee, that FCNR deposit, basically to get dollars from NRIs, and it's been used before, it's very unlikely we'll see that being announced in any shape or form. So we don't have to wait very long, by the way. 40 minutes more, 45 minutes more, and we'll have it. So that's the picture at this point in time. 38 minutes and 53 seconds to go for the governor's decision, the RBI decision to come through. Maybe just a couple of other sort of, top movers, if we can have a few hot boats from the small cap space, the NSE 500, to get you a sense and color in terms of what's happening, right? 3.33% higher on the small cap index. It's kind of lagging behind maybe in line with what the Nifty is doing at this point in time. Look at the bump in oil marketing stocks at the bottom of the screen. BP and HP, the most IOCs following behind with a 6% jump at this stage. There's ONGC, which is down 3.5%. It's basically, it's a long list of oil sensitives which are all taking it on the chin at this point in time. Larsen was the other one, which of course is also, it's got humongous Middle East presence, and that also sold off pretty aggressively on the back of what we saw. So back above the 4,000 rupee level at this stage.
Just one more point, Prashant. These are days when you thank your stars that this market is aggressively net short. When you have the short contracts from FIs at 2.6 lakh contracts, which is at extreme levels, you thank your stars because you don't need them to buy, you need them just to cover their shorts, and you'll have a big, that additional pop will come in there. So by the end of today, it's going to be interesting to see the kind of short covering. My guesstimate would be those short positions come down by 10, 15 or even 20% in today's trading session. Let's see how that goes because the start itself is well above the 20 DMA. It's taken off those crucial barriers as well. So, it's going to be an interesting trading session. At the end of today, we'll bid buy for the FI flows, as well as the kind of short squeeze that we're seeing. And counters that have got shorted heavily, they're coming in for the biggest bounce. Case in point being the Nifty Bank Index. Just take a look at that. Bursting away in today's trading session. 55,000 from 50,000 just last week.
Yeah, absolutely, Nigel. And, one also hopes, along with the short covering, that buying also, cash buying also. Yesterday, for example, there was another 8,500 crore figure, actually more. You want, long onlys also to start to come back. And Sunil was making that point to watch whether the stance of global investors, foreign investors, etc., does start to change a little bit, because it's been one hit after another. We started this year with a little bit of tariffs, but it was predominantly AI, and then late February onwards it was Iran. But even in 2025, it was a long waiting game for that deal with the US, and whether it'll happen, not happen. So it's been a tough phase for some time now for the markets. And IT, for example, right, on your screen, that AI hit. Stocks had sold off aggressively. Last few days, of course, has been good. The IT index has come off the highs of the day. But that perhaps also because it's added on about 4%, 5% very quickly in the last few trading sessions or so. Nilesh Shah is with us. He's Managing Director at Kotak Mahindra Asset Management Company. Nilesh bhai, good morning. Great to have you with us here. And there is peace on the screen and green on the screen. What theatrics and last-minute brinkmanship and finally a ceasefire which has been announced, Nilesh bhai, is the question, of course, is whether the peace will hold, and one hopes it certainly does. But for us here in India, Nilesh bhai, if you want to just outline what this means, broadly, the shape of things to come, in your opinion.
So obviously, Prashant bhai, a ceasefire is a welcome move. If it opens up Strait of Hormuz, and there are contradictory statements between the Truth Social post of President Trump and Iranian post, but let's hope for the best. From our point of view, four things matter. 90 lakh Indians' safety in Middle East paramount concern. They send $50 billion remittance. That flow is important for our stability of currency market as well as deficit. Third, availability of oil and gas is important for many of our industries. And finally, if price of oil is on the lower side in double digits rather than triple digit, that's positive for Indian economy. So apart from the ceasefire ensuring safety of Indians in Middle East, we'll be looking at Hormuz Strait, how much oil and gas starts flowing from there.
No, absolutely. And I think the thing is, we can track it easily. Actually, we can track it. Anyone can track it easily because, as we've highlighted before, and markets will watch that very closely. For markets, Nilesh bhai, here in India, will we see a more constructive kind of phase, or will we start to worry about something else? Before this Iran thing broke out, it was all about AI, right? Gloom and doom. And then this happened. But have things, not adequately, but sometimes it just gets to an extreme, right? A level of pessimism. And then you start to move in the other direction. Are we there yet? Beyond today?
So undoubtedly, Prashant bhai, we were not on the pessimism side. At 18 times forward earning, we were trading at premium to other emerging markets. That can't be called pessimism for sure. We were not trading at 10 times forward like we traded in COVID 20 time. That probably can be called pessimism. Market is like a juggler. The focus is always on the ball which is falling, not on the ball which is going up. Undoubtedly, market will keep a watch on availability of oil and gas, price of oil and gas, whether this ceasefire is honored by Israel. And apart from that, I think now focus will shift on the quarterly earning. The March quarterly earning got impacted by 1 month of war, but the secondary and tertiary impact could last into June quarter. So people will be interested to know how June quarter earnings will get impacted by ongoing situation. At the end of the day, Prashant bhai, we are in a period where returns will be moderate, more linked to earnings growth than to valuation re-rating. And investors and speculators both will have to get adjusted to it.
Nilesh, morning, this is Rima here. The problem is that even from this level of nearly 24,000, if we go up 10%, we still would be at 26,200, which is where we started the year, 2026, which means this year, 2026, would be a flat return kind of a year. What do you expect, considering that, for the next 9 months, now considering there is still some uncertainty on what the second order, third order impact on earnings is going to be, the extent of earnings downgrades we might potentially see in June. What's your own forecast for the market?
So, Rima, for last almost 10 calendar years, Nifty has delivered positive return. This is one of the longest streak. No one complained that, oh, Nifty didn't give any negative return in a calendar year. In equity market, that should have happened. Now, you have made money for 10 years. Maybe 11 years, you'll have to be happy with no return. Number two, what about asset allocation? Did you put all your money only at 26,000 Nifty? What did you do when the market was correcting? So equity investment, if you measure on a 1 year basis, that will not be fair. Businesses don't get built in a 1 year. You'll have to take a longer term view. And if you take a longer term view, again, I will stress, please moderate your return expectation. We are not going to see high double-digit return like post-COVID lows, because that was when market was 10 times forward. Today, it is probably 18 or 19 times forward. Those returns are not going to come. Be happy with moderate return and then only invest.
So if you have to construct a portfolio right now, could you give an indication of what's the best way? Let's start with the asset allocation, and then for someone with a long-term view, and then which sectors are considered safe or attractive from a valuation point of view where there will be some earnings?
So from a longer-term point of view, we think banking and financial services is one sector where valuations have corrected. Maybe there will be some impact on their margin for the March quarter, but thereafter FY27 earnings growth should be double-digit. The second sector where one could look at is domestic focus consumer discretionary. If oil prices come down in double-digit, then there will be beneficial impact of all the steps taken by government, from EMI burden reduction through interest rate cut, GST cut, income tax cut. And we did see Jan, Feb, March consumption, improving further. So consumer discretionary space, maybe it's the summertime. So first consumer durables, then probably airline, travel, tourism, which has been hit very hard because of this geopolitical situation. And maybe thereafter healthcare and hospital. So this will be the consumer discretionary plus banking and financial services sector, which should outperform the market.
Hi, Nilesh. Good morning. Good to see you, Ben. Better times, right, for the markets and a better day. So that's pretty good news. Nilesh, since you briefly mentioned about asset allocation, for investors that are looking to allocate money, what would the buckets be now if you just break it up into three: equities, precious metals, and then you have debt? What should it look like at this juncture?
So on the equity side, we are kind of neutral weight to equity, but at the higher side. So all our multi-asset allocation fund, balance advantage fund are towards the higher side of equity allocation, but in the neutral range. So if neutral range is, let's say, 40 to 60%, we are at 60%, not at 40 or 50%. So higher side of neutral equity allocation. Within that, we are overweight large and mid cap and underweight small cap. Small caps have shown better earnings growth, but they are trading above their historical valuation. Large cap yesterday were trading below their historical valuation. On the fixed income side, we are advising barbell kind of strategy, where you go and buy extreme long end, 30-year, 40-year, 50-year. We believe that's where interest rates, market interest rates are unlikely to move further up. They'll consolidate over there or may even come down. And then you create barbell by investing in up to, let's say, 3-year carry product, corporate bond fund, short-term bond fund, money market fund, and those kind of shorter funds. On precious metal, we still remain bullish on gold. The central banks of Russia, Turkey, probably Poland sold gold. Central banks of India, China, Japan probably didn't buy gold. ETF also saw sharp drop in gold in subscription, and hence gold buying was reduced. But going forward, we think with ceasefire, if US interest rate starts coming down, DXY, the dollar, starts weakening, gold prices should start moving up.
Okay. Another point, Nilesh, is the kind of selling we have seen from the FIs. But we have to focus what is in our own hands, right? And the strategy, as you have been explaining for a long time, is that you need to stagger it out, keep your staggered flows going in, the SIPs and the likes. What about liquidity in the domestic mutual fund industry? If you could help us out with that number, because the FIs, they sold more than 1 lakh crore in the last month. And this month, we're just a few days in, already 35,000 crores odd. So how is the domestic liquidity situation looking?
So domestic mutual funds liquidity will vary fund house to fund house. At Kotak Mutual Fund, we did not believe in keeping cash. Our investors gave us money in equity fund to invest in equity. And we have told them that we won't be taking any cash call. So whatever money came, whenever they came in, we decided to deploy. We are not absolute return chasers. We are relative return chasers. My job is to outperform benchmark indices, not generate absolute return. So we operate our funds at less than 1% cash.
Nilesh, in about 30 minutes, we'll have the Reserve Bank of India and the decision. And it looked pretty bad yesterday. Is looking much better this morning. That's how fast things change now. But what would you expect? I mean, with all this talk of this FCNR deposits, whether that's necessary, not necessary. Of course, as I said, the currency also is now looking in much better shape. Latha, of course, was saying it's absolutely unlikely we'll see something of that sort. But anything on your mind with regards to policy?
So never argue against Latha will be my principle. And your laughter says that all three of you agree with that.
Oh, of course we agree.
I laugh the loudest. I'm getting nervous.
On a serious note, Latha is absolutely right. Rupee is well behaving after the steps taken by the RBI. And what we need is a Mehuna policy. Today, there is, thanks to the geopolitical situation, some respite in the market. Otherwise, rupee market was in kind of little bit panic mode. Interest rates had moved up and equity market was seeing FPI selling and correction. At this point of time, geopolitical situation has given one relief. But what we need is a Mehuna policy from RBI, where RBI says, look, we have brought rupee under control. We are sitting on almost $700 billion of reserve. Albeit there is a short forward position, but we are in control. On interest rate, they have to assure market that we are in a pause kind of situation rather than hike kind of mode. And there will be adequate liquidity to ensure that interest rates comes down below 7% rather than remain above 7% on 10-year yield. And growth will get supported. If our growth is better than our peer group, then global investors will start looking back.
Yeah. No, absolutely. But you gave us that line, nice line, and you gave us the headline, actually. Mehuna policy. So well put. It, I think, covers everything which markets would like to see, and generally, I mean, I think which is good for the economy as well as a backstop for just saying that, well, I've got your back in that sense. Thank you very much, Nilesh Bhai. Great to have you with us here. Appreciate your time here on CNBC TV 18. Always a pleasure.
All right. Okay, let's move on now. SEBI has given IPO-bound companies more time to list on account of the market volatility, helping firms avoid rushing public offers at a time when the sentiment is weak. Harmis now joins in with more on this. Harmis.
It's a big relief indeed, and considering, of course, before today's announcement, that the volatility that the markets were gripped with, there was some lull in the IPO markets when it comes to bringing out issues at such point of time. And as a result of which, SEBI made this announcement yesterday. There's a one-time extension for the IPOs and the rights issue approvals that were given until the 30th of September 2026. And this extension, though, is only valid for companies whose approvals expire between this window of the 1st of April until the 30th of September of this year, and of course prompted due to market volatility. Now, usually what happens is that an observation letter or an approval letter that the SEBI is giving for an IPO is valid for a 12-month period, and for those who have filed their IPO papers through the confidential route, that process is valid for an 18-month period. And now, as a result of this amendment, in order for companies to take advantage of this, they must have to now submit an updated offer document and an undertaking from the lead manager that they are in compliance with the Schedule 16 of the ICDR, and therefore then take advantage of this. Now, there are certain big issues that were in the pipeline that were stuck and that could get some potential relief. Now, this is data from Prime Database. Well over 40 companies get potential relief because of this, whose deadline ends until the September the 30th. But there are some big issues. For example, Greaves Electric Mobility is one such name, the unit from Greaves Cotton, Hero FinCorp, Kent RO, Prestige Hospitality, the much awaited one from Prestige Estates, the hospitality unit, Juniper Green Energy, Hero Motors. There are such big names, and IPO sizes of anywhere between 1,000 crore rupees to as high as 4,000 crore rupees. Such big IPOs were stuck because of this market volatility, and as a result of this SEBI move, they're likely to get some relief.
Thank you very much for that. Statements coming in from the US President. A big day for world peace. Iran wants it to happen. They've had enough. Likewise, so has everyone else. The United States of America will be helping with building the traffic in the Strait of Hormuz. There'll be lots of positive action. Big money will be made. Iran can start the reconstruction process. We'll be loading up with supplies of all kinds and just hanging around to make sure that everything goes well. I feel confident that it will. Just like we're experiencing in the US, this could be the golden age of the Middle East. He signs off. President Donald J. Trump. So sort of sounds like a bit of a victory lap, right?
Rima, he's a typical New York businessman, right? He's always optimistic, always there to kind of make the next
money.
deal. Just look at the language, right? We'll be hanging around. There's big money to be made, loading up. I mean, in a way, it's a good thing, right? That he is a businessman and he's thinking money and all of that stuff. But he's also, of course, the president of the US. But I'm just saying that look at this. It's a weak. I wouldn't read it as a victory lap. Actually, it's just like it's just it's just a positive kind of a thing, and trust the ceasefire, and I don't think there's anything more to it. It's typical. It's typical of if you read articles from back in the day in 80s, 90s. There's a New Yorker profile, Atlantic pieces. This is typical Trump New York handshake. Kind of businessman out there to make a deal.
Yeah, and just the fact that it's positive and it's got a very optimistic tone. Yeah. So it just gives more credibility to that 2-week ceasefire. You're not going to constantly doubt that ceasefire on whether that's not a permanent resolution, but maybe more of a pause before hostilities pick up. So this statement sort of gives it that positive conclusion.
Just hope and pray that it sticks. Just hope and pray that it sticks. Everyone can call victory. Iran will say, I forced them to do the deal. President Trump will say, I did that. Pakistan will say, I mediated. Just hope that this sticks and we continue, with economic activity globally, and we stop, all this bombing and shooting and etc. So hope it sticks.
All right, let's get back to the big IPO story, because as Hormuz was telling us, SEBI has granted a one-time extension for IPOs whose approvals were expiring between 1st of April to the 30th of September 2026. So this was on account of the fact that there was so much market volatility, the sentiment was hit. Many companies could not follow through with their IPOs despite getting that approval. And now with this extension, they don't need to refile the paper. So it just saves a lot of regulatory bandwidth for the companies and for the SEBI as well. So it seems like a market-friendly, very pragmatic step. Pranav Haldia, MD of Prime Database, and Karan Marva, Head of CFO Advisory and IPO Advisory at Grant Thornton Bharat, are now joining in. Gentlemen, thank you very much for joining in. Pranav, let me begin with you. Your thoughts on this IPO extension? We've seen that in COVID in 2020, and now again, exceptional times. So we've got this extension. So share your initial thoughts. and the extent to which it will benefit? How many IPOs whose approvals, are likely to expire in this next 6 months?
Well, first of all, a very, very good morning, and what a great morning this is. And I'd like to say that what a difference one night makes. And let's hope, as Nigel was saying, that let's hope it sustains. And let's also hope that this relaxation which SEBI has rightly given is not required at all. And, markets bounce back. As we've always seen that primary market takes its cue from the secondary market. And, in case this rally sustains and you see some bullish momentum coming back, I would not be surprised if you start seeing some IPO launches happening as well. So coming to the data, as Hormuz was saying, there are about 40 companies which will stand to benefit with this relaxation, which are looking to raise 60,000 crores. And, this is just the companies whose approvals are due to expire till 30th of September. But, let's also remember that there are close to 200 total companies in all looking to raise 3 lakh crores, which are presently in the pipeline, which have either already filed with SEBI or which are awaiting approval. And this does not even include some of the mega IPOs which we are expecting this year. So there is a huge buildup of companies which are looking to tap the IPO market. And, as you said, the last time this relaxation was given was during COVID times. Let's hope the ceasefire works out and we do not require this relaxation to be extended or actually required at all.
Okay, we can see the RBI governor walking in. So we've just got about 1 or 2 minutes. So Karan, you want to share your thoughts?
Hi, good morning. I think it's a welcome move. I think it's in the right direction and it allows companies, the much needed breathing space, given everything that's happening in the world. You wake up every morning and there's a new headline. But I also think that while, and I agree with Pranav, I think we'll see hopefully, some launches coming back. Last year was a record year for the Indian markets and this year was supposed to, be better. And hopefully it'll come back to that. But I think one also needs to wait and watch and see how, companies react. Because clearly, the business fundamentals have changed or have been disrupted for a lot of companies, given, geopolitics and everything else that's happening. So we'll have to wait and watch, how many of the companies that are, eligible and ready are able to or are willing to go ahead in spite of or because of this relaxation. But definitely a welcome move. I think it gives companies, like I said, a little more breathing space to, be able to come back to the markets.
Pranav, very, very quickly, we've done this analysis. Hormuz, in fact, had done it towards the end of the year. That while last year was a record year in terms of the money raised, the IPOs, many of the companies, nearly 50%, were trading below the issue price. So what is the mood towards the IPOs, even if you get the green signal?
Well, this is a hotly contested topic. My view remains that, when there's a complete market meltdown and all your already listed companies are also trading at huge discounts, it is slightly unfair to expect that the IPOs which got listed in 2025 or 2024 will continue to trade in the positive, in perpetuity. My view remains that after a company IPOs, once it gets listed on the secondary market, its share price will go up and down on the basis of the company's own performance, how the sector is doing, how the broader market and economy is doing. So I think it's a slightly unfair expectation that we have, that we keep on looking at IPOs at any point in the future and expect that, all of them should trade in positive.
Karan, Pranav, unfortunately out of time. We'll need to start our coverage on the RBI monetary policy. It's going to be a big one, not in terms of rates, but what the commentary is going to be with respect to growth, inflation, the weakening that we've seen in the rupee. Thank you very much for joining in on this discussion. For the market still holding up smartly, now inching towards 24,000. It's 23,945 on the Nifty. Had a gap up opening and managed to build a little bit on it. Get into a break. On the other side, we'll begin our RBI coverage. We'll chat with Kaushik Das, Indranil Pan and Parul Mittal Sinha ahead of the RBI Governor's MPC address.
Shut up. Welcome to the monetary policy coverage. The title should ideally be Kahani Mein Twist. The Reserve Bank Governor perhaps spent the morning rewriting his speech because things are looking far less gruesome than they did just about, say, 10 hours ago. And therefore now perhaps what we have to watch out for is, of course, a no-action policy, but maybe watch out for what he says about liquidity, what he says about the new GDP forecast and the new inflation forecast, and if he lets slip anything on the rupee at all. Well, I have my colleague Ritu Singh also joining me from the CNBC TV 18 studio. Morning, Ritu.
Good morning, Lata. You know, the RBI governor may be rewriting his speech. We've had little time to redo our poll, but yes, the expectations very much remain a no-rate action policy. What happens to the forecast now, and what is the oil assumption that the governor, that the RBI makes, which we'll get to see in the MPR? I think that's something we'll keep an eye out for. But the FY27 forecast on the macro, that's what we'll be getting for the first time. So stay tuned to that one. Not much is expected anymore on the rupee or the bonds, given the action that we've seen overnight. So a lot has changed, but a no-rate action policy. Macro forecast is where we'll keep our eyes tuned to. The FY27 GDP growth, as per our poll, is seen about 6.9 to 7%, and the CPI number at about 4.1 to 4.5. Liquidity, yes, that's something we'll want to hear more on, but lots change overnight, so we'll have to see how the MPC adjusts to that.
Fair point. I guess there would be a con call or maybe even a physical meeting today itself before the statement is finalized. But we have our guests with us, Parul Mittal from Stanchart, Kaushik Das from Deutsche Bank, and Indranil Pad from Yes Bank. Gentlemen and Parul, thank you very much for your time. Parul, what will you watch out for now?
Hi Lata, thanks for having me. For this policy, like you mentioned, things are evolving by the hour. So just a few hours ago till yesterday, market was just hoping to not get any rate action, was hoping not to get any interest rate hikes to support the rupee. What market will now watch out for in this policy is any discussions on the liquidity, any discussions on the stance going forward, and whether RBI would like to draw out some liquidity from the interbank system. That is one. The other is commentary on the rupee. I think it's currently the discussions on rupee which are really driving the interest rate markets as well. So if RBI comes up sounding calm about the rupee or standing ready to take actions to continue defending the rupee, that may also calm down the market. So these two aspects is what we'll watch out for.
Yeah, Nilesh just described it as a mehuna policy would help on the rupee. Kaushik Das, morning to you as well. What are you do you expect that there will be changes to growth and inflation forecasts, growth lower and inflation higher, or even will that be left to just scenarios? If it is 85, this is the growth. If it is 100, this is the growth. Crude oil. Or are you expecting they will give a forecast, and will the market read into it anything?
Hi, Lata. Good morning. I'm expecting some forecast to be given. Now, that forecast could be given in the range, like they can mention like growth in 6.7 to 7%, that kind of a thing. Not give a point estimate, but not give everything in terms of a scenario. That scenario can be a part of that MPR report as a separate exercise. But from the monetary policy statement, I would expect some growth forecast and inflation forecast. And I would expect growth to be lowered. Even with this ceasefire, oil is at 95. So we are nowhere close to 65, 70. And we need to see what's the new normal once things stabilize. Are we at 85, 90? Still then, it's a kind of higher price compared to where we were before the war. And then we have to, think about growth from that angle. There are also questions of gas supply, whether supply chain disruptions will happen or not. So the question is whether RBI shows growth below 7%. For FY27, our own forecast was 6.7 before today's announcement. So somewhere between 6.7 to 7 is what I would expect. On inflation, whether RBI shows inflation above 4.5% as per forecast is concerned, that will take into consideration whether the government will consider hiking prices in May, depending where oil prices settle between now and May. If it is still at 90-95, there could be some requirement of price hikes in May. So all this, as Parul mentioned, is evolving by the hour, by the day. Nobody has a clue. So at this point of time, it's better that you maintain that neutral stance, you maintain a neutral tone, and you highlight risks both to growth as well as inflation, because inflation risk is not just because of oil. This year we could have El Nino, and there could be spillover to core inflation. So I think RBI will reduce growth to some extent and inflation higher. And what will be important is the tone. What is the degree of comfort or discomfort they're showing on growth slowdown versus inflation uptick will determine how markets perceive this as, whether hawkish, dovish, or neutral.
Okay, if this is indeed war fears speaking off and crude prices speaking off, then I guess the need to sound hawkish goes away. But Indranil Pan, do you expect that the governor will say, I mean, we will all ask him questions, that I am restarting BRRR. Are you expecting a concrete statement on liquidity, or the contrary, that he will continue to say, I don't mind if Walker, the call rate is below the repo rate?
Well, I think at this point in time, as both of your other guests pointed out, it's a zone of uncertainty. In a zone of uncertainty, you really don't announce too many things. That's perspective number one for me. And on the liquidity, I think we are comfortable on the liquidity. Liquidity is also conditional upon how much of FX sales the RBI would have to do in future months to take care of the volatility in the rupee. For now, the rupee seems to be managed because of the sort of taking away of the speculative positionings in the market. And if there is no escalation in the tensions, I would sense that there would be some trickle in terms of the capital flows, because India still continues to be one of the best growing economies of the world. And at these levels of the market, we can still, and if the rupee stabilizes, and that's important, we can see capital flows sort of trickling in and helping the rupee indeed. So I don't think there would be very specific announcements on the liquidity, except for the fact a continuation of an understanding that we would continue to maintain liquidity adequate in the system. And now the second thing, of course, is that in the first half of the year, anyways, the liquidity is relatively on the better side. It's the second half of the year that shows up with relatively higher strains in liquidity. So that also needs to be kept in mind at this point.
Yes, Parul, on the rupee specifically, there have been some chatter about the FCNR deposits. It seems far-fetched at this point. But if not that, what specifically are you hoping to hear from the RBI?
Yeah, so rupee, we think RBI will follow on with more measures to continue supporting the rupee, and it could come in any format. So FCNRB, like you said, I think we are not there yet. It's a measure that can come in at a much later stage if this stress continues. Right now, I think the first line of action can be giving an oil window where RBI can satisfy the demand of oil companies outside of the markets. That's the lowest hanging fruit. We think some measures to increase duties on non-essential imports that can come through, some kind of restrictions on LRS. So there are many other smaller measures which can keep coming in, which continue to reduce the impact or take away the pressures on rupee. So those kind of measures, if anything comes through, that will continue to tell the market that RBI is standing ready to keep supporting the rupee. And as and when dollar rupee levels come down, I think we will see a positive knock-on effect on all of the markets, be it the IRS, the OIS markets, the bond markets, the corporate bond markets, and even the FX forward market. So giving that comfort to market is going to be very key in this policy.
Okay, Indranil Pan, besides, of course, rupee and liquidity, we'll watch out for no rate action policy. Could there be a joker in the pack? Anything else you're expecting or you'll be looking out for from this policy? Any trade relief, related measures? We've seen RBI come out with some earlier. But anything else you'll be watching out for?
No, I think first of all, this policy is more in terms of the rate setting, and that is what the MPC would be discussing. Most of the for example, the rupee action and the liquidity action gets taken beyond the policy, except for a commentary in terms of the direction that the RBI would want in terms of both the liquidity and the rupee. The other thing, therefore, we are not really expecting any significant policy that impacts the financial markets perspective. Importantly, I would be looking out for the growth inflation mix that the RBI is looking at and what are the risks around that. Consequent to that, the market would possibly take a cue in terms of future actions from the Reserve Bank of India.
Welcome you all to the first policy of this financial year. At a time when the global economy is facing unprecedented challenges, from heightened geopolitical tensions, the conflict in West Asia, for which a temporary ceasefire was announced today, and the disruption in global supply chains. Before the outbreak of the West Asia conflict, India's macroeconomic fundamentals exuded confidence with buoyant growth and low inflation. Conditions, however, turned adverse in March with the widening of the conflict zone and its intensification. The fundamentals of the Indian economy are on a stronger footing at the current juncture than it was in previous crisis episodes, as well as relative to many other economies, providing it with greater resilience to withstand shocks. Global growth faces increasing downside risks as the sharp rise in energy prices and shortages, some of which we saw a correction today in the prices of energy, and shortages of inputs for various industries have stoked inflation fears and pushed up the geopolitical risk premium in the oil markets. Heightened uncertainty precipitated by the ongoing conflict is weighing on the outlook. Safe haven flows have exerted depreciation pressure on currencies of major economies as the US dollar strengthened, while commodity prices such as of metal and gold have moderated. Financial markets have become more volatile. Equities registered a broad-based correction. Sovereign bond yields, already elevated due to long-run fiscal sustainability concerns, driven by inflation fears, have hardened across major economies. I now come to the decision of the Monetary Policy Committee. The Monetary Policy Committee met on 6th, 7th, and briefly today in the morning of April to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged under the liquidity facility at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance. I shall now briefly state the rationale for these decisions of the MPC. The MPC noted that since the last policy meeting, geopolitical uncertainties have heightened significantly. Headline inflation remains contained and below the target. However, upside risks to the inflation outlook driven by increased energy prices, pressures, and probable weather disturbances affecting food prices have increased. Core inflation pressures remain muted, although supply chain dislocations and the risk of second-round effects render the future inflation trajectory uncertain. The MPC further noted that high-frequency indicators till February of this year suggest the continuation of strong momentum in economic activity. Growth impulses continue to be supported by robust private consumption and investment demand. However, the West Asia conflict is likely to impede this growth. Higher input costs associated with increase in energy prices and international freight and insurance costs, along with supply chain disruptions that could constrain availability of key inputs for downstream sectors, would impair growth. The government has taken several measures targeted at supporting exports and protecting supply chains. This should mitigate the adverse impact of the conflict. The MPC opined that the intensity and the duration of the conflict, as well as the resultant damage to the energy and other infrastructure, add risk to the inflation and growth outlooks. However, the fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook. Accordingly, the MPC voted to keep the policy repo rate unchanged, even as it remains vigilant, closely monitoring incoming information and assessing the balance of risks. The MPC also decided to continue with the neutral stance, retaining the flexibility to respond judiciously to incoming information. Before I provide an assessment of growth and inflation now, let me briefly elucidate on the channels of transmission through which the Indian economy may get impacted by the ongoing conflict. First and foremost, elevated crude oil prices could increase imported inflation and widen the current account deficit. Second, disruptions in energy markets, fertilizers, and other commodities may adversely impact industry, agriculture, and services, reducing domestic output. Third, heightened uncertainty, increased risk aversion, and safe haven demand could impact domestic liquidity conditions, economic activity, consumption, and investment. Fourth, weaker global growth prospects may dampen external demand and reduce remittance flows. Finally, adverse spillovers from global financial markets could tighten domestic financial conditions and raise the cost of borrowing, some of which we have already witnessed. Overall, the initial supply shock can potentially transform into a demand shock over the medium term if the restoration of supply chains is delayed. I now come to the assessment of growth. As per the new GDP series, real GDP growth for last year is estimated at 7.6%. This corroborates the underlying strong momentum in economic activity supported by robust consumption and investment amidst supportive policy measures, ongoing structural reforms, and favorable financial conditions. Going forward, elevated energy and other commodity prices, as also shocks to availability of inputs due to disruptions in the Strait of Hormuz, are likely to impact growth this year. The government has, however, been proactive in ensuring supply of inputs across critical sectors to minimize the impact of supply chain disruptions. On the other hand, sustained momentum in services sector, persisting impact of GST rationalization, which was carried out last year, and the healthy balance sheets of financial institutions and corporates should continue to support economic activity. The agricultural sector's prospects are supported by healthy reservoir levels. Business expectations remain optimistic, and leading indicators point towards continued resilience in manufacturing and services sectors. Moreover, the government's focus on scaling up domestic manufacturing in several strategic and frontier sectors augurs well for India's ensuing growth trajectory. On the demand side, private consumption this year is expected to be supported by discretionary spending. Rural demand remains robust. It should gain further traction on the back of favorable agricultural conditions and a healthy labor market. Urban consumption is likely to strengthen further, aided by the beneficial impact of GST rationalization and the buoyant services activity. While the government's thrust on infrastructure spending continues, the revival in private sector investment is expected to sustain on the back of high capacity utilization, strong credit growth, and benign financial conditions. On the external front, merchandise exports could be adversely impacted from disruptions to key shipping routes, the concomitant rise in freight and insurance costs, and lower global demand on account of the conflict. However, merchandise exports may benefit from the recent trade agreements, many of which were signed last year, and few of them are now in implementation, and others to become operational hopefully this year, while services exports are expected to remain resilient. Taking all these factors into consideration, real GDP growth for this year is projected at 6.9%, with Q1 at 6.8, Q2 at 6.7, Q3 at 7, and Q4 at 7.2%. Further escalation and wider spread of the conflict, as of now, of course, we have a ceasefire, heightened volatility in global financial markets and weather-related events, however, weigh on the domestic growth outlook. Risks to the baseline projections are tilted to the downside, with uncertainty remaining elevated due to the ongoing West Asia conflict. Coming to inflation, in January, February, headline inflation continued to remain below target. It was 2.7% and 3.2% respectively, with food group recording inflation. It was in deflation mode, as you are aware, in the previous 4 months up to December. Inflation in fuel terms was modest, core inflation at 3.7%, and the underlying price pressures benign, as evident from the much lower core inflation if you exclude precious metals. Turning to the inflation outlook, recent spikes in energy prices due to the conflict have emerged as a risk. Although retail prices of petrol and diesel have remained unchanged so far, the pass-through of higher global energy prices has resulted in some price increases in a few other fuel items. Food price outlook remains comfortable in the near term, with a robust Rabi production that we had, adequate reservoir levels which would help agricultural activity, and comfortable buffer stocks of food grains. The likely emergence of El Nino conditions could pose a risk. Considering all these factors, CPI inflation this year is projected at 4.6%, with Q1 at 4, Q2 at 4.4, Q3 at 5.2, and then going down in Q4 to 4.7%. Core projection is projected at 4.4%. We are doing this for the first time, as has been the demand from some quarters. And going forward, we shall continue giving our projections for core inflation too. Excluding precious metals, core inflation is even lower, indicating that underlying inflation pressures are expected to remain contained. The risks are on the upside. I shall now speak about the external sector. Global trade is expected to witness a slowdown in growth during 2026 as compared to 2025. This is due to the lingering tariff-related uncertainties, despite the Supreme Court judgment, ongoing West Asia conflict, and elevated energy prices. India's merchandise exports contracted by 0.2% during the first 2 months of this year on a year-on-year basis. This was a result of export contraction in key markets. Merchandise imports, on the other hand, recorded a double-digit growth of more than 22%. This is largely driven by higher gold imports. As a result, there was a widening of the trade deficit. Expected robustness in services exports and inward remittance receipts during Q4 last year, however, should keep India's current account deficit moderate and within the sustainable level last year. Rising global uncertainties and elevated prices of key energy commodities pose some upside risks to India's current account deficit this year. The recent bilateral and regional trade agreements with major trading partners are expected to boost India's trade and investment opportunities, while at the same time, they will also widen and diversify India's trading partners and integrate India into global value chains. On the external financing front, gross FDI witnessed a strong growth, almost about 20%. Net FDI also showed improvement on a small base of last year. India remains an attractive destination for greenfield FDI projects. FPI to India, driven by outflows, primarily in the equity segment, recorded net outflows of $16.5 billion last year. And even this year, till we have data till April 6, there were outflows of more than $5 billion. Flows under ECB and non-resident deposits too moderated as compared to last year, last year. And as on April 3, for which we have data, latest data till April 3, India's foreign exchange reserves stood at a healthy $697.1 billion. These are adequate in terms of the standard metrics of reserve adequacy, whether one sees it from the perspective of import cover, we have about 11 months, as has been the case for some time, or whether one looks at it from the perspective of external debt. Overall, therefore, India's external sector indicators remain favorable. Nonetheless, elevated global geopolitical, trade, investment uncertainties require a continuous vigil of the evolving developments. Despite stronger macroeconomic fundamentals, the Indian rupee in the last financial year depreciated more than the average in the previous years. In this regard, let me reiterate, I've said it many times, our exchange rate policy remains unchanged. Specifically, intervention in the foreign exchange market is aimed at smoothing excessive and disruptive volatility without targeting any specific level or band of price for the exchange rate. This is consistent with our long-standing policy of exchange rates being market determined. And we in the RBI stand committed to this policy and would judiciously continue to contain excessive or disruptive volatility to ensure that self-fulfilling expectations do not exacerbate currency movements beyond what is warranted by fundamentals. I shall now be speaking on the liquidity and the financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average daily surplus of 2.3 lakh crore rupees since the last MPC meeting. The Walker since then has traded in the lower half of the corridor, except towards end March, which is an yearly phenomenon. Short-term money market rates, especially those of CPs and CDs, commercial paper and certificates of deposit, they remained elevated. GSEC yields remained largely range-bound with a softening bias in February. But thereafter, on account of the ongoing conflict, they hardened, as did the global yields, along with the rise in the energy prices. Transmission in the credit market has remained satisfactory. To ensure sufficient liquidity in the banking system, the Reserve Bank proactively undertook durable and transient liquidity measures. Going ahead, we will continue to be proactive and preemptive in liquidity management and ensure sufficient liquidity in the banking system to meet the productive requirements of the economy. As for the financial parameters of the banks and the NBFCs, let me inform all of you that the parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain healthy. Similarly, the system level parameters of NBFCs too are sound, with adequate capital and improved GNPA ratios. As per the latest available data, credit from all sources, not only bank but also non-bank and others, grew at 14.3% YOY. This is in comparison to the 11.7% growth that was witnessed a year ago. Bank credit growth too maintained its upward trajectory. You are aware it had gone down to about 9% in mid-2025. Moreover, it has remained broad-based. I shall now, as has been the practice, announce some measures related to some additional measures. They relate to ease of doing business, capital adequacy for banks, and market developments for one of the segments. I have three measures for promoting ease of doing business. First, to facilitate better utilization of bank board's time. This has been a request from the banks. We have done a comprehensive review of all our extant instructions, which are spread over various directions and regulations. And we propose to now revise and rationalize the matters which require attention of the board. Hopefully, this will result in the board being able to divert more time on policy matters, leaving operational matters to the management. Second, you would recall that we had recently in 2025 done a detailed exercise to consolidate over 9,000 regulatory instructions into 238 master directions. Now, a similar consolidated exercise has been completed for all our supervisory instructions, and we shall be issuing the consolidated instructions in this regard. Third, to facilitate ease of doing business by MSMEs, we propose to dispense with the requirement of due diligence while onboarding them on to various trades platforms. For capital adequacy of banks, there are two measures proposed. First, it is proposed to remove the condition regarding NPA provisioning for inclusion of quarterly profits in their CRAR computation. Second, in view of the developments in prudential framework over the years, it is proposed to dispense with the requirement which was laid down a few years ago to maintain an investment fluctuation reserve as an additional buffer to hedge against depreciation in the value of investments. For further development of the term money market, there is one measure, as I mentioned. We have decided to permit certain additional categories of non-bank entities in this market segment. You would be aware only banks and standalone primary dealers, or SPDs, are today eligible to participate in this market. We are also enhancing the borrowing limit of the standalone primary dealers in the term money market. To conclude, global economic conditions and sentiments have soured after the outbreak of the West Asia conflict. These have adversely impacted the growth inflation outlook. As reiterated before, we shall remain vigilant of the evolving situation and put in place policies that prioritize the best interest of the economy. Thank you, Namaskar, and Jai Hind.
Well, I think you will have to read the policy as neutral to dovish compared to what the market expectations, and that perhaps should show some kind of positivity in the bond yields. Otherwise, the important parts are more in the nature of the non-policy announcements. In the policy announcements, I think there is a marginal reduction in the growth to 6.9. Now, that should have some repercussions on credit growth and other things that impact the financial sector. So note that the government, the RBI also is accepting that growth is going to be somewhat lower and inflation higher. So overall for the year, 6.9%, and earlier for Q1 and Q2 they had 6.9 and 7. Now both of them have come down by about 20-30 basis points. The current quarter, which was originally 6.9, is now 6.8. Next quarter, which was originally 7, is now 6.7. So a good 30 basis points lower forecast for the first half, 20 to 30 basis points. Inflation is distinctly higher compared to previous forecasts, and at 4.6% for the full year and 5.2 for third quarter. One should not expect any dovishness in terms of policy, but if the highest is 5.2, then chances of a rate hike in the current year look a little unlikely. I thought his statements on liquidity sounded more benign, and he was not averse to keeping the Walker, the weighted average call rate, below the repo rate. If that continues, that will be very positive for rate transmission, and perhaps slightly negative for entities like mutual funds who were making a cool money in the repo in the tripartite market. Now they won't be able to make that much. The gains are fewer. And finally, the non-policy announcements are important because it looks like there will be lesser costs on banks. We have to look at it closely. Some of the counter-cyclical provisions have gone away, which will distinctly mean lower cost for banks, and therefore we may be able to see some upgradation of EPS, but let me get it from the bankers themselves. I think we have our team of experts with us. Mr. Ashwini Tiwari, the Managing Director of State Bank of India, with us. Economists Upasana and Kaushik are also with us. I will get to the other guests, but first to Mr. Tiwari. Sir, first thoughts, growth has been brought down. Do you expect that credit growth will also have to be lowered for the banking sector?
Thank you, Lata. The credit growth, of course, is a function of the growth in the economy. So far, the growth has been very good, and the 14.2 number the governor gave out is higher than many previous years. So our sense is that while there could be some impact, but so far we haven't seen any reduction in the demand from either MSMEs or retail, or for that matter even corporates. Demand continues to be steady. So we'll wait and watch as to how this credit growth is impacted, if any, because of the GDP growth reduction. The other thing to consider is that after a lot of uncertainty, there is some final announcement of the ceasefire. So hopefully, if this sustains, then that uncertainty of the geopolitical situation will go away. And this was a major factor in all the other difficulties we've had. So if that goes away, my sense is that we may not have a very sharp reduction in the growth and therefore the credit growth.
Okay. Yeah, I agree with you, sir. Also, because inflation is higher, perhaps more working capital requirements will also be there. And therefore, perhaps credit growth will not fall. Could you get exactly what he said about the counter-cyclical buffers that you all had to keep, the investment fluctuation reserve, which you can go, and even some NPA provisioning, which appeared to have been reduced? I didn't get that sentence correctly, but are you noticing, some relief on reserves and some relief on provisioning? Will that mean some addition to the bottom line? Could you catch what he said?
The first part, which is the NPA provisioning, I also could not catch, but the investment fluctuation reserve, that is a counter-cyclical buffer, which has been now allowed to be taken out. I think that will provide us some relief. My sense is that more than the current situation, all of these steps actually move towards the ultimate ECL framework, which will come in later on. So therefore, these are also part of the game. And of course, it helps today that if the banks come under some pressure, especially with the high yield movement in the last few days of the previous financial year, a lot of banks had to face a mark-to-market issue. And therefore, to some extent, that this IFR relaxation will also help. But to me, it's also part of the longer-term vision which the RBI had in terms of moving towards the Basel-compliant framework.
Okay, actually, you took away my third question. I was going to ask you, there is no relief actually given on that MTM losses that will have to be borne. Is that likely to be a large number for your own bank?
So we haven't asked the RBI for any such relief because we believe that if it has to be spread over, I mean, last time when it was given in 2018, the relief was that this was spread over 4 quarters. But it has to still be taken in this year itself. So therefore, we haven't asked any such relief. I believe some banks may have done so, but I'm not briefed on that matter.
No, you have to take it in FY26, no? Because the mark-to-market loss, the moves came on March 28, and on March 30th, we did see that on 31st, you would have to take that mark-to-market loss. Will that be high for FY26 is what I'm asking.
While I can't give out numbers,
Any
clearly
number
there
that
is,
you can help?
I can give out numbers here in the silent period, but clearly there will be an impact of that. If not loss, then you can take it that there is no additional profit which we may have got because of the benign conditions earlier. So therefore, what I'm just saying is that in case there is any impact of this, we have not asked for this to be spread over a period, unlike earlier dispensation. Whatever it is, we will take it in the profit and loss for this year itself, which is ending March 26.
Okay. 26. Okay. As I understood it, he said liquidity will be kept plentiful. The word he used is adequate. So, what is your sense about margins? If the liquidity tap in the interbank market is loose, will that have any impact on deposits at all? How do you see margins for the current quarter and the quarter gone by? More importantly, the current quarter, April, May, June?
So the liquidity position in general tightens towards the end of the year because of obvious reasons like tax payments and various other expenses. The RBI has been proactive in terms of providing liquidity to the overall market. But as we have seen, the deposit rates had hardened in the last quarter. They have not come down even now. Banks are raising CDs and CPs at a higher cost. There is some moderation in the last 1 or 2 days, and we have to see how that sustains. Hopefully, after yesterday night's announcement and today's situation of the markets, maybe we'll have a slight moderation of the rates overall. But otherwise, the deposit rates had not moderated so far. And therefore, what we see is that the margins could be range bound. If the deposit rates come down and on the back of CPs and other market instruments, then maybe we'll see some improvement in the margins. But so far, the margins, no change as such.
Okay. Thank you very much, Mr. Tiwari, for being with us. If you can stay on for a bit, Ritu may have a couple of questions. Importantly, today the yields have come down substantially, 6.95 on the 10-year even before the governor started, and now a tad lower. So I would assume a concomitant impact on CDs as well, which are a cost for banks. Let me just quickly get to the economists. Kaushik, are you changing any forecast after listening to what the governor said in terms of your growth or your inflation? What were your takeaways?
Lata, we had a growth forecast of 6.7 and governor, I think, has given 6.9. So given this band of uncertainty, I think both of, all these forecasts are indicating that from 7.5 of last year, we are going to go down, 50, 60 basis points, assuming that this ceasefire holds. And he highlighted downside risks to growth. Whereas on inflation, he talked about 4.6%, with upside risks. And we need to kind of figure out, it's impossible to know right now in May whether the government will hike petrol or diesel prices or not, depending on where those Brent prices are at that point of time, how these 2 weeks play out. So if you see RBI's inflation forecast, if I'm not mistaken, for April, June, it's kept at 4%. Which kind of indicates that they're not factoring in any fuel price hike in that May-June period. And the second quarter also, July-September, they've just increased it to 4.4 from 4.2. So there are upside risk if fuel prices go up, domestic pump prices. That will depend on where oil prices settle. But the question that you asked in the beginning or the statement that you made, you feel like it's a neutral to dovish. I also feel the same because this is for the first time, if you've observed that they've given a core inflation forecast, and that core inflation forecast is lower than the headline 4.4. And governor also mentioned that if you take out precious metals, then the core inflation excluding precious metals is much lower, which kind of signals, to us as market participants that what RBI is trying to tell us is that underlying inflation momentum is not as much as what is reflected by the headline number, which is mainly a supply side factor, whether it is fuel or if it can be food. So underlying assumption in my head is that RBI is telling us that there's no immediate need for any rate hikes, or at least in this year, if this inflation trajectory holds and growth, if it is below potential of 7.5% at 6.9, 6.8, then RBI can wait on the sidelines to see how things evolve before taking a decision at a later point of time.
Okay, Mr. Tiwari, since we have little time left with you, very quickly, if you had any further clarity on the provisioning relief or, the capital front, if you've been able to calculate what kind of a relief it'll give to an SBI. And secondly, very quickly, also on rates, is the deposit repricing complete? It looks like with the current forecast, we're in for a longish pause from RBI. So what do you expect from here on?
So in terms of the impact on SBI, I'm sorry, I have not been able to calculate. It's just been about a couple of minutes, and we will do that during the day today. But in terms of the deposit rates, as I explained in my earlier response, the deposit rates had not come down so far. They were, in fact, hardened in the last quarter, and especially the bulk rates had gone up significantly. My hope is that with with the geopolitical situation changing a little, it has to still stabilize. There might be some moderation, and as Lata explained, there was already a reduction in the rates, market rates so far. There could be some moderation in the deposit rates, but we have to wait and see. Because of the high credit demand in the last quarter, the deposit rates had hardened. We will see in this quarter what happens. The credit demand continues to be strong.
Okay, Mr. Tiwari, I guess we'll touch base again once we have more clarity on what exactly the relief for banks may be. But Upasana, very quickly, how realistic were the macro forecasts for you? We've got a number of 6.9% on the GDP and about, on the CPI as well. Is it in line with what you were estimating?
Yeah, we were at inflation, rather, I would say, is at 4.7% as per our expectations. Okay. So I would say it's broadly in line with what RBI has said. But having said that, I think that particularly the Q1 numbers are looking a little lower. As Kaushik said, probably there is no assumption of any pass-through at all, which I believe has an upside clearly. So that's why probably there's a 10, 15 basis of an upside to our projections. Besides that, on the growth front, we are at 6.5%. Having said anything, even though there is de-escalation at this point in time, there's a whole lot of uncertainty as to how all of our supply side disruptions are going to play out over a period of time. And unless we don't get stability on that front, I see a reasonable downside risk to RBI's GDP forecast. And that is clearly reflected in the governor's speech today, wherein there was much more highlight on the downside, medium-term downside risk to growth. And that was providing a little bit of tilt to the dovishness that Kaushik was also referring to. So I guess there is a neutral to dovish, guidance in a way, along with the fact that core inflation has been highlighted as being benign, core measures, core inflation measures, all of that. So I guess taken together, there is downside risk to GDP growth as per our expectations, and the fact that overall inflation will not be overshooting significantly, even though we do believe that there's upside risk to these numbers. Clearly, RBI has suggested that there will be a pause on the rates front for now. And the very fact that they've talked about liquidity being proactively maintained ample, I think that itself speaks volume of the side that they want to direct the market.
Okay. I quickly wanted to highlight for the viewers the monetary policy report, which the RBI releases twice a year. That has been released, the first one for this financial year, and the baseline assumption for crude oil prices, according to this RBI report, has been taken at $85 per barrel for FY27 and about $75 per barrel for FY28. We're just awaiting more details on what the assumptions further are. But Kaushik, quickly, you want to come in on these numbers, $85 a barrel assumption for FY27?
Yeah, so obviously this builds in expectations of de-escalation, and oil price already is at 95 from 110 yesterday, could go down, and the average, we have just started the financial year, so very well we could be at 85 or 90, provided things kind of remain under control over the next few months. You never know about these things. If you see, after the Russia-Ukraine war in FY23, oil prices, the Brent prices averaged around 95. Currently, we are saying that it will be around 85, which is still much higher than the 65, 70 that we expected for FY27 before the war. And that is why you would expect some bit of slowdown in growth. And as it's not just the oil price that we are talking about, it's also about supply of gas, whether there will be some supply chain disruptions, all those things, and also the monsoon factor. We are hearing that there could be El Nino this year. There's a 62% probability. Does it hit the agricultural sector? If it happens, what happens to inflation, growth dynamics? So lots of moving parts, but at 85, I think it builds in de-escalation, which has come today. It couldn't have come at a better time. But we need to wait and see where prices settle. And then the question is, how do you share the burden? Government has already cut the excise duty on petroleum products. Do they need to hike price if the OMCs are still suffering losses? Or if oil prices come down further, will the excise duties again be reversed back to some extent? So depending on that, the growth, inflation, and the fiscal mix will also determine the revenue loss and the calculation on fiscal. As of now, it looks like the fiscal deficit target should be met. If you have an $85 oil average for the year, then fiscal deficit with the Economic Stabilization Fund, I think we should still be able to meet that on the 4.3% target. On inflation, there could be some upside risk if there is food related uncertainty, and if there is a hike of petrol or diesel or gas in the coming months compared to the 4.6 that RBI has given, particularly in that April-June quarter and July-September quarter, the first half. And on growth, there could be some downside depending on, if the prices are increased, then private consumption could take a hit because of higher oil prices. But this all depends on where oil prices settle over the next few weeks or months.
Thanks for that, Kaushik. I think importantly, the tax collections of the government can also fall, considering that there would be a hit on EBITDA margins in at least the first quarter. So perhaps we have to count our fiscal numbers a little later. At the moment, there are simply too many uncertainties. We are only 7 days into the fiscal year. A little tough to gauge. Things can be uncertain, but 85 looks reasonable. Since this is an average assumption from now to next March 31, perhaps 85 cannot be considered a very optimistic assumption, going by where things stand in the last 10 hours. But we need to know how the bond markets are reacted. They are the guys who were pricing in as many hikes as they wanted. So let me invite Amit Tripathi from the fixed income head at Nippon and Anil Bamboli of HDFC AMC. Amit, to you first, what is the sense you're getting now? What is the 10-year yield range you are looking at?
So even prior to the war, the market was seeing strains both from the twin deficit issues as well as the capital flow issue. In this scenario where there is some thawing in the war and RBI has been on a wait and watch, cautious but not in any sense panicking, which is the right thing to do, one would assume that the bond yields would come and settle down in and around the levels where they were pre the war scenario, which was more in the 675, 665 kind of a range as far as the 10-year bonds are concerned. As far as the shorter end is concerned, as that part was also raised earlier, and the tightness that we had seen and higher supply from banks, seasonally we are getting into a better place right now in the first half. And as the RBI is on wait and watch mode and one does not expect any reaction too soon from here on, one would expect some softening in rates, at least at the shorter end as far as corporate bonds are concerned.
No, I didn't get you. What are you expecting the 10-year range to be, therefore?
So this was the 665, 675 range prior to February 27th. And I think that is where the markets will most likely would want to settle down till the time it gets further clarity.
Okay. What about you, Anil? Are you expecting another 20 basis point fall in the yields? Before the governor started speaking, it was 695. And crude is still $90 plus. So what's your estimate of the 10-year yield?
So I broadly agree with what Amit was saying. I think markets had priced in a lot of negatives. They have corrected some bit of it. But if things continue and the ceasefire finally culminates into an end of war or the conflict that is going on, definitely we can go back to the pre-war levels, which Amit is mentioning.
Okay, and that would be what, 6.65 or 6.75? Because we are not going to pre-war crude levels of 67 or thereabouts. Crude prices are still expected to be 85, as the MPR is indicating. In spite of it, you think that status quo ante can happen, 6.65?
Yeah, because see, last year we had a demand-supply mismatch which was there, which caused a lot of the sell-off that had happened. Things will be much better this year from demand-supply point of view. And if you have no rate hikes, or even if you have, say, 25 basis or 50 basis point rate hike towards the end, you will be still at around 575. And if you take 100 basis point spread over that, you can still end up being, 675. So I think that band around 675 looks to be a very reasonable estimate.
Okay, fair enough. Last year, of course, you got a lot of help from the Reserve Bank buying 8-9 trillion rupees worth of bonds. I wonder how much they're going to do this year in terms of their own purchases, especially if their intervention in the FX market is likely to fall. But of course, we will have to see how the rupee behaves. And that is the question now to the economists. Upasana, what is the forecast now on the currency? You think the worst is over, 95, and we don't go worse than that?
Lata, this is a tough question, I think. While for now, today, if you're asking, we are all looking very comfortable. We are hoping that, the 2-week truce is going to culminate into a calmer period after that. So if that was to be true, then already RBI circular, along with that, we have now the de-escalation. That is suggesting that at least there'll be sanity in the market for a while. But having said that, if there is volatility going ahead, then we need to remember that current account deficit at $85, as against a $65 pre-war period. that $20 change is anyways going to cause a much higher demand for dollars. The current account deficit will be more closer to $90 billion, which is around 2% of GDP, 2.2%. So there will be a balance of payment stress, which will continue. And that is the fundamental driver of rupee. So I think we will continue to move higher on dollar rupee. It's just that probably now the pace has been arrested with which we are going to move.
Okay. You wanted your jab at it, Kaushik, currency?
So currency always kind of exaggerates during time of stress, the fundamentals compared to where rupee was a few days back. So we have seen it come down from 95 to 92.5, those kind of levels. Now, the thing is that going forward, we have to also take a call whether FI equity inflows will come back to India with the valuations having become more normalized, with this ceasefire being there. And also remember, last year, we had a very low nominal GDP growth below 9%. So this year, if you are getting close to 7% growth, and if you add inflation, which is going to be much higher than last year, your nominal GDP growth should be improving over last year. And based on nominal GDP growth, earnings estimates, if earnings have been cut too much, if people start now, changing all that based on the ceasefire, if I see that there is value to bring money into the markets, then capital flows from the equity side, if it improves, that can help rupee to appreciate from current levels. But the question is at what level RBI starts buying dollars, because the reserves that they have kind of used to stop rupee from depreciating, they would need to again get some reserves back. So there will be a natural tendency for RBI to buy as well if the flows come back. So rupee at this moment looks well supported. All the measures that have been announced, I don't think there is any immediate measure required. And if oil gradually comes down, that could reduce the fear about current account deficit getting bloated too much, although it will be higher than last year. And if the capital flow side improves from what we thought a few weeks back, then on the margin, it's all about increment from where we were. I think rupee could get supported at these levels. And then it will be a narrow band in which rupee would move, and people will take comfort from that, investors, that the worst is behind us, and then they will be encouraged to bring in more money into India, which then is a virtuous cycle of seeing more appreciation and probably then RBI coming and buying dollars at some point of time.
Okay. Ritu, any more observations?
Well, yes, a couple of updates, from the RBI's monetary policy report. One is, of course, the baseline assumption of crude, as we highlighted, is $85 a barrel. There is a severe scenario where crude is also assumed at $95 a barrel, and then a stress test is done. The exchange rate assumption, and this is the baseline assumption in the MPR to make the forecast that they've done, is at about $94, 94 rupees to a dollar. So, a little higher than the rates we're currently seeing. That's what RBI is pegging it at. Of course, this is just an assumption based on statistical models. It is by no means a forecast, but it is an important number nonetheless to, take note on. Apart from that, a couple more highlights in terms of the capital support measures that the RBI had highlighted. There are two of them. First is to remove the condition regarding NPA provisioning for inclusion of quarterly profits in the capital adequacy, computation. That is one. And second, of course, as we've been highlighting, is removing the investment fluctuation reserve. So we still have to stand by to hear more from banks on how much additional, relief does this really provide. But quickly, Kaushik, if you'd like to come in on some of these additional assumptions that we've seen from RBI in the MPR, including on the exchange rate. And I think the growth forecast as well for the coming year, 6.6% is what FY28 numbers are indicating as per their statistical models. Again, not a forecast. This is just what the models are suggesting. 6.6% for FY28, and of course the number we've already got for FY27. Kaushik.
These are very realistic numbers. What basically RBI, so for the exchange rate, as you know, RBI typically takes whatever the spot levels were during writing that MPR report. So if it was closer to 94 at that point of time, they would have taken that. That doesn't mean that that will be the forecast per se. And based on that kind of reference point, then they do their balance of risks on inflation, current account, 30 basis points upside or downside. So I think that's a very realistic estimate to take for 94 for rupee. Even after it stabilizes, as I told you, RBI may need to buy dollars, so you could see rupee coming back at those levels. So that's okay. On the growth front, I guess RBI has already highlighted that there could be downside risks, and nobody knows whether this, after 2 weeks of ceasefire decision, whether things will again, after a month, again, things will erupt or something else will happen, whether the availability of gas supply will normalize very soon, or we'll see shortage and supply chain disruption. So there would be definitely a hit on growth to some extent. And private consumption is the biggest worry because we are close to 60% of GDP on private consumption. Remember that it was not a few months back, 6 months back, we had the GST rationalization to support growth. So it was not like growth was doing that great. But because of the tariff decisions that we have had in the US, maybe things will improve. So in that sense, 6.5% to 7% range is a very realistic estimate compared to 7.5%, which would have been probably without if the war did not happen.
And this again, just to reiterate, is at $85 a barrel oil. If we get to 95 or higher in an adverse scenario, RBI even estimates that this year's forecast, FY27, could come down to 6.7% and for FY28 to 6.4% if the adverse scenario plays out and crude is above the estimates that RBI has currently made. Going forward, Upasana, now, putting together all of this just to conclude where the inflation forecast is at, where the growth numbers are at, are we in for an extended pause for the time being?
It appears like that. I would say, we are too going with the assumption that crude oil prices will be averaging at 85. And our assumption on dollar rupee is also 93.75, so broadly 94 as per RBI's MPR. So, we believe that these assumptions that RBI has talked about are broadly realistic. And now, given that going ahead, the downside risk is what RBI has given to its 6.9% GDP. If that starts materializing much more, the window to stay on pause remains there for much longer. So I guess just until yesterday, markets were fearing a rate hike as early as today. But now I guess RBI has tilted the direction towards a prolonged pause for now. And the very fact, again, I'll reiterate that they have said again that they will keep liquidity ample. That is very important to keep in mind because the first leg, even before rate hikes, should have been tightening on the liquidity front. And that is also nowhere in the sight. So I guess, yes, that's how we should look at it for going ahead over the next few months.
Okay. Well, I think the governor's statements seem to indicate that they are going to keep liquidity ample. Amit, if I can come to you, immediately, you all are not expecting the reinstatement of VRRR, are you? From what the governor said?
But I think the RBI has been very clear in the past few months, in spite of all the macro and flow volatility that we saw, that they want to keep the markets well funded to support the credit growth that was at an incipient level and still is at incipient levels. So I guess we would think that the RBI would continue to provide markets with slightly more than adequate liquidity, at least seasonally speaking, for the next 3 to 6 months. And that is the reason why we also feel that given the RBI stance today and given the relative patience that we may see over the next 3 to 6 months, the short end of the yield curve, where the yields are elevated, both because of supply as well as because of the volatility flow that we saw, have a probability of softening up a bit from where they are right now.
Okay, gentlemen and Upasana, thank you very much indeed for your time. I don't know if Mr. Tiwari is still there, but our thanks to him as well. The market has given its verdict. Already before the governor started his speech, we saw the yields fall all the way from 7.03 overnight to 6.95 because of the 14% fall in crude prices. After the speech, the 10-year bond yield has fallen to 6.91 or thereabout 6.9. So clearly the market has given the verdict that they see the speech as dovish, clearly not indicating any hurry to increase rates, showing adequate concern on growth. He repeatedly said that there will be shortages and higher fuel prices. So clearly that concern on growth is seen as a dovish Reserve Bank. There was also this adequate promise about liquidity, which gives the impression that the weighted average call rate, the one-day money, is not going to touch the repo rate just yet, except for periods of tax payments. So we have to read this as a dovish policy. That's the verdict of the market. And it looks like if you took a poll now, the chances of a rate hike in 2026 are clearly ruled out. Even otherwise, Ritu's poll had very few people saying yes to a rate hike. And likewise, the Citizens MPC of CNBC TV 18. So we can work with a lower for longer kind of policy, at least for now. And with some hit to growth. That is the key takeaway from the Reserve Bank Governor. From Ritu and me, thank you very much for joining us in our monetary policy coverage. We will touch base with you yet again at 12 o'clock when the Governor addresses the media.
Well, over 6 weeks after we saw some, uncertainty, war, and a lot of fear in the market, all those fears have now been dissipated. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, as always, Hormaz Fatakia and Ritu Singh. What a day it's been. All the fear, uncertainty, and bearishness was bottled up, and now it looks like someone just popped the can, and the markets got 900 points on the Nifty to show for, nearly 3,000 points on the Nifty Bank and the Sensex. Broader markets doing extremely well. It suddenly feels like the day the exams have ended and everyone's suddenly free. Isn't that?
Well, it's a 2-week pause, and let's hope it extends even longer. Let's hope this is, the end of the escalation of tensions in the Middle East. And you're seeing the market reaction. 18 stocks advancing almost for every one stock that is declining. So it's a good day. Oil prices are down all the way to 94. And we just heard from the RBI governor as well. No signs of hawkishness at all. And I think that is something the markets are going to take with both hands. Bond yields also coming down on the back of that. The rupee also recovering. Hormaz.
They could not have come at a better time. It's just 2 days away from the start of the earnings season, and that is also the big talking point that's going to be for the market going forward as well. Let's continue this conversation with Shreyas Devalkar of Axis Mutual Fund, who is joining in on the show. Also joining in is Anil Gupta of ICRA. Gentlemen, good morning. Thank you for joining in. Shreyas, to you first. Now, with this hope of a de-escalation and this hope that the next 2 weeks will bring about some concrete steps towards ending this hostilities over the last 6 weeks. Now, do you believe that the opportune time for deployment of funds in the market was back when the markets were at extreme panic, or do you still believe that this is still a good time to deploy if you have a longer term time horizon?
Good morning, and thank you for having me on the show. Actually, as we always say, every time is the right time. However, obviously, 5 to 10% lower could have been better than the 5 to 10% higher. So the way we stand today is from the day this war started, the markets, at least Nifty is down 5%. At a point in time, it was down 10%. So definitely that point in time would have been much better. But obviously, the clarity on the outlook, it brings in obviously the higher prices and higher valuation to that extent. But if you look at it overall from the market point of view and overall market point of view, even at these prices, it's not that the 5% move is too big a move from the bottom, what has happened as far as the headline index is concerned. If you look at multiple segments of the market, especially in the large cap, the valuation are reasonable. You take financial services, IT, there are real estate companies in the large caps. There are multiple sectors, including the consumer durables also, which failed a lot during this time. So multiple sectors have seen a lot of correction, including auto, no doubt on that. So because of this concern, so the combination of concern on the traditional businesses like IT, where the AI has been concerned, and the concern which was also driven by the crude underlying because of the war situation. And this combination has led to the reasonable valuation across the board, which generally don't happen many times. Only few pockets got elevated during this point in time, but otherwise the valuations are reasonable across the board.
Sure. Shreya, do hold on. We also have Anil Gupta of ICRA who's joining us on the show. In a short while, we'll also have Lata with us. But Anil, first on these 2 capital adequacy measures from the RBI, if you could explain to our viewers what it means. One, to remove the condition regarding NPA provision inclusion in quarterly profits for capital adequacy computation. That is one. The second is the removal of the investment fluctuation reserve. How much incremental buffer, how much relief does this give to banks?
Yeah, hi, good morning. Thank you for having me on the show. The quarterly profit inclusion of the banks, let's say when we look at the quarterly profit reporting in maybe the statutory reporting which we see on the exchanges, generally those capital ratios do not include the quarterly profits, and hence when we see the full year audited numbers, especially for the PSU banks, there is a sharp jump in terms of reported capital ratios because the full year number is an audited number and audited profits can be included. So what we will now see is maybe between let's say Q4 of a financial year, let's say we end in March 2026, till March 2027, there will be a decline in the capital ratio because of the consumption and not inclusion of the profits. for the quarter. Now what we will see is possibly a improved capital ratio, not a steep jump between December to March reporting in terms of capital ratio. So that is basically the change which is related to the NPA provisioning, because let's say if your NPA provisioning, there is a lot of volatility. What happens is RBI says don't include your interim profits in your capital ratios. But now you can include your quarterly profits into your capital reporting. On the second change, which is talking about the doing away with the investment fluctuation reserve. So this investment fluctuation reserve was introduced somewhere, I think in 2018, and banks were required to build investment fluctuation reserve through their P&L account at around maybe 2% of the AFS books. Now, this 2% was created over a period of maybe 2 to 3 years when the bond yields were favorable, and this was included in the tier 2 capital of the banks. Now, subsequent to the changes in the investment guidelines in April 2024, RBI allowed a creation of AFS reserve, where basically your unrealized gains could be included in the AFS reserve, which boosted the capital of the banks. And this was included in your CET1, core capital ratio. Now, because of these recent bond yield rise, the core capital ratio will get adversely impacted because the AFS reserve is likely to go down. So now what happens is the IFR, which is investment fluctuation reserve, which is no longer required, can be included in your tier 1 capital. So what we will net basis, what we will see is that the tier 2 capital ratio will possibly go down. Overall CRAR will go down, but the CET will get a boost. The core equity capital ratio will get a boost because of inclusion of the IFR reserve, which the banks are carrying.
Got it. Okay, let me also quickly invite Lata Venkatesh, who's joining us now from RBI. Lata, you had a question for Anil as well.
No, not question. I got answers from the banks, and that's what I'm going to share with you. What the bankers said is that they were not allowed to include their quarterly profits in their capital, as Anil said, because what if next quarter your NPAs go up? Then you will need more for provisioning. So they were allowed to do it only at the end of the year, especially if there was a wide fluctuation in their NPA. Now, even if the NPA fluctuates, they are going to be allowed to include their profit. So it's a capital gain. Likewise, the inflation fluctuation reserve going away also improves your tier 1 capital. But this banker told me that that doesn't mean anything immediately, because almost all banks are sitting at very healthy capital adequacy. It's not as if you're sitting at a capital adequacy of 12 or 13%, and because you don't have enough capital, you're not able to give loans. It's not like that. They're all sitting at 15, 16% capital adequacy. And, you know, if that 16 goes to 16.2, it's not as if they're going to give more loans. And hence, any immediate impact on the P&L because of a higher loan growth is not on the cards. It is just a comfort zone that I am not rushing to raise capital anytime soon. There is a little bit of 20 basis, 30 basis of extra capital that has been released for banks because of these two provisions. A third point which we have, which we perhaps did not make much of, the NBFCs now can participate in the money market. So the call rate market, which until now was only a few banks, and therefore the volume was much lower than the tripartite repo market or the CBLO market, now you can have non-banks participating. This could be an advantage to the NBFCs, because for a day, if they want liquidity, that liquidity is also available from the call market, which could be a bit of an advantage. What the NBFCs really want is that we should be allowed to access the repo window. That is not said over here. We of course have to wait for the instruction, because what we have is only the governor's speech. But if they are allowed to access repo, then NBFC stocks will go through the roof. That is not on the cards. They have been only allowed to participate in the call market, and that means a little more money for them, a little more intraday flexibility. I thought I should put that on the table. Anil, you want to add on this?
No, I think you correctly said that the volumes in the TREPS markets were multifold compared to the term money market. And I think wider participation will not only improve the rates at which the money was available in term money market, but also maybe improve the liquidity of the participants because the rates are definitely better in the term money market than the overnight market.
The financials doing extremely well, but just to put things into perspective, ever since the war started, that period, the Nifty was down almost 12.5%, and the Nifty Bank was down 17.5%. So it was a bigger underperformer, and now it's unwinding, and it is becoming a bigger outperformer. Amidst all of this, will be very interesting to see how the IT stocks are panning out, because the IT index is underperforming today. Remember when the war started? From then to now, the IT index was absolutely flat, even as we saw the Nifty fall about 12% and the Nifty Bank down about 17%. Thank you, Anil, for joining in. Let's go back to Shreyas. Shreyas, how does your portfolio stance move from here? I mean, obviously, the war period was that of uncertainty and capital protection was sought. Now, do you think you will shift focus back to taking some aggressive bets that you were holding on to while this uncertainty was on? Or maybe your approach continues the way it was, whether or not there was any sort of geopolitical development?
Obviously, yes, we were taking some aggressive bets, especially in Jan, Feb, March, in the sectors, in auto, especially in the CV space, and probably with this development, there were question marks around this. I would not say that yes, everything goes back to normal, because certain things one need to keep in mind that where the crude settles eventually, and how it overall impacts. Because end of the day, if this supply constraint led inflation that remains for some time, then there is going to be some impact on demand as well as margin. So if you see even this quarterly results season and the previews which have started coming in, there was only few maybe weeks of impact on some of the companies. But yes, there has been impact of this. So unless we say that yes, things go back to normalcy, crude traces back to $70, then definitely we will be more aggressive on those bets. However, having said that, because of these developments, I would not have changed much the stance, because anyway it was expected that this is going to be transitory. Whether it is 1 month or 3 months, that was the always debate. Even today, we cannot call out that yes, it is back to 70s, it is still 95.
All right, Shreyas, Anil, thank you so much for sparing time and joining us today with your views on the markets. And of course, a lot of these policy announcements made by the Reserve Bank of India. 24,000 back on the index for the first time after the 10th of March. So almost a 900-point gain now on the Nifty, back above the mark of 24,000. And that is, of course, led by the Nifty Bank. Take a short break. The management of Amul joins in on the other side as they've hit the 1 lakh crore rupee top-line milestone. Discuss the outlook going ahead with the Managing Director, Jayan Mehta. There is ceasefire cheer indeed in midweek trading today, and you take a look at every single asset class, particularly the risk assets. They are all in the green as we speak. Look at the Nifty back above 24,000, led by the Nifty Bank, which has had an almost 3,000 point advance. The currency has appreciated. The bond yields have cooled off very, very sharply. And as a result of the cool off in bond yields, take a look at the reaction in the PSU banks in today's session. PSU banks were battered in the month of March, but take a look at the rebound today. A 7.5% move on Union Bank and a 6 to 7% move on most other constituents, including SBI, which is up 4% as well. You take a look at the stocks exposed to West Asia. L&T took a beating during the war, back up 7%, was intraday crossed 4,000 as well. Viatech, Vaba, KC, Kalpataru, all of them surging 4 to 5%. The oil price fall has benefited oil marketing companies the most. Look at HP, BP, IOC, anywhere between 7 to 10% now on HPCL, and ONGC, a negative impact, down around 2.5%. The Adani Group stocks are seeing double-digit gains in today's session. Adani Green's up 12, Adani Enterprises, Adani Total, Adani Energy Solutions, all of them seeing gains of anywhere between 7 to 10%. You take a look at the other beaten down names that are seeing a rebound today. Ashok Leyland was almost closing in on a 52-week low. That's up 13% now. The top gainer on the Nifty 500. Bajaj Finance fell to a 52-week low. That's up 8% as well. And Tata Motors passenger vehicles too doing well for itself. You look at the business update impact. Most of these real estate names are doing well. Prestige Estates, Phoenix Mills, and of course AU Small Finance Bank too doing very well for itself. So it's a sea of green today, barring a few names. Most of the other names well and truly up and away.
All right, Hormaz, thanks a lot for that. So ceasefire cheer on D Street, and there is green across the screen, a deep shade of that as well. But let's get in our special guest for the day today. We have Jain Mehta, who's the Managing Director of Amul, joins in because the revered brand obviously has caused or crossed 1 lakh crore in sales in the last year. Congratulations, it's a milestone, sir. 11% growth at a time when, you know, a lot of the consumption companies are facing some sort of slowdown issues. Just wanted to understand a couple of things. One, what are the factors that led to this 1 lakh crore rupee, you crossing that mark? That's point number one. And secondly, in the more near term, what was the impact on the business when it came to the West Asia war? Packaging costs, etc., for a lot of the consumption companies increased.
Thank you so much. Yes, this is indeed a milestone achievement for Amul, a cooperative movement which started 8 decades back, and the GCMF, which has been here for now 51 years. As a brand which is owned by 36 lakh farmers, it is obviously the objective to serve the interest of the milk producers as well as the consumers. And Amul has been doing this consistently over the last 8 decades, as a result of which we've been able to consistently grow over a long period of time. Over the last few years, we have taken several initiatives to strengthen our distribution network, expand our portfolio, innovate continuously, and also see that we are able to keep up with the pace in which the consumers are changing. So this is a journey, and this milestone, of course, is a landmark in our history.
All right.
About the second point you mentioned, yes. There was a crisis, which I hope will settle down soon. But let me tell you, the fuel crisis did not affect us much thanks to the support we got from the central and the state government. And we got our supplies of gas, which is about 80% of our average requirements. So as a result of which, we continue to process 350 lakh liters of milk every day. And the supplies of Amul products have been consistent all through the entire month. There's been a pressure on the packaging material costs, but we do believe it's temporary. And as you just mentioned, cooling off in multiple places, we are also very confident that these costs will also come down and reduce the pressure both on the producer as well as the consumer.
Jain, I wanted to ask you, 8 decades to get to 1 lakh crores of revenue. How quickly does the next 1 lakh crore come? And secondly, also, when you say the packaging cost impact wasn't much in the quarter, will we see some blip? I mean, at least for the quarter, even if going ahead this improves, what should we expect in the numbers?
The growth figures will remain consistent over the last 2 quarters. In fact, consistently, we've had high double-digit growth in consumer pack segment and the fresh milk segment, which itself is an indication that we will continue at a good, rapid pace. Objectively speaking, while 1 lakh crore looks very good, the opportunity that India has, and I've mentioned this earlier on your channel also, we can add actually 1 Amul every year in our country. because the shift in the consumer behavior from loose to package and branded means a huge opportunity of growth in this space. So we are having our eyes set on this number as well. And as a result of which, all the efforts that we do in increasing our procurement footprint on the cooperative basis across the country, to investing in processing facilities, right from bulk milk coolers at the villages to modern plants and ultra modern distribution network, and innovate with wide variety of products. So a high double-digit growth is definitely expected this year, and I'm sure this momentum will continue. And talking about the pressure in the pricing in this quarter, I'm sure this is going to get settled, so it's not going to be much more impactful as far as the bottom line or the top line is concerned.
Take that point, 10,000 crore annually. If you add on a 1 lakh crore base, you are adding one Dabur, one Marico already to your bottom line every year, or to your top line every year. You want to add one Amul. Well, it'll be very interesting to see how that goes. But, just a couple of questions around the industry right now. You earmarked on, getting increased exports. So what's the performance been like in your presence in the US right now? And secondly, is there any fear of foreign players coming to India post the recent trade deals that have taken place?
To answer the second part first, there is no fear of any foreign milk coming at subsidized rate, or milk products coming, or any agricultural product coming into our country, even due to the free trade agreements which are happening, because the government has very wisely kept our dairy sector, the Chapter 4, out of any of such negotiations. So that way, as a country, and milk is an important source of livelihood for 8 to 10 crore families in the country, we are very much protected, because otherwise many countries are wanting to dump their subsidized products into our country and hurt our sentiments. So this part has been sorted out and is not an issue anymore. Talking about US, yes, we've started selling fresh products in US, and our 6% gold milk is available across 35 states. We are perhaps the only national brand of milk in the entire United States of America, and we're doing very, very well, achieving higher volumes every month. Having said that, we're also exporting dahi from India to US at the rate of about 2 to 3 containers per month, and that business is also growing. The duty reductions also is helping us grow the market of other dairy products like butter, cheese, ghee, ice cream, Shrikhand, and so on.
Mr. Mehta, and finally, before we let you go, the street was a little worried when there were reports of there being some sort of E. coli or some sort of contamination in Amul products. There was a lot of fake paneer sort of news that came by as well. What do you have to say on that? And are you coordinating with the FSSAI on that?
Sure, of course. See, we have 120 plants and we do about 25 billion packs of Amul products every year. We have the highest quality standards, and I've assured elsewhere also, and through your channel also, I want to communicate that Amul products meet the highest quality standards, the acceptable quality standards as per food safety standards of India, and also exceeds these norms. So this is absolutely, there are many malicious campaigns towards that, but we are obviously reassuring all our consumers that the process of quality control in Amul is the best.
Jayan, thanks very much for your time here. We appreciate it, and wish you the best again with what's next. We'll take a break on that note, but up next, more on the markets in just a bit.
Welcome back. A big move is what you're seeing in the markets right now. If you look at the F&O positioning as well, right, a large part of it is on account of short covering that we're seeing. So if you look at the frontline indices, all of them doing extremely well. It's a good day of trade, no two ways about that. Look at the broader markets, they're doing even better. So we have 4% gains for the mid-cap index, 4% gain for the small-cap index as well. A wide gap between the advances and declines that's maintaining through the course of the day. India VIX is down by about 21%, below the 25 mark, below the 20 mark now as we speak as well. So fears all but dissipated entirely, and a large part of this up move can be attributed to some of the shorts being caught on the wrong side as well. Obviously, yesterday there was expiry, so not a lot of positions on the short side for the next week were added, but whatever they were, 23,500 call, caught on the wrong side covering their positions, 23,600 call as well, so a fair amount of short covering here. But at the same time, we're seeing a lot of put writing as well, which is visible at 23,900 for about 200 rupees, telling you around 23,700 would be an important support. 23,800 put writers also fairly active. But on the way up, we are seeing some writing at the 24,500 call. So maybe the street is looking at that as the next level of resistance, which also ties in technically because the Nifty has crossed the 20-day moving average after the gap up today. And there's a wide gap between where the Nifty is right now and where the 20-day moving average is. So that'll be an important support to track. But on the way up, the 50-day moving average, which is at 24,573, plays up as a bit of a supply zone as well. For the Nifty Bank as well, it's crossed the 20-day moving average. The next level to track will be the 200-day moving average at 57,283. The only index that I'll be watching out for from here on is the IT pack because of its earlier outperformance. Does it start to underperform now as it was in the pre-war period versus during the war period where the IT index actually did well? If the rupee continues to solidify from here on, maybe the IT index ahead of TCS's numbers will begin to underperform as well. With that, we'll take a short break, come back, focus on markets and a lot more stock-specific action. Stay with us.
Well, we have Arun Kumar Singh, who is a former ambassador to India, from India to the US, joining us now to discuss the latest happenings in West Asia. Mr. Singh, thanks very much for your time here. We've seen this 10-point agreement plan between Iran and the US. To begin with, you think this 2 weeks will become lasting peace? Who gets the upper hand? And the fact that Pakistan is playing mediator, what does that do to their diplomatic standing in this region?
So we have to see how the 10-point plan plays out, because that's essentially an Iranian plan or Iranian proposal. And although Trump has said that that is something that they can work with, but many of the elements that are there, US in the past has found it very difficult to go along. So I would say that at the moment that is in play, because US and President Trump wants an off-ramp for the moment, and we have to see. But I don't think the 10-point plan will likely lead to any kind of an enduring result. That's just a framework to start some kind of discussion. And I think the situation is still complex, because from Iran's perspective, what they would want, a commitment from the US and Israel that they don't resume attacks at a later stage. They would ideally want some compensation for the damage that has been caused in the war. They would want removal of all the sanctions. And I don't see all that playing out immediately. I think from the perspective of Israel, they would want to make sure that the Iranian state does not have the capacity to hit back against Israel. And therefore, they would like to reduce certainly their defense programs, their ballistic missile program, their nuclear enrichment programs. And they would like enduring limits on those programs. Now, whether Iran is ready for that after the kind of war they've been subjected to. And from the US perspective, while they would welcome all that, I think President Trump wanted to signal for himself that he was able to achieve what no US president has been able to achieve so far. And that major reorientation in the foreign policy of the government in Iran. And I think that is unlikely to happen. So I think we are in a situation where all the antagonists are unlikely to achieve their main objectives. So what are the compromises that they are prepared for, given the kind of damage that has happened? And, one of those who have suffered major collateral damage are countries in the Gulf, the Arab countries. They didn't want this war. And in the process of this war, there's been damage to infrastructure in those countries. They were seen as safe haven for investment, for people going there, living there. That image will be challenged. So what is going to be the impact on the economy of those countries? And they would worry whether at the end of this war, with whatever settlement that is worked out, does Iran feel emboldened? And what does that mean for their security? Because you'd have seen reports that many of those leaders had now been asking the US that once you have started the war, you have to make sure that Iran doesn't end up with capacities or an intent and will. That is a later challenge for them. So these are the complexities. As far as Pakistan's role is concerned, I think they are placed in a particular situation at the moment. They're neighboring Iran. They have a defense cooperation agreement with Saudi Arabia. They have a reasonably good working relationship with President Trump, with the government in US. So given the particular situation, they were able to play a role to exchange messages, get something going. And I think globally, most people would welcome that some kind of positive move towards a ceasefire has been achieved, whoever has played a role in that. But I don't think that poses any kind of security or any other concern for India. I think as far as India is concerned, it has a good relationship with the countries in the Arab world. It has a good working relationship with the US, strong relationship with Iran, with Israel, and even Iran, if you saw, have permitted Indian flagged ships to pass through the Strait of Hormuz, showing that they also attach value to the India relationship.
Right, that's point well taken. Thanks a lot, Mr. Singh, for putting that into perspective. No problems for India. It's great that Pakistan acted as a mediator out here. But, just given your experience, what kind of probability would you assign to this de-escalating as well? Because Donald Trump, as we've seen over the last 4 to 6 weeks and years before that as well, is known to change course without any notice.
No, absolutely. But I think, I've said earlier in other comments that Donald Trump would feel a compulsion to bring the war to an end largely on 2 grounds. One, how is his domestic politics playing out? The price of energy in the US market, inflation, how does his base feel his involvement in a war, which is clearly a war of choice? There was no imminent attack from Iran. And I think that has been playing out negatively for him. The second thing is that they have spent large amount of their interceptor missiles in what was happening in Ukraine, the conflict between Israel and Iran last year, and the current conflict. So the limit on their stocks of interceptor missiles would again be a constraining factor for Donald Trump. So at the moment, I think there is a compulsion on him to bring the current crisis to an end, at least the active phase. As far as Israel is concerned, to some extent, they've achieved their objective. They've certainly degraded the capacity of the Iranian state to hit back on them. Now, whether they are comfortable that they have done it now for some years down the line, and that do they have the capacity to go in and hit Iran whenever they want if they see military-related developments or preparations in Iran that could be a security challenge for them. And the third player, as far as the Iranians are concerned, they've been damaged in a major way. The infrastructure has been hit. The Iranian, emotionally, they would react because the war has been brought to their doorstep. Are they politically in a position to accept continuation of the ceasefire? But I think given the extent of damage that has been done to the infrastructure and the economy, I think there would also be compulsion on the Iranians to try and prolong the ceasefire. I think at this stage, the real challenge would be what is going to be the arrangement around Strait of Hormuz. Because even now, the Iranian foreign minister has commented that the ceasefire is there, but movement through the Strait of Hormuz can happen only in coordination with the Iranian military. Now, that something would be difficult for the Arab countries to accept. It will be difficult for the US to accept. How do they work that out, we have to see. Right. And also in terms of the rights to enrichment for uranium that Iran has been insisting on, whether US and Israel are prepared for that compromise. So I think at the moment, I would say there's certainly a compulsion on all sides to continue the ceasefire. But I think we are nowhere near resolution of the issues that led to the current conflict. And one can't say that at some stage down the line, it will not flare up again.
Ambassador Singh, a short but insightful conversation. Thank you so much for sparing time and joining us today. We'll take a short break, get to the action on the bond markets on the other side with Manisha Gupta.
Well, as promised, let's shift focus to the bond markets, and Manisha Gupta, as always, is joining in with the latest on that front. Manisha.
Well, it promises to be an interesting day for various asset classes with so much happening in the international markets, and then there are Indian cues to react to as well. So when you look at the India bond yields, well, early in the day, they fell by 10 basis points, and this was in reaction to the US announcing a 2-week ceasefire with Iran, Israel also jumping in with an affirmation therein. And this has led to a reaction in the crude oil prices, which fell 10 to 15% and are just about holding around that $95 to $92 a barrel mark therein. The conditional safe opening of Strait of Hormuz also is something that seems to have done wonders to the risk appetite in various asset classes, and that's exactly what we saw into the bond market as well. But then the prices of government bonds gave up some of those early gains. This is as traders started to place short positions. The 2035 gilt at 6.9%, which is the lowest that we saw since March 25th there is. RBI's MPC keeping the interest rates unchanged at 5.25% is something that the street was perhaps working with. But it is the other numbers. And this, by the way, is the second consecutive time that you're looking at a pause when it comes to interest rate movement from the RBI therein. The SDF rates at 5% and MSF rates at 5.5% also have been held steady. RBI is now expecting the CPI inflation at 4.6% for FY27, suggesting that there are risks on higher side in sense of inflation there. The growth for FY27 is projected at 6.9%, which also, of course, is going to be to the light of what happens in the international markets. At this point, it is 2 weeks that we are anticipating that there wouldn't be any statements. There would be negotiations at best, and then, of course, statements leading to that. But after that, what happens and doesn't happen is something that the street will watch out for. But at this point in time, there is a bit of a clarity, stability that the street is anticipating.
Manisha, thank you for that update there. Take a short break. More on the markets on the other side. If you want to call this a slight cool off from the highs of the day, you may want to, but there is still an 800-point up move on the index. We were at 24,000 at the start of the show. We are still at 23,930. The banking index continues to do well. Of course, there are some select underperformers like the ONGCs and the Coal Indias that are not doing well. But overall, the first half of the trading day has been a very good one for the markets. Take your leave on this edition of Trading Hour. From Mangalam, Ritu and me, thank you for watching. We leave you with the markets still in positive territory ahead of the RBI Governor's address. Stay tuned. Back with more on the other side.
and welcome. You're watching Halftime Report here on CNBC TV 18. The Reserve Bank of India has just announced its monetary policy decision a short while ago. If you're just tuning in, it was a status quo policy on the rates. As widely expected, 5.25% is where the RBI left the repo rate. The growth numbers have come in for the new financial year. It is at 6.9% for FY27, and the CPI inflation for the full year is seen averaging about 4.6%. That's where we're at on the macro forecast. We now have the top brass at the RBI addressing the media after announcement of that policy. Take a look.
Shri Sanjay Malhotra, along with Deputy Governors Shri T. Ravi Shankar, Shri Swaminathan J. and Dr. Poonam Gupta. We also have with us Executive Directors Shri R.L.K. Rao and Shri R. Kesavan, along with Dr. Ajit Ratnakar Joshi, Sri Sanjay Kumar Hansda, and Sri Indranil Bhattacharya. I also welcome my other colleagues from the Reserve Bank. Before we begin, we have a few housekeeping announcements. So there are totally 27 participants from the media, and I'll request the media persons to please stick to one question so that everyone gets a chance. I also request everyone to switch on the mic while speaking so that those watching the live telecast are able to hear clearly. And once you have finished speaking, please switch off the mic. Sir, with your permission, I will now call out the names. Thank you, sir. I will request Ms. Lata Venkatesh from CNBC TV 18 to please ask the first question. Lata, please.
Thank you, Mr. Bridgeraj and Governor. So what looked like the structural shift in this policy is that you all have started giving us core inflation number. So a couple of questions attached to that. Core is non-food, non-fuel. So if you are giving us that number, are you indicating that even if inflation headline goes up, but core doesn't because that could be because of a change in fuel, you will not be moved? Are you trying to give us a message? And in that case, can you also give us the quarterly core breakup at some point in time, maybe from next time? The more important part is if you look at your second half, while the full year average is 4.4, even then 1 percentage point above last year, the second quarter, second half average core goes nearly to 5%. So should the market be prepared for a rate hike in the second half? As well, a word on liquidity will be triple R return.
So first of all, let me compliment you to be, to have been, very nimble in your question. You have noted the change that we have made in this policy statement. I'm very happy, that you have noted that. This has been a request which has been there from the market participants, and so we thought that this was while this has always been a factor, so in that sense, I would not say it is a shift. It's not a shift, in terms of monetary policy decision making, but it's only, we thought that this was the right time to do it because we did, the 5-yearly review. So there was a second 5-yearly review, which was completed, and so we thought that this is the time, if we have to do something about it and and give our projections on core, which we have been doing internally, and so that's why these numbers have been given. Monetary policy is not preset course of action. As I have stated even earlier, even in the last statement, I think I made a mention of this, and even otherwise, that it's not, while, for us, it's the headline, which is the target, and we have to ensure, that it's headline that remains at target and within the band. That's the goal, that's the primary goal for us. But at the same time, the various components of inflation and where they are emanating from are also very important. And so that has been the consistent policy of the Monetary Policy Committee and of the RBI, and we'll continue to look into all components and then, take a call as to how we need to respond to the various components while keeping in mind that the ultimate target is headline inflation and it's not anything else.
That should, first of all, there is an adverse scenario.
So as I said,
inflation you have increased by 50 basis. Growth you have brought down less. So it can be interpreted
so
as...
So that's why I said it's not a preset course of action. It's for the Monetary Policy Committee to decide, to take a call. These are the factors, which go into it, how, they are going to play out over a period of time. We will take a call. Things are evolving, so drastically, and so frequently every day, you yourself mentioned, 5:30 a.m., we got a pleasant news, maybe not a complete surprise, but we got some pleasant news, and so we have to, be prepared, and so we will not be, in a position to say what the MPC is going to do in the next meeting.
Thank you, sir. We'll take some more questions from our left side before we come to this side. So for the next question, I'll request Shri Manojit Saha from Business Standard. Manojit, please.
Yeah, thank you. Thank you. 1 year ahead, inflation forecast is 4.7%. You have given it here. So the real rate is just 50 basis point, while the neutral rate is seen around 1.5, 150 basis point, 120. So are you falling beyond below the neutral rate? Number two, if you can also throw some light on the recent RBI steps to curb the rupee depreciation, the NOP cap, or banning banks offering contracts to clients. Are you satisfied with the rupee's behavior in the last few days? And now the scenario has changed completely. Is there there's a case to withdraw those limits and caps?
A lot of questions.
Two questions only.
Three questions. So your second question first, which is, on the recent regulatory measures that we took with regard to the foreign exchange markets. You are all aware, and you may not have witnessed, but we did notice that in the last few weeks of last month, March, there was heightened volatility in the forex markets. We saw that positions were being built up, leading to arbitrage positions between the non-deliverable forward markets and the deliverable markets. In normal times, these linkages are important for an efficient price discovery. And that's why it has been our endeavor to widen and broaden, and make more liquid these markets. But when there is excessive volatility, when there is excessive building up of positions, is only increasing volatility and perhaps not helping in efficient price discovery. Such kind of measures are taken. Whether and these are reactions to the specific market movements. These are not in any sense they are not signaling any structural change. We stand committed long term. We stand committed to the development, broadening, and deepening of these markets, to the internationalization of the rupee. And so obviously, these are not measures which are going to remain there forever. As and when, we see that, and you have seen, so much of fluctuation. You can yourself see, how, the rupee has been so volatile. So it's basically, arising out of that. With respect to your first question on the neutral rate, while, first of all, we do not have, very precise numbers on the neutral rate, but there have been occasions when the real rate, because, first of all, you don't have a neutral rate, so what is the neutral rate, but so it's difficult to calculate, what the actual rate, should be. But real rates as of now are still high as of now. Looking ahead, as I said, there is so much of uncertainty to be acting on those today. And especially when the MPC noted, that when there is so much of uncertainty, number one, and moreover, it's coming from the supply side. So having noted that, that's why the MPC thought that this is a time to pause, wait for more data, and then take a call. Real rates today are still about 2% or so. They are not low. Going forward, how it happens, so much of uncertainty, we need to wait and watch.
Thank you.
Thank you, sir. I will now request Anup Roy from Bloomberg to ask his question. Anup, please.
Thank you, sir. Sir, thank you for giving an elaborate answer on this rupee thing. So going back to your date call, the guidance in February policy that rates will remain low for longer, 9 to 12 months, barring any shock. The shock has come, but today we have some clarity also. So would you give that comfort again that rates will remain low if the shock is dissipated?
See, we are in a neutral state. Possibility either ways, anyways, cannot be ruled out. So it is quite possible that these low rates continue for a long time. As I mentioned, structurally, Indian economy is very strong, very resilient, very robust. Despite shocks, we are projecting 6.9%. Despite such a big shock, 6.9% real GDP growth. And you look across, independent of what other economies are growing, but if you look at relative to them, even better. So structurally, long-term macroeconomic fundamentals, because of various measures which the government has taken, which the RBI has taken, which various institutions have taken, remain to be very strong and continue to drive growth on the one hand, and at the same time keep price pressures contained. So it's quite possible that even in the short to the medium term, we will continue to have low rates. It's quite possible.
Thank you, sir.
Thank you, sir. I will now request Ms. Hamsini Karthik from Money Control to ask her question. Hamsini, please.
Thank you. Good afternoon, Governor, and DGs, everyone. I'd like to drift a little from some of the macro points. And as your speech was concluding, the bank stocks really cheered your monetary policy today. You came up with a lot of leeway in the way that they can operate, etc. A couple of things I would like to understand from you, Governor, is you're open to reviewing the computation of net profit back to CRAR, and you're open to letting go or not, consider the 25% threshold on 25% increase threshold on GNPA. I'd like to understand what triggered this review process within RBI, and do you believe that you will see a reasonable amount of capital flowing into banks as a consequence to this? And the reason I'm also asking this question, I'd like to get a good answer to this question, is because in the last 6-8 months more so, we've seen a lot of banks, almost like every 2 weeks we've had some bad news or the other from banks, largely private banks. I take your point that this is not a systemic risk, but with the way banking is changing globally and also faster in India, do you see a need to enhance, or rather, do you see a need to possibly tweak more on regulations, or you believe supervision can take care of these nagging pains that come up every few times?
Broadly,
connected questions.
Two quite different questions, but connected smartly. You have connected the two.
The banking questions.
Banking questions. So the first one is on capital related measures, that we announced today, 2 of them. The first one, I think both of them have been in the works for some time. They are not that way, surprises. The banks have been requesting us, and I think, NBFCs already had similar provisions. So it was time, that we aligned it with regard to the first change that has been made with regard to the calculation of CRAR. It does not change the calculation of net profit. It only changes the calculation of the capital adequacy. It is a better reflection of the capital that the banks have. Similarly, the second measure that has been announced with regard to the investment fluctuation reserve, that also does not, there has been a, checkered history, if I may say so. it was there, then it was brought, it was withdrawn, then again, it was brought in. This is something which is not been there, it's not there in any other jurisdiction, and there was lack of clarity also, with regard to it. And moreover, as I mentioned in my statement, number of prudential regulations that we brought in, we did not feel, that there was a need with regard to it. On the second part of your question, which is perhaps relating to, some of the episodes that we witnessed in some of the private sector banks, I want to assure everyone through the media present over here that the banking system is very resilient, it's very safe, strong. Number of regulations, whether it's relating to conduct, governance, prudence, liquidity, all of them, along with, our supervisory framework, they keep the banking system very healthy and robust. These are episodes. There are, these will, unfortunately, these are bank specific. Not even bank specific. These are, these are more, in the nature of, crimes, or in nature of crimes. And while, we have to be vigilant and alert to them, the law enforcement mechanism, obviously, in our country will also take care of these. Not to add anything?
I think it's perfectly fine, sir. In terms of these are entity-specific developments, do not pose any systemic risk at this point in time. As we have clarified that as they play out, we deal with them on a bilateral basis as this play out. But as Governor said, that banking system as a whole remains resilient, and we continue to focus on improving the conduct-related matters and governance-related matters. And banks are by and large run on very professional lines. And any material supervisory concerns as and when it arises are dealt with on a event-specific basis. If anything requires at a system level or a regulatory tweak, as you were alluding to, that we are not averse to taking such measures, but at this point in time, there is no event that warrants a macroprudential measure or a regulatory tweak. These are episodic. We will handle it on an individual basis.
Thank you, sir. Thank you.
Thank you, sir. I will now request Ms. Ekta Suri from Z Business to ask a question. Ekta, please.
Good afternoon, sir.
Ekta, आपने बात मान लिया, आपने उनको जो है, you have raised her up the order, huh?
Thank you, sir.
Yes.
I thought so, right?
Yes, sir. Thank you so much.
आप खुद इतना अच्छा हिंदी में बोल रहे हैं, आप अच्छा हिंदी में बोल रहे हैं।
सर नहीं, हिंदी चैनल नीचे आ जाते हैं, फिर वो सारे इंग्लिश वाले ऊपर आ जाते हैं, तो इस बार सच में रिक्वेस्ट सर आपने मान ली। थैंक यू सो मच सर।
आपको ब्रिज को धन्यवाद देना पड़ेगा।
थैंक यू सर, थैंक यू ब्रिज सर। सर मेरा सवाल सर, अभी हम बात कर रहे थे गवर्नेंस के ऊपर, सर उसके ऊपर है सर। अभी हाल ही में अगर हम फ्रॉड्स को साइड में कर दें, मैं नाम भी लूंगी, कोटक महिंद्रा बैंक या IDFC फर्स्ट, लेकिन अगर हम HDFC बैंक की भी बात करें, इस्तीफे ने बहुत हेडलाइन बनाई, वहां पर साफ लिखा गया कि ये एथिक्स और गवर्नेंस से रिलेटेड मैटर है। लेकिन जब उसके बाद पूछा गया जिन्होंने इस्तीफा दिया चेयरमैन जी से, तानू जी से, कि क्या इश्यूज हैं, वो खुलकर नहीं, उन्होंने कुछ भी नहीं बताया। यहाँ पर मेरा सवाल ये है, लेकिन हाँ इंटरव्यू में ये जरूर बोला कि मुझसे क्यों पूछे जा रहा है कि क्या इश्यूज है, आप खुद आत्म मंथन कीजिए। यहाँ पर मेरा सवाल ये है कि पैसे की बात पैसे से होती है, लेकिन यहाँ पर आपने इस्तीफा दे दिया, जो शेयर होल्डर है उसको नुकसान हुआ, उसकी शेयर की वैल्यू जो है वो नीचे गिर गई। बैंक का जो कस्टमर है उसके दिमाग में एक बीज बोया गया कि पता नहीं क्या ऐसे एथिक्स और गवर्नेंस वाले इश्यूज चल रहे हैं, मेरा पैसा सेफ है या नहीं है। तो सर अभी जैसे सर ने बोला कि इसके नियम थोड़े हम और सोचेंगे, तो क्या यहाँ पर क्या RBI ने कोई मिनट्स में कोई ऐसी चीज पाई है जिसमें सच में एथिक्स और गवर्नेंस के कोई ऐसे इश्यूज है, लेकिन हाँ मीडिया तक नहीं पहुंचे, शेयर होल्डर और कस्टमर तक नहीं पहुंचे। दूसरा, अगर नहीं ऐसा कुछ पाया है तो क्या कोई ऐसा नियम आएगा कि कल को कोई भी बोर्ड से रिलेटेड अगर इस्तीफा डाल रहा है और वो एक वेग भाषा का इस्तेमाल करके वो अगर जाना चाह रहे हैं तो जाए, लेकिन वेग भाषा का इस्तेमाल करके एक कस्टमर के दिमाग में ट्रस्ट का मिसट्रस्ट का डाउट ना डालें, और दूसरा एक शेयर होल्डर जिसका कोई लेना देना नहीं इमोशन से, उसके शेयर की वैल्यू को गिरा कर ना जाए?
नहीं, जो पहला आपका प्रश्न है, देखिए, हमने पहली बात, हम किसी बैंक स्पेसिफिक प्रश्न को हम यहाँ पे उसका उत्तर नहीं देते, लेकिन आपको मालूम है, ये सर्वविदित है, सबको मालूम है कि हमने प्रेस में अपना एक प्रेस नोट दिया था तब, जिसमें हमने ये कहा था कि हमारे हिसाब से कोई भी मटेरियल कंसर्न हमें, चाहे गवर्नेंस या कंडक्ट से संबंधित हो, वो नहीं है। तो उस बात को मैं यहाँ पे दोहराना चाहता हूँ कि कोई भी मटेरियल हमें कभी भी अपने सुपरविजन में या उनके रिकॉर्ड को देख करके ऐसा कोई गवर्नेंस और कंडक्ट से रिलेटेड मैटर हमारे सामने में नहीं आया।
Sir, you say that after seeing the minutes of after checking the minutes of the board meetings, or
जनरल जो हमारा सुपरविजन रहता है उसके अंदर में मिनट्स भी देखे जाते हैं, मिनट्स की प्रति भी हमारे पास में आती है, तो उन सबको देखने के बाद में ही ये हमने जो वक्तव्य जो हमने अपना प्रेस नोटिस जो दिया, प्रेस नोट जो जारी किया, वो सभी चीजों को ध्यान में रखने के बाद में ही दिया है। क्या इसके लिए कोई और दिशा निर्देशों में, गाइडलाइंस, डायरेक्शंस में कोई और बदलाव करने की आवश्यकता है? आज के दिन में हमें ऐसा नहीं प्रतीत होता, लेकिन यदि ऐसा महसूस हुआ कि कहीं भी आगे जाकर के कोई बदलाव, कोई नया नियम, निर्देश, सेबी के निर्देश वैसे इस संबंध में आप लोगों को मालूम है पहले से ही है, उसके ऊपर यदि कोई और निर्देश की आवश्यकता यदि हुई, महसूस हुई, तो उसके अंदर हम कभी भी पीछे नहीं हटेंगे।
कंटिन्यू वन मोर सर, क्योंकि एक बड़ा बैंक था, आपने स्टेटमेंट भी दी कि यहाँ पर बैंक स्टेबल है, लेकिन अगर कोई छोटा बैंक होता और इस्तीफे के बाद लोग डरकर अपने पैसे विड्रॉ करवाने निकल जाते, तो सर उस समय तो अनस्टेबल सिचुएशन आ जाती। तो मेरा एक ये भी सवाल था कि आपने किसी को भी रिजाइन करना है तो वो रिजाइन कीजिए, लेकिन इमोशंस पर गोलमोल बातें कर वैल्यू गिराना शेयर की, मेरे दिमाग में ये मिसट्रस्ट डालना कि मेरा पैसा सेफ है कि नहीं, सर वो किस हद तक, सर उस पर आप क्या कहेंगे?
देखो, जैसा मैंने कहा, मैं किसी एक स्पेसिफिक बैंक या वक्तव्य के बारे में नहीं कहूंगा। मैं कहूंगा कि जो भी कानून है वो बिल्कुल स्पष्ट कानून है, और उसमें हमें नहीं प्रतीत होता कि आज के दिन में कोई बदलाव की आवश्यकता है। यदि हुई तो निश्चित रूप से हम उसके ऊपर में विचार करें।
धन्यवाद सर। Sir, we'll now take a few questions from the right side. I'll request Sangeeta Mehta from the Economic Times to ask a question. Sangeeta, please.
Thank you. Sir, what is the crude oil price assumption that RBI has taken to arrive at the inflation projection of 4.6%?
For this year, $85 to a barrel.
For the full year? For
the full year on an average, $85.
And so
it's now, and next year is, I think, 75. 75.
And sir, how long is your assumption of the crisis to last, West Asia crisis? Because one of the
it's very difficult. There is no assumption that what feeds into is the price. The price is more important for us, and some of the supplies, some of the critical supplies. So, and the war, actually, it is more, the supply disruption. The war, you are aware, that the Ukraine war is going on. But it is having, one can't say that it is having no impact, but it's having negligible impact. So what's important is that how long, what are going to be the prices of some of these commodities which are important for us, especially energy, and what is also important is how long, this supply disruption is going to be there. It's very difficult to say so. Now there is an announcement that it will be the Strait of Hormuz, for example, will be opened.
Well, because one of the comments, the statement you have said that is if initial supply shock can potentially transform into demand shock over a medium term if the restoration of supply chain is delayed. So this medium term is referred to what time frame?
This will be many months. Many months. Okay.
Thank you, sir. I'll request media participants to please stick to one question so that everyone gets a chance. I'll now request Jasprit Kalra from Thomson Reuters to ask his question. Jasprit, please.
Quick question on the FX side, the measures that were taken. Of course, they have helped stabilize the rupee and the arbitrage positions that you highlighted. In some corners of the market, especially amongst foreign investors, it's also been interpreted as a soft capital control, with more could be coming down the line that could hurt returns. And they've also raised concerns about how it makes it harder for them to hedge their currency exposures in the local market. When you take these measures, what sort of impact assessment is done on that level? And has the RBI reached out to or communicated with any investors to reassure their concerns, or do you plan to do that?
No, see, that's what I just mentioned, that these are specific to the market movements that we observed. These are not structural changes. We stand committed. I am repeating, I don't have more to add, unfortunately, to what I said, but I'll still repeat, which is that we stand committed to the further deepening, widening of these markets, and the further internationalization of the rupee. These should be seen as actions which help, I would say, in better market development, rather than because this we found was quite speculative and in some sense, bordering on speculation, right? So it was more of speculation, leading to higher volatility. So that's why these measures have been taken. And yes.
Thank you,
sir.
sir.
Anything?
Yes, these measures have to be seen in the context of this event, this episode, which, as most of you probably know already by now, was leading to disruptive volatility. More importantly, this was leading to a artificial drying up of supply in the market, which was affecting prices. Although the transactions were arbitrage transactions, they were affecting local prices. So our objective of doing this was to cool that phase down. So the long-term commitment still remains to rupee internationalization, to having one global market and all that. On the issue that you raised, whether foreign investors can hedge here, nothing has been done which disables them from hedging. They can all hedge. So those things are also well in place. We will look at how the market responds to this. You would see that we initially just announced that these positions need to be wound down, right? By limiting the position. Then we studied the market behavior, and we understand that in a market, market makers or authorized dealers have privileged position, right? And they behave responsibly. We have seen how much they have added to the depth. Sometimes you get carried away. So we thought an indication should quieten things down. We did not see that. We did not see that. We saw that these positions were, being assigned here and there. So we took the remaining measures to contain those. This is a very, very specific, specific measure that is intended to contain this particular episode.
Thank you, sirs. I will now request Ankur Mishra from ET Now to ask his question. Ankur, please.
So continuing with the same topic, many of the banks have been complaining about MTM losses due to the measure which you had taken. I want to understand when you see particularly when we spoke to the market participants, they also mentioned that till 2020 NDF view was different for Reserve Bank of India, and it later got changed. Now, if you're saying this is specifically to arrest the rupee volatility, is it a fair understanding that in very near term, once you can see the currency stabilizing, the limit may be once more revised based on the situation? And also, I mean, the NDF view remains the same from Reserve Bank of India. Also, today you have announced about the IFR requirement of the banks. Wanted a little more elaboration on the thoughts behind that.
So first question, I think, we answered. Only repeat that, this was in response to this particular episode. This is not permanent or structural. So going forward, we'll see how the markets are behaving, and appropriately, a call will be taken at an appropriate time, to review them. Second question, IFR. I'll request Swaminathan, Mr. DG Swaminathan, to throw more light on it. Basically, changes in the investment, like, now the bond yields are very high, and sometimes they can go up, they can go down, and so that has implications for their profitability. Then the banks come back to us saying, please allow us to stagger these losses. So we had come out with the concept of an investment fluctuation reserve, which to some extent, mitigates. But then we feel that it is, the market prices, mark-to-market prices, should be factored in, because that's the correct position of the banks. And so that's why if they price it as per the market, then the very need of this fluctuation reserve, goes away. You can probably, throw more light on some of the historical details of why this was first introduced and removed, and then again, it was brought in.
Now, as Governor earlier mentioned, also this had a checkered history. It was introduced in a certain context, withdrawn, reintroduced, and there was also a lack of harmony across the bank types. Different banks had different guidelines that were applicable to them. Essentially, it was required or thought to be relevant because it is better to keep some reserves in good time. So this was to be created as a below-the-line appropriation item out of the profits that would have been generated during the year by sale of investments, so that it can be used up when it is necessary. Subsequently, two significant developments. One is that in terms of our capital adequacy norms, guidelines have been completely revamped, and also that, as you are aware, 2 years ago we issued a comprehensive guidelines in terms of valuation and disclosure of valuation of investment book. So having implemented that, this IFR is considered no longer relevant. It does not in any manner change the value at which investment book has to be reflected in the accounting books, and also it does not change the profit calculation in any manner. This was an appropriation item considered no longer relevant in the given circumstances. So has been done away with more in the nature of a simplification. And third thing is that there was also a different level of compliance across the banks. It was not uniformly complied with as well. And there were supervisory observations arising out of difference in compliance levels. So by removing that particular requirement, we are making it a little more easy in terms of complying with the applicable norms. So it's at this point in time considered no longer relevant. Maybe we can offline clarify to you more in detail. No, because this was a below the line appropriation item, so it wouldn't have made a significant difference. It was around 2%. 2%. Requirement was 2%. Yes.
Yeah. Thank you, sirs. I will now request K. Ramkumar from Hindu Business Line to ask his question. Ramkumar, please.
Thank you. Are you seeing any kind of signs of incipient stress build up in the banking system because of this supply chain disruption, high energy prices, and weak external demand? And another question is about whether the transmission of the earlier rate cuts is complete into the lending rates and deposit rates. Yeah, thank you.
So insofar as from the bank side, we are not seeing any systemic concerns. with regard to their profitability and their health. Yes, there will be pockets, there will be sectors which will be hit because of the present crisis. Again, it will depend on the extent. The government has done a wonderful job as of now in trying to secure these inputs and reduce the supply chain disruptions. It will all depend on how long this continues. In the meanwhile, you are aware that we have already extended the time limit from 31st March to 30th January for the longer period of exports proceeds to be repatriated to 450 days. Till 30th June we have done that. We'll see going forward, but as of now there is no systemic risk. What is the second question? Transmission, I think this there, in my statement as a footnote perhaps, against 125 basis points, about 90 basis points has been, is the transmission, that we have seen on the lending side. Similarly, on the deposit side, it's more than 100. So there's been good, satisfactory, as I mentioned, transmission.
Thank you, sir. I will request media persons to please stick to one question. I will now request Piyush Shukla from NDTV Profit to ask his question. Piyush, please.
Good afternoon, Governor DGs. Thank you, sir. Sir, one payment bank CEO was jailed and he's been released, and the bank is in transition to SFB. Does this development affect their SFB? We have given an in-principle approval to them. Does this affect that progression? Will the bank have to? Has the bank sought reappointment of the CEO? CEO's reappointment. Has the bank sought that? Also, in terms of the upper layer category of NBFCs, when will be the next list updated, and will Tata Sons be a part of it?
See, specific, regulated entities specific questions, we don't ask. The next list, we are coming up with a framework. We are coming up with a new framework for the NBFCs. Very soon, you should see that. New framework for categorization of NBFCs into upper, middle layer, etc. You'll see.
So just this bank.
Very soon, very quickly we should do it. Hopefully
this payment bank has received in-principle approval for conversion to SFB since he's a KMP. Just some clarity, sir, whether this affects that.
I'm sorry, specific bank questions we don't answer.
So that draft norm, that will be a draft norm or final circular, that NBFC?
Generally, we do a draft. I mean, this case we will see. We'll take a call.
Thank you, sir. Sir, we'll now take some questions from the left side. I will request Falakna Syed from Deccan Chronicle to ask a question. Falakna, please.
Sir, is this a growth assumption of 6.9%? Isn't it too optimistic, given that supply chain normalization, especially gas supply, takes quite a long time, and it will have ramifications outside also the supply. Also, the level of oil that we will have will be higher than when the war started. So isn't this growth of projections too optimistic?
No, we don't think, that it is too optimistic. However, we have mentioned that, there are more risks to the downside rather than to the upside, and that would happen primarily, I would say, for the reasons that you are mentioning. If, there is a prolonged disruption in the supplies, which we hope should normalize sooner than later, that can put pressure on the assessment of growth of 6.9%. This is a reduction, in comparison to last year, of about 70 basis points. So it's not small.
Okay. Sir, can you share data on the last 7 months? 7 months back, you had launched the unclaimed deposits scheme, wherein banks were given a kind of incentive.
We'll give the data. I don't have it, offhand.
Okay.
You have it? You have some data. Why don't you then give it?
So last 7 months, how much amount has come back to the depositors?
There were two events. One is that Aapki Punji Aapka Adhikar scheme, there was campaign for 3 months from October to December by DFS, Government of India, and also RBI. So that led to a lot of unclaimed deposits, being returned to the claimants. And also we have come out with incentive scheme to the banks. So that also helped. It's around the same time. So both these initiatives actually led to a lot of retaining of the amounts. I can tell you the figures. So average earlier from April 2025 to September, average refunds were around 180 crore. Now, post this campaign, that is from October till now, the average has gone up to 760 crore per month. So to that extent, it's quite a jump. And even in incentive also, around 600 crores we are paying to the banks for doing aggressive tracing of the customers and then retaining the amounts. So these are the figures.
All right, so that was the top brass at the Reserve Bank of India addressing the media after announcing a status quo policy on rate 5.25%. That's where the repo rate has been left at. The growth projections have come in at 6.9% for the current financial year, with the governor just now in the press conference clearly stating that if there is continued supply disruptions, there could be a downward pressure on this number. The CPI inflation for the entire year is seen at 4.6%, and the core inflation number, which the RBI has given out for the very first time, is at 4.4%. Apart from that, there is a whole bunch of non-policy measures, including on capital adequacy, that the Reserve Bank of India has announced, and we'll discuss more of that. During the press conference as well, again, you had the Reserve Bank of India saying they did not find any governance or conduct-related concerns when it came to HDFC Bank. Importantly, they've also said on the Forex circular that it is not a permanent measure. It is just in response to the current situation and will be reviewed and perhaps removed at a later point of time. Apart from that, we also saw some updates coming in on, the capital measures, where they said the IFR measure has had a bit of a checkered past and they thought it was no longer relevant, and therefore the RBI has chosen to do away with it. So that's as far as the key updates are concerned. Also in the NBFC sector, that there will be a revised framework for categorization of NBFCs into the base, middle and upper layer. That is an important change, which the governor indicated will be out soon. Apart from that, none the wiser from this policy press conference. It looks like we're in for a pause, but the policy not as hawkish as perhaps the market anticipated. Let's bring in our guests to react to some of these comments that have come in. Sakshi Gupta of HDFC Bank, Soumya Kanti Ghosh of State Bank of India, Neeraj Gambhir of Axis Bank and Lalit Tyagi of Bank of Baroda are with us now. Gentlemen, Sakshi, thanks very much for your time here. Mr. Soumya Kanti Ghosh, let me start with you on your key takeaways from the policy today, and if you think some of the macro forecasts that have been made with the assumption of oil at $85 a barrel on average this year seem realistic.
No, I think it's Ritu. I think thank you for this opportunity. I think on an overall basis, we are expecting that the oil prices assumptions could be anywhere between 90 to 100. But this 85 actually builds in the assumptions, because if you remember, before the war had started, there are already talks of a global growth being downgraded, and oil was supposed to, I think there was a forecast which has said that oil could actually move towards 50. So I think taking that into consideration, and with the hope that the conflicts ease sooner than later, I think the projections of $85 per barrel, it could be plus minus 5 over there, but the important message is that crude oil prices are likely to stay higher for longer in the medium term.
Okay, Sakshi, what's your take on the forecast that we've got? Is there a downside bias, an upside bias, given what we've seen, the developments of the last 24 hours?
Right. So look, I think for me, there were a couple of things from this policy. A, I think unlike some of the expectation that, the RBI could be hawkish, in this policy, clearly a very, very balanced communication. I think that the RBI was neither dovish or hawkish, in my opinion. I think they are talking about they have upped their inflation forecast, and they've also said that there is an upside risk to the inflation forecast that they are giving, while on growth, while they are projecting 6.9, there is a downside risk, right? At this point, depending on whether the ceasefire, I mean, we've had pleasant news, but I think what will be critical is whether the ceasefire is actually durable and the Strait of Hormuz actually opens up on a sustained basis. Given that, my estimation is that on inflation, the number at 4.6 at this point seems a bit conservative. We are estimating inflation to be closer to 4.95% for this year, assuming that this conflict is short-lived and the ceasefire holds. Because I think that, over the coming months, some of the pass-through of the higher energy costs by producers will start increasing and start showing up in data. And, in this projection, I'm not even accounting for adverse weather events, El Nino, etc., to happen. So clearly, in my mind, the number on inflation seems higher. On growth, I think it's too early to kind of, predict. Of course, the starting point for growth seems very good, given the data that we were tracking up till February. But the impact on growth can be very non-linear if we, end up in a situation after 2 weeks where this ceasefire doesn't hold.
All right. Neeraj, Kambir, interestingly, we had the RBI governor making it very clear these current forex measures, including capping the net open position at 100 million daily starting at the end of April. It is not permanent. I mean, what did you read? How did you read that? Do you think it could be reversed? Is there some representation from the industry that has been taken into consideration, or what did you make of it?
I don't think there's any representation from the industry to say that this should be reversed anytime soon. I think, if anything, the issue currently at hand is, an orderly unwind of the arbitrage positions that the banking system has, kind of built up. We've seen some bit of that unwind happen in the recent days, and I think some more will happen. Markets, after yesterday's events, have calmed down a little bit, which is making it easier to unwind these positions at lesser impact to the P&L. But what happens over the medium term, whether we come back to the full, integration between the two markets as we had done over a period of last 5 years, I think it remains to be seen. To me, the fact that Reserve Bank sort of thought of breaking this link at this point in time, I think also tells me that we need to see a considerably longer period of stability in the currency market before some of these measures can be reversed.
I see. Mr. Lalit Tyagi, let me quickly bring you in on some of these non-policy measures as well. First, of course, on the capital norms, when RBI says that, they'll probably do away with that 25% NPA provision deviation condition for the calculation of capital quarterly profits in capital adequacy. How much additional relief does this really provide? And also the doing away of the investment fluctuation reserve. How much capital will it unlock for you?
So I think both these measures are positive in terms of the banking system's computation of CRAR as well as the provisioning requirement on account of IFR. And both have their own individual logics also, which RBI Governor has specified in their press conference. Look, the removal of the computation of NPA provisioning while taking into account the quarterly profit into CRAR brings the harmonization and also clarity. So now banks are no longer attached to the botheration of computation of whether their NPA provisionings are going up 25% of the previous 4 years quarter average. So that brings a little bit more clarity about their capital planning. And second, as regard IFR is concerned, this is a very pragmatic approach. Banks are already maintaining enough capital for the market risk as well as the MTM, charges on account of the revised guidelines, investment guidelines which have come. So post that, I think they might have thought that, no longer IFR reserves a requirement. And I think it's a pragmatic approach, I would say.
But is there any quantum you could put to how much capital that the two measures put together would unlock?
right now we are in the silent period, so probably I will prefer not to quote any figure.
Okay, got that. Mr. Soumyakanti Ghosh, what next from here? I mean, if you read between the lines with the kind of forecast that we've seen, are we in for a prolonged pause? What next?
No, I think, Ritu, there will be a prolonged pause in the policy rate. And just to highlight on the assumptions which has been made in the regarding the inflation rate, I think our inflation projections were at 4.5%. So I think the 4.6% is a reasonable assumptions. Growth at 6.9% could be a little lower if even if things come back to normal in the next 2 to 3 weeks, because the war infrastructure will take time to rebuild. So that's one thing. The other thing is that regarding the measures which the central bank has taken in terms of cooling down the foreign exchange market, how long that remains, and also the fact that because at the end of the day, the problem is actually on the capital flow. So as long as you don't address the issue of capital flows, I think the pressure on the external sector will remain. So it remains to be seen how this scenario unfolds in the future, because having a balance of payment maybe for the 3 successive years, including the next year, I think that is something which needs to be addressed into, so that we can have a holistic view on the exchange rate, an orderly and holistic view of the currency.
Mr. Neeraj Gambhir, the same question to you. I mean, what next? The bond markets didn't react much after the policy. In fact, on the back of the geopolitical developments, we already saw the bond yields cool off to under 7% kind of levels, but not much of a reaction after the announcement. What are the markets pricing in?
So there's a considerable amount of uncertainty how life evolves from here. I mean, of course, there has been a truce or ceasefire that has been announced for 2 weeks. We don't know what happens at the end of 2 weeks. So considerable amount of uncertainty on how the geopolitical situation plays out, and consequently what happens to commodity prices and crude oil prices and the entire shipping and logistics impact, which affects not just crude, but a whole lot of other commodities as well. So all these uncertainties are currently out there. For me, what was significant was the fact that the governor emphasized the fact that we are neutral, which basically means that we have the option of moving either side depending upon the evolving situation. So I would not actually say that this is a prolonged pause. I think we have to, it's an evolving situation. Depending upon what happens to the commodity prices, depending upon what happens to the currency, the monetary policy can actually swing on either side pretty quickly if required. And as we've seen that in the past as well. So I think we need to remain open to that sort of possibility, which is what the bond market is also currently doing. I think the bond market is basically saying that, yes, we take cognizance of the fact that the truce has been announced. Yes, we take cognizance of the fact that crude oil prices have come down as a result of that. But that uncertainty is still out there, and which is what the market is sort of pricing it.
Sure, there is uncertainty, but Neeraj Gambhir, I mean, when you're saying neutral stance, of course, means it could go either way. What is the possibility? I mean, a cut is pretty much out of the question at this point.
It is out of the, I mean, of course, if I were to take a call, I think a cut is probably a very low probability even going forward. Never say never, but very, very low probability even going forward. A hike is probably a higher probability if the currency remains unstable and, at some point in time, the RBI thinks that they need to use the monetary policy tool. But I think the bar for that is reasonably high at this point in time. So yes, it is potentially, either ways, but really possibility of a hike if the currency becomes very unstable.
Well, speaking of the currency, and Sakshi, if you'd want to come in on this, the MPR has assumed currency averaging about 94 to the dollar in FY27. What is your own internal estimate? And, how realistic do you think this kind of a level is? We're below 92 at the moment, but it is an uncertain environment.
Yeah, absolutely. I mean, I agree with you. I mean, 94 to 96 is the kind of assumption that we are working with for FY27 right now in a base case. But honestly, I mean, we are just in the first few days of this fiscal year right now. I think that, we don't know the amount of risks or volatilities that we are going to face if it is not the, West Asia conflict, where the market again starts thinking about the impact of AI. We'll also have the US midterm elections. I mean, there there are just too many, I think, uncertainties that are floating around at this point. So my broader sense would be that yes, right now it does seems fair to assume that given the pressure on the current account, where we are assuming that the current account deficit will be closer to 2%, and even if I assume that the balance of payment is perhaps neutral at best going into FY27, the pressure on the currency is still going to be there, right? I think it is just the extent of depreciation that is uncertain at this point, and the pace of depreciation. I think just on the rupee, I must kind of emphasize one of the the comments that the governor made in his monetary policy statement today, where he seems to be indicating to my mind that yes, we are not targeting levels, but his comment around the fact that India did have strong domestic fundamentals, but the rupee continued to depreciate much more, and therefore they will come in and try and curtail volatility so that at least the rupee aligns with domestic fundamentals. I think that was a very a strong statement indicating that the RBI will not let the rupee endlessly depreciate, and there is a sense that they want to kind of maintain stability.
Okay, finally, Mr. Lalit Tyagi, to close the discussion with what you've made of in terms of what next. For Bank of Baroda itself, is the repricing part done? Have the cost of funds bottomed, do you expect? And do you expect some upward movement as we see those rate hikes subsequently on your margins as well? Mr. Lalit Tyagi?
I think, yeah, am I audible?
Yes, go ahead.
Yeah. So I was saying that FY26 have ended for the banks on a good note in terms of the credit and deposit growth. And I think margins appears to be stabilized because, the deposits repricing have largely happened. FY27, probably we have to see what kind of, interest rate objectives need to be there. But I think on the deposit side, probably we do not see any upside pressure in terms of interest rate hike, because I think looking to the market volatility, depositors are coming back to the banks, and that is appearing in the traction in the deposit growth. I feel that going forward also, probably banks should be in a good shape.
Right. On that note, Sakshi, Mr. Soumyakanti Ghosh, Neeraj Gambhir, Lalit Tyagi, thank you all for joining us here and helping us parse through the monetary policy announcement today. We appreciate your time. On that note, we have to bid you goodbye on this special coverage of the monetary policy, but stay with us. More news and updates will continue after a short break.
A two-week ceasefire decision and hopes of an agreement between the US and Iran to end the war sparks a big relief rally. Realty and auto stocks lead the charge while IT lags.
RBI opts to wait and watch how the West Asia crisis pans out. It keeps interest rates and its neutral stance unchanged, but trims its growth projection with FY27 GDP growth seen at 6.9% versus 7.6% in FY26.
The RBI also allows banks to count quarterly profits in their capital adequacy and dispenses with the investment fluctuation reserve, giving them a capital boost, while NBFCs get access to the call money market for their liquidity needs.
Crude oil prices see a sharp drop to the low 90s from near $110 per barrel a day before, heating oil and gasoline prices to plunge while gold and silver gain. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan, and with me as always is Hormaz Patakia, who's standing by at the wall. It's been a really good day for the markets, a two-week ceasefire, oil prices falling, and the RBI's neutral stance staying. All of that boding well for the markets. The Nifty up 845 points. The mid-cap index 2,236 points higher. And the Nifty Bank seeing quite the rally, 2,700 points in the green. But let's go across to Hormaz, who's going to decode what's happening in the markets. Hormaz, every sectoral index also in the green today.
That's the color of the day, and the bulls will be really relieved to see that kind of green that you're seeing on the screen today. The Nifty crossed 24,000 intraday, but is struggling to find some momentum beyond that. Nonetheless, it's still an 850-point advance that you're seeing on the index. The Nifty Bank was a bigger underperformer in March compared to the Nifty, and therefore it is seeing a bigger recovery from the lows. A 5% gain on the Nifty Bank, almost 2,700 points higher, above the mark of 55,000. We're talking about 54 in the morning, so you're well above 55. The currency has appreciated now at the highs of the day, and the bond yields continue to remain at lower levels below the 7% mark, and that has translated into gains for the PSU banks. We'll get to that in just a bit, but take a look at the contributors here. The index heavyweights doing their job. Reliance is putting its foot forward, as is HDFC Bank, as is ICICI Bank, and L&T, that beaten down name because of the West Asia crisis, is seeing a rebound as well, almost 8% higher on the stock. You take a look at the other top Nifty movers beyond the contributors. Shriram Finance is now up 11% as we speak. The Indigo is 2. The cool off in the oil price is a positive for them. Some other positive triggers emerging as well. 10% higher for Indigo. Tata Motors passenger vehicles, also another beaten down name, doing fairly well. You take a look at the cool off in the bond yields and the gains seen in the PSU banks as a result. Union Bank is up 7.5%, with Bank of India, Bank of Baroda, Canara Bank all seeing gains in excess of 6% today. You take a look at some of the other beaten down names in the recent past. Pine Labs is up 16% today. JP Morgan had an initiation note, but it was of course on a neutral rating, but the stock still remains below its IPO price. Ashok Leyland is up 12% today. It's the biggest single day gain that the stock has seen in 6 years. And Prestige Estates, after its business update, pre-sales crossing 30,000 crores for FY26, the stock up 9%. And take a look at the impact of the fall in the oil prices. Look at HPCL up 9.5% as we speak. BPCL is up 7%. Indian Oil too trading with gains of around 7%. But on the flip side, the fall in oil prices does not bode well for stocks like ONGC and Oil India. They are some of the names that are bucking the trend. Oil India is down 4%. ONGC has recovered some of those losses from the earlier part of the trading session. And another stock on the index that's not doing well is Coal India. But barring a few names that are in the red, it's a predominantly green screen. The bulls will take this with both hands.
So predominantly a green screen after a long time. Thank you, Hormaz, for taking us through what's been happening with the markets today. But let's go to our top story. US President Donald Trump has agreed to suspend his planned bombing and attack of Iran for 2 weeks, following his threat that a whole civilization will die tonight if Tehran did not comply with his demands. CNBC's Dan Murphy joins us now with the latest updates. Dan, take us through what's been happening between Iran and the US.
Good morning. Well, the Iran-US ceasefire is certainly being felt sharply across the global energy and equity markets today, and specifically in India as well. As you've been mentioning, Indian equities have rallied on the back of the announcement. Brent crude plunging double digits to around $95 a barrel, which is a significant development for India in particular. Of course, given the fact that it is the world's third largest oil importer, a lower import bill directly eases pressure on India's fiscal deficit. And then, of course, there's the reopening of the Strait of Hormuz as well, also stripping out what traders call the war premium from energy prices. If this truce holds, and that's the big question mark at this hour, but if this truce holds, that could feed through into lower domestic petrol and diesel prices for Indian consumers. And then, of course, today, the Reserve Bank of India also holding interest rates unchanged, citing the war's effect on growth. And with that ceasefire in place, the RBI perhaps has more room to manage inflation without resorting to aggressive rate hikes if the deal holds, of course. And all of this is contingent on the truce holding. And we have seen reporting that remains far from certain. Of course, on the Strait of Hormuz, absolutely critical for energy markets and traders out there, Iran says safe passage will be possible, but also added caveats around technical limitations and coordination with its own armed forces. It's language that basically gives Tehran room to define compliance on its own terms moving forward. At the same time as well, Israel also confirmed this morning that the ceasefire does not cover Lebanon, where it's been fighting Iranian-backed Hezbollah. And Iran had, of course, specifically demanded guarantees on Hezbollah as part of any deal. That demand has not been met. So you can see there is still a gap between the parties here. All three key players involved, the US, Iran, and Israel. The next step to look out for, the next flashpoint for markets, is going to be the negotiations that are due to begin in Islamabad on Friday. The gap between the two sides remains enormous, as I mentioned, and this morning, of course, the ceasefire exists on paper, but it's not a lasting truce deal as of yet. It's back over to you.
Dan, thank you for those updates there from West Asia. It's also a good day now to hear out views from ace investor Ray Dalio, who believes that there is merit in looking at the markets with a broader lens. He said that the impact of the ongoing conflict in West Asia will have bigger implications for Asia. Listen in.
If you step back and you see it in the context of the greater whole, okay, there is a world war of sorts going on. So in other words, there are sides to this world war. There are wars. In Europe, essentially, Ukraine and the war with a nuclear power. The United States is a nuclear power and so on. So I think that one has to view what's happening outside of that. What's happening there will have big effects on the Asian region. I think that being investors, if they can step back and understand things like what is the value of money, how will we treat our debt, and will we print money, what will the destruction of conflict be, what will productivity be? All of those things have to be viewed, I think, in that arc.
On that note, it is time for us to head into a short break, but more news and updates coming up on the other side. Stay tuned.
Welcome back. Now, the Reserve Bank of India Governor Sanjay Malhotra marks the resilience in the Indian economy, saying that the fundamentals are now at a sound footing. Listen into what he had to say.
The government has taken several measures targeted at supporting exports and protecting supply chains. The fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook.
Ritu Singh is now joining us with the key highlights from today's policy. Ritu, over to you.
Well, it was a very patient Reserve Bank of India policy. It wasn't a very reactive one to what's happening in West Asia, but you had, as widely expected, a status quo on rates at 5.25% repo. That was a unanimous MPC decision. The stance was also left unchanged at neutral. Now, on the macro forecast, which RBI has given for the first time for the start of this year, for FY27, the GDP growth is seen at about 6.9%, and the inflation for the full year is seen averaging about 4.6%. Now, keep in mind, all these forecasts have been done with a base case assumption of oil remaining at around $85 a barrel on average for this year and $75 next year, and rupee at about 94 to the dollar in FY27. Now, if that does not materialize, this is the base case, we could see growth taking a hit. In fact, that's what the RBI governor alluded to when he said that the West Asia conflict could impede growth if these supply chain disruptions continue for a while. For the first and second quarter, which RBI has given a forecast for growth, it's been revised lower compared to what we'd seen in the previous policy. On inflation as well, it was that because of the recent spike in energy prices and what's materialized, there could be a concern on the inflationary front. It is also for the very first time given a core inflation forecast for FY27 at 4.4%, saying it was a long-standing ask of the industry, and now, of course, it has given out this number. On liquidity, there wasn't much to talk about from the RBI policy. They just said they'll keep sufficient liquidity in the system to ensure that there is orderly transmission. Apart from this, there are some non-policy measures that were in focus as well. Let me quickly take you through them. The first is on capital adequacy norms. So this is now an easier way to calculate, to include your profits in your total capital adequacy calculation. Earlier, if you had a deviation in your NPA provisioning, you could not do it. Now that condition has been done away with. Apart from that, the investment fluctuation reserve, that has also been taken away. So, some release of capital on that front. Importantly, the RBI governor said they'll also come up with a new framework for the categorization of NBFCs into various buckets. That's one to watch out for. And lastly, on the forex measures that have been undertaken recently, RBI making it very clear that was just a reaction to the current situation. These are not permanent.
Ritu, thank you for those updates there, and take a short break for now. Get you more updates of the commodities market after this short break. Stay tuned.
Welcome back. You're still with us on Business Lunch. There have been some big moves in the commodity space today following the ceasefire in West Asia. Manisha Gupta is here to take us through all of the commodity action. Manisha?
Well, the sharp moves in commodities is becoming a norm, but this one really comes in on the back of a 2-week ceasefire that the US proposed and Iran has agreed to, presenting a 10-point agenda which will be negotiated or discussed upon in the next 2 weeks. Having said that, there also is a bit of a clarity that the Strait of Hormuz will open and allow ships to go through, and that immediately has led to a knee-jerk reaction and a correction in case of crude oil prices, where we have seen 12 to 15% of a decline come in for crude. So that immediate geopolitical premium that had built up in case of crude prices seems to have been coming off. While of course we started before the war conflict, the crude prices were at 70, but markets believe that's a level that you would not see so quickly, and 85 to 95 perhaps is going to be a range that crude prices will continue to hold on to. Not just about the crude oil prices, but we have seen a reaction come in for the metal prices also. Gold and silver, which have been behaving not as a safe haven, but more as a financial asset class, have gained, as has been the risk appetite coming back. So gold is up 2%, back at $4,800 an ounce. Silver gained up by 5% in the Asian markets right now. And for the metal prices, aluminum has seen a bit of a decline because aluminum was an outperformer when the Strait of Hormuz were shut and there were damage onto facilities of smelters and mining there, because 10% of global aluminum comes in from Middle East. So aluminum has gone in for some profit taking, but gains have come back in case of zinc and copper, as markets believe there would be some reconstruction activity as well coming in, and that clearly seems to be supporting these couple of metals.
Manisha, thank you for those updates there. Now speaking to CNBC about the 2-week ceasefire, Willie Walsh, the Director General of International Air Transport Association, says that it is a challenging situation for the airlines and the immediate concern around the jet fuel supply in Asia, followed by Europe. Listen in.
The immediate concern is around supply in Asia, followed by supply in Europe. I don't think Europe is in the same situation as Asia quite yet. About 80% of jet fuel for Asia comes through the Strait of Hormuz, which has been closed. Good news in the past hour that there is a temporary ceasefire and that oil will start flowing through the Straits of Hormuz again. So hopefully that will provide some short-term relief, and we've seen that in the price of crude oil, which has fallen significantly in the past hour or so. So it's a challenging situation, but the thing you've got to remember is fuel in effect is a variable cost. So the fact that airlines will cut capacity can be for two reasons. One, to reduce their cost exposure to oil, and secondly, to mitigate against the potential shortage of jet fuel supply.
Interglobe Aviation is the top gainer on the Nifty, surging 9% following a sharp drop in crude prices after the ceasefire announcement. The hike in aviation turbine fuel prices was also lower than expected. Sudarshan Kumar is here to tell us more about what's aiding the stock. Sudarshan?
So over the last few weeks for crude prices, it was a one-way move. A recent hike, Brent had hit of almost $120 per barrel. But thanks to the ceasefire announcement between US and Iran, because of that, today there is a sharp fall in the crude and Brent is back below $100 per barrel. Now, remember, ATF forms almost 40% of total cost for aviation companies. And Indigo being the largest domestic carrier, it's going to benefit from the fall in the crude price. And that's the reason it's higher in the trade today. Another positive that has come, that ERA, that is the regulatory body for aviation companies, they have announced a cut in the landing charges and parking charges by 25%. That also going to benefit. Another recent announcements, if you talk about, recently government had announced an increase in ATF charges, and those charges were increased by almost 8.5%, but it was much lower than expectations. Analysts were expecting an increase in the range of 50 to 100%. So there also it's benefiting Indigo. And after ATF increase, this fuel surcharge was increased by Indigo, and that increase was for both domestic as well as international routes to cut the cost. So considering all the factors, Indigo is amongst top Nifty gainers today.
It indeed is. Sudarshan, thank you for that update there. 9% higher on Indigo now, back towards that 4,700 mark is where it's headed. You take your leave on this edition of Business Lunch. We leave you with the markets close to the highs of the day, back towards that 24,000 mark. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always Vivek Iyer. Vivek, good afternoon. Some relief rally which has come by and this is something which has led to Nifty crossing that 23,900 mark quite comfortably. Across the board, it's a green looking screen and we've been talking about it since the word go. And a lot of sectors, some sigh of relief across the board.
Good afternoon, Sonal. Absolutely nothing to complain about as far as today's trading session is concerned. All of the indices, bright green, very sharp relief rally is what we are seeing. And especially the mid-cap and the small-cap space, most of the beaten-down names are seeing significant buying, especially with good volumes as well. But a lot lined up on the show, so let's start off with the top headlines. A 2-week ceasefire decision and hopes of an agreement between the USA and Iran to end the war sparks a big relief rally. Realty and auto lead the charge, while IT lags.
Companies with direct West Asia exposure see recovery in trade. Shares of KEC International, Kalpataru Projects, ABB and Siemens Energy see significant gains.
OMC and Paine stocks surge as crude oil prices see a sharp drop to the low 90s from near $110 per barrel just a day before.
RBI allows banks to count quarterly profits in their capital adequacy and dispenses with the investment fluctuation reserve, giving them a capital boost, while NBFCs get access to the call money market for their liquidity needs.
Shares of Angel One and PN Guardrail rise in trade on positive business updates. Angel One sees March average orders rise 7.4%, while PN Guardrail's revenue surges multifold, driven by strong festive demand.
Okay, those are the top headlines that we're tracking. Of course, market continues to be the big story. A big uptick across the board and all the sectors are in the green. It is very close to the 24,000 mark, up around 900 points as we speak. And as Vivek was mentioning, it's the major action that we're seeing in the mid caps and the small caps, considering that a lot of beaten down names have taken off. So this is our special segment, Mid Cap Movers. We have Ria to take us through the mid caps that are moving around in trade. Ria.
Well, yes, let's start off with the top sectoral gainer. First, real estate stocks are on fire today, with the realty index up nearly 7% today. Leading the gains is Aditya Birla Real Estate. The stock is reacting after the company clocked nearly 1,600 crores in bookings within just 1 month of launching its project in Gurgaon. Prestige Estates is also up in trade today after reporting a 76% jump in its FY26 pre-sales to over 30,000 crores. And apart from these two, Lodha, Sobha Realty, as well as Phoenix Mills are also all performing well in today's trading session. Moving on to the auto sector, though, the Nifty Auto Index is also up sharply, around 7% today. Stocks like Ashok Leyland, Motherson, Tata Motors, PV, Uno Minda, as well as TVS Motors, all up in trade today. And among other gainers, there's HPCL, BPCL, both are gaining in trade, tracking the sharp fall in crude oil prices. And financial stocks like L&T Finance, Max Financial, as well as AU Small Finance Bank are also seeing buying interest today. On the flip side, if you look at the losers in today's session, oil and gas names are under pressure. Oil India as well as Coal India are declining after a US-Iran ceasefire triggered a sharp fall in global oil and commodity prices. And finally, among some other losers, stocks like Nalco, Lupin, as well as Zydus Wellness are seeing some profit booking today.
Okay, thank you so much, Ria, for joining us and giving us a sense of all of the top movers as far as the broader end of the markets are concerned. But it's a very good time to welcome Ashish Kyal from Wave Strategy for a quick technical check on the market. Well, Ashish, absolutely nothing to complain about as far as the move today is concerned. Where do you see the Nifty headed from your end?
Hi, afternoon to you and all the viewers. So there is no complaint about since 3 days actually. If you look at it, Nifty after forming a low at 22,180 level, gave a very strong move over the past 3 days itself. And when we were discussing here on 2nd of April, I mentioned that Nifty managed to fill the gap for the first time on an intraday basis, which happened on 2nd of April. So that was the first sign of reversal. And yes, of course, today with a stellar move of more than 3.5% on Nifty and then Bank Nifty contributing more than 5%. It's a fantastic move that we are seeing here. Having said that, the overall tone for Nifty, Bank Nifty both remains positive, but buying here at these levels for short term does not provide a good risk reward. So my view will be any dips that we get on the downside towards the level of around 23,820, 23,780 can be an opportunity to re-enter and aiming for the target of around 24,300 and 24,400 levels. very important thing to observe is that the open interest, if you look at the profile, is showing very sharp rise at 24,000, both the calls and the put sides, which means that there is some kind of tug of war that's going to happen at this 24,000 psychological level, and crossing above that 24,050, 24,080 might trigger another short covering from the call sellers of 24,000.
Okay, all right. Take that point, Ashish. So on the upside, you're looking at levels of 24,300 to 24,400 on the Nifty. Any dips can be bought. But Ashish, then what do you buy or what do you sell at these levels if we talk about individual names?
So it's best to avoid selling because we are seeing a systematic buying. We saw systematic selling few days back. So the stock that are breaking out right now are something like capital market stock BSE. We can clearly see a very strong breakout in today's session. The stock is up by nearly 7-8% right now, but there is a lot of potential from here on as well. And we can expect the stock to reach towards a level of around 3,400 on the upside, and stop loss can be maintained at around 3,100 on the downside. The next stock on the buy side is going to be Delivery. Again, it formed a very classic inverted head and shoulder pattern, gave a breakout above the neckline with a gap, and sustaining there. The volumes have picked up significantly well. So one can create long positions in Delivery, aiming for the target of 485 and maintaining a stop loss of around 447 levels.
Well, thank you so much, Ashish, for joining us, giving us your view on the markets as well as your individual trading bets for the day. Remember, most of the stocks doing quite well in the session. But earlier today, we caught up with Nilesh Shah of Kotak Mahindra AMC, who shared his market outlook view amid the ongoing geopolitical tensions and outlines the sectors which he expects will outperform from here on. Let's listen in.
Availability of oil and gas is important for many of our industries. And finally, if price of oil is on the lower side in double digits rather than triple digit, that's positive for Indian economy. On the pessimism side, at 18 times forward earning, we were trading at premium to other emerging markets. That can't be called pessimism for sure. We were not trading at 10 times forward like we traded in COVID 20 time. That probably can be called pessimism. Market is like a juggler. The focus is always on the ball which is falling, not on the ball which is going up. The March quarterly earning got impacted by 1 month of war, but the secondary and tertiary impact could last into June quarter. So people will be interested to know how June quarter earnings will get impacted by ongoing situation. For last almost 10 calendar years, Nifty has delivered positive return. This is one of the longest streak. No one complained that, oh, Nifty didn't give any negative return in a calendar year. In equity market, that should have happened. Now, you have made money for 10 years. Maybe 11 years, you'll have to be happy with no return. We think banking and financial services is one sector where valuations have corrected. Maybe there will be some impact on their margin for the March quarter. But thereafter, FY27 earnings growth should be double digit. The second sector where one could look at is domestic focused consumer discretionary. If oil prices come down in double digit, then there will be beneficial impact of all the steps taken by government. So consumer discretionary space, maybe it's the summertime. So first consumer durables, then probably airline, travel, tourism, which has been hit very hard because of this geopolitical situation, and maybe thereafter healthcare and hospital. So this will be the consumer discretionary plus banking and financial services sector, which should outperform the market.
Well, BFSI and consumer discretionary is what Nilesh Shah expects could outperform going forward. It's a good time to slip into a short break. We'll get to the key buzzing stocks on the back of Q4 business updates and the impact of the ceasefire on the other side. Stay tuned.
Welcome back. Still tuned in a mid-cap radar. A lot of quarterly updates which are coming by. So let's talk about them now. Phoenix Mills is the one that I'm tracking. Their quarter four update, especially on the mall side or the retail side, was quite strong, on the back of which the stock has surged 8% in trade today. In FY26, they saw all-time high retail consumption of 16,578 crore rupees, which is up 21%. And in quarter four, the consumption was up 31% on a YOY basis to come in at 4,251 crore rupees. Across the portfolio, they saw double-digit consumption come by, and that was recorded for the year as well. In the commercial segment, in FY26, they added 2.8 million square feet of Grade A offices across Bengaluru, Chennai and Pune. The total portfolio size now is 4.8 million square feet for the company, and the occupancy is at 70% as of March 2026. For hotels as well, their revenue per room, per rental saw growth of 6% in quarter four and 7% in FY26, and their occupancy was at 86%. This is St. Regis that we are talking about. And in their residential segment as well, their gross sales doubled on a YOY basis in FY26 to come in at 471 crore rupees. But of course, the bunch of their business comes in from malls, and that's where the company has done well this time. Consumption is doing well. Of course, management commentary on what's happening now will be key to watch. But so far, it has looked okay for Phoenix Mills, and that's why the stock is higher in trade.
Well, Sonal, you've looked at Phoenix Mills, more of a consumption play retail, but another company, Prestige, that too is doing quite well in the session. What's driving that higher?
30,000 crores in sales in FY26 itself, and I think that's an industry high, and this is the first time the company has crossed that mark as well. It's a 76% growth, and remember, yesterday on the show we were talking about how a lot of companies have spoken about West Asia war impact and not been able to meet their guidance. This company has actually overdone that, actually surpassed that as well. So it's a strong showing from Prestige Estates. If we talk about their quarter four sales, it's up 10% on a YOY basis. So a lot of these sales were seen in 9 months itself. But company talks about sustained traction across key markets. They have seen sales from new launches and ongoing inventory. And first time that the company has crossed 30,000 crore rupees in terms of sales. And we are still awaiting, of course, Godrej Properties numbers. If they do not cross 30,000 crores, so this would be an industry high again. They are optimistic about sustaining this particular momentum in the coming year as well. So strong update coming in from Prestige Estates, and this is at a time when industry is suggesting there is some slowdown in the residential real estate market. We've been talking about it. So yes, this has come in as a breather, 9% higher on this one.
Well, thank you so much for that. We remember, yesterday we were talking about a bit of a slowdown, especially if Q4 is concerned. So this definitely comes as a relief, like you just said. But another sector that's seeing quite a bit of a relief rally is the entire fertilizer and chemical pack. Remember, significant supply chain disruption is what led a lot of these stocks to lose momentum. But Ria now joins in with an analysis of what's driving these stocks higher today.
Well, yes, the entire fertilizers and agrochem space is performing well today, and let's understand what the impact is of these new developments and specifically the reopening of the Strait of Hormuz. Now, first of all, this will normalize the availability of urea, ammonia, phosphates as well as sulfur, and for urea specifically, remember that roughly 20 to 30% of India's urea supply passes through the Strait of Hormuz, so that will be a key positive. Apart from this, we will also see a cost correction in the primary feedstock, which is natural gas as well as sulfur. Freight costs will also be cut materially for these companies, and we will also see better output once the LNG supply resumes for these companies, since LNG is the primary feedstock for ammonia and urea. Now, in terms of the specific financial impact on all of these companies, we will see some easing of gross margins as well as volume recovery for them. The working capital cycle will also ease out, and the inventory losses that the companies had incurred, those will also see some bit of reversal. But it is important to remember that complete supply chain normalization will happen gradually, but the immediate price impact is the immediate relief for these companies. Now, apart from this, all of these companies, Coromandel, Pardeep, Phosphates, Chambal Fertilizers, even the likes of RCF, UPL and PI Industries are all performing well today on the back of these developments.
Well, thank you so much, Ria, for joining us and giving us a sense of what's driving the fertilizer agrochem pack ahead or up in the session today. But one particular sector or a couple of sectors, that have clear direct exposure as far as West Asia is concerned or to the GCC region is concerned. Today, a lot of them are seeing significant relief rally. We've spoken about L&T, almost a little over 35% of the order book coming in from there. But some of the other names that we'd like to focus on, of course, remember KEC International, 20% order book from that particular region, almost 28% of order inflows of FY26 coming in from there. Kalpataru, 11% order book exposure there and 2% of order inflows. But remember, they are L1 or lowest bidder in a lot of projects that's being tendered as far as FY26 is concerned. The other set of stocks that we will be keeping an eye out for, of course, is the rice pack. A name like KRBL, remember, derives approximately 60% of its annual revenue from exports to this particular region. And apart from that, some of the other names today that are doing quite well, of course, names like Vatek Wabag, ABB India, Siemens Energy, Triveni Turbine, a lot of these names, as you can see on the screen, Vatek Wabag up over 5%, Apar Industries up over 3.5%. All of them either have direct exposure or have significant supply chain movement, especially through that particular region. On the back of that, most of these stocks seeing a bit of relief rally.
Some relief that has come by. That's been the case across the board, right? We've been talking about it. We'll slip into a short break now, but when we come back, we'll get to more on the markets and stock-specific action as well. Stay tuned for that.
Welcome back to Midcap Radar. Well, there's some exclusive information that we're picking up from our sources. We've spoken to various industry experts, people who look at tendering activity across various projects, and we're talking about capital goods space, and we're talking about thermal power plants. So we spoke to a whole host of analysts who track this particular space very closely, as well as industry experts. What we are picking up is that in two large projects, Larsen & Toubro has emerged as the lowest bidder, and the total value of this particular project will be in excess of 22,500 crores. So which are these two packages are? The first one, of course, is a thermal power plant of NTPC. The name of the power plant is Lara, and it's a super thermal power project that is based in Chhattisgarh. The other project, of course, that L&T has emerged as the lowest bidder is for the Damodar Valley Corporation, that is the DVC-CIL joint venture project in Chandrapur. Again, this particular project is in Jharkhand. So again, this is a meaningful project even for L&T, even with the order book in excess of 7 lakh crore. Now, the other and quite interesting order win that's likely to come about is for BHEL. BHEL has emerged as the L1 or the lowest bidder for a package which is valued in excess of 10,000 crore. Now, this particular project is for expansion of Odisha Genco thermal power plant. And, this is an expansion project where with this particular order win, in case, BHEL is confirmed as the L1 bidder, the total order inflow for BHEL or the total L1 status for BHEL will exceed 40,000 crore. That's a significant order book impact as far as BHEL is concerned. We've reached out to both L&T as well as BHEL. We are awaiting a response from both of these companies, but what we are picking up from our sources is the lowest bidder status in large thermal power projects that India is currently developing.
Okay, all right, interesting. So that explains the move that we are seeing as well, but of course we are still awaiting comments from these two names as well. For the markets, it continues to be a good day. The VIX or the volatility index is down 20%, so it gives a sense of the market moves that we are seeing. Mid caps too are doing really well in trade, but with that we'll take your leave on this edition of Midcap Radar. Stay tuned, your stocks when we return to answer all your individual stock queries.
Hello, good afternoon. You tuned into Your Stocks coming live from the CNBC TV 18 Motilal Oswal Studios. I'm Vinny Motiwala. With me is my colleague Arundhati as well. Arundhati, good afternoon and a good day coming in. We were waiting for some positive news. Ceasefire. Finally.
Biggest news of the day.
Biggest news. That's the only news.
Yeah.
That's why the markets are green. Everything is trading in the green. Whether on the humanitarian front or even for the stock markets across the globe, we're seeing good moves coming in. And look at the Nifty itself, right? 3.5% gain in the trading session. All the indices trading in the green. Nifty IT, which is trading with the least amount of gains, we could say. That's also 0.3% of gain still coming in there. Advance decline ratio in the favor of advances. I mean, it's a good day. But nobody's complaining here today. And we're just waiting for the next 15 days, Strait of Hormuz update. That'll be key now from here on as well.
Absolutely. Seeing whether that Strait of Hormuz remains open, whether they open it up for all of the ships to pass through will be key to watch. But everything in the green, global markets in the green, Indian markets in the green, all of the sectoral indices are higher today. We've got the Realty Pack that's doing well. That index is over 7% in the green. We've got the Auto Pack that's also doing well, 6% higher. And if you take a look at PSU banks, you know, they've recovered from yesterday's lows, and they're also doing well. So all in all, every stock in almost all the stocks in the green today, all the indices in the green.
Let's not forget RBI monetary policy also.
Absolutely. That was also a key thing to watch out for, and their neutral stance, maintaining it was also a good thing for the markets.
A good thing. So yes, that's what's happening here. But let's get started with the show then and solve all our viewer-related queries. First up, we have our guest joining us, Saumil Mehta, Head of Retail Research at Mirae Asset Sharekhan, as well as Sneha Poddar, VP Research Wealth Management at Motilal Oswal Financial Services, to answer all your stock-related queries. Saumil as well as Sneha, good afternoon. Thank you so much for joining us on the show as always. And let me get started with the first query then for today. We have this coming in from Arasu, who is writing to us from Bangalore. Wants to know actually recommendations that he wants for data center stocks that one could look to invest in. Sneha, any names that you can suggest here that one should be looking out for a data center story? We do have obviously real estate names, some of them. We had some of these IT-related names also, which really did see a run-up during the AI data center run-up as well. Any names that you would look out for?
Hi, good afternoon. See, data center opportunity is kind of becoming a structural shift and not just a trend which will fade off. So with the structural shift which is happening, we're expecting the overall capacity to double by FY27 end. And what we would really like to play in this is, rather than holding on to the the data center owners on the real estate front, it's better to play it out through power and the cooling installation companies. So my bet would be on Cummins India. Because it has the, it offers a high capacity backup power segment, which is the generators which is required, because data center will be requiring a lot of electricity demand, and thus for that, Cummins India will play a key role. They are one of the market leaders in the genset, and they have about 70 to 80% localization, so that gives them a lot of advantage. Another option which can be viewed is Siemens Energy, which plays a very important role in the power T&D segment, and thus they would be an ancillary play to a data center theme. So these two companies I would like to really recommend if one wants to participate in this theme.
So you've given us two of your the stocks that you think that he could look at. But Saumil, let me come to you. Any data center stocks that Arasu can invest in? Any technical levels to watch for? Any stocks that he can enter at this point in time?
At this point of time, I think data center stocks very specifically we don't have in the market. Very few of them, probably Anantraj or some other stocks like DataNet or something like that. But I would agree with the co-panelists that we should look for stocks which are supporting this overall theme, like Cummins or Siemens. I would like to add one more, which is KEI. KEI is also a very good, company where we have support to these kind of data center themes, and that would be my pick. The stop loss would be around 4160, which is the 200 daily moving average. It has just broken out of a small consolidation. I'll be expecting the stock to do really well in the medium term. In the long term, my medium term targets would be around 5,200, 5,300 levels.
All right. So KEI Industry, Siemens, Cummins, those are what y'all are looking at and are good stocks to enter. But let's go on to our next query. Udit is writing to us from Mumbai. He holds 8,000 shares of Quality Power at 850 rupees. He's making a profit on that stock currently, and he wants to know if he should continue to hold or sell the stock at current levels. So, Sneha, let me come to you first. What's the fundamental view on this stock, and what do you make of it? Should he stay invested?
Okay, we do not cover the stock, but just having looked at the Q3 numbers, they were really healthy, and we saw a good operational growth for the company in Q3 numbers. Basically, it is it is transitioning towards the green energy, which is driving the growth. So my suggestion would be though we do not cover it, but it's a good long-term bet on the power side. Overall, the power theme is doing really well, and the requirement coming from the data center will actually keep the power and power-related stocks in demand over the next few years. So structurally, fundamentally, the stock looks good. Valuation-wise, we'll have to really see whether it's expensive or not at the current levels.
Okay. Saumil, your view for Quality Power is Udit has bought it at 850 rupees per share. Currently at 913. What are the levels that he should keep an eye out on?
Great pick. Great pick at the right time. Making high tops, high bottom on the daily, weekly charts. Great setup. Monthly, medium-term outlook, long-term outlook looks great to me. There are some support around 760, 750 is a very, very crucial support for this stock, where 200 daily exponential moving average is. But overall, I think my targets would be 1040 in the medium term outlook, and in the long term, I think it would go above 1100, 1150 levels.
Okay. 1100, 1150 levels for Quality Power, so can continue to hold also. Let's move on to the next query then. We have Manoj, who's writing to us from Noida, holding 110 shares of One MobiKwik. This is at a price of 360 rupees per share. So currently they're facing the brunt of the fall that we've seen coming in for this stock. Long-term story for One MobiKwik, where does this stand at? Can they continue to hold this one? Sneha, your view.
Okay, sorry, we again do not cover the stock, but just very broadly, in Q3, they had managed to turn profitable, but the overall, revenue growth was just 7%, which was largely driven by the platform fees and the interest on loans. What is the real problem is the payment gateway cost, which, comprises almost 40% of their overall expense. So that is resulting them in struggling at the margins level. So, one can probably hold on from the long-term perspective, but I would suggest to wait and watch and not average it out at the current levels till at least some sort of stability is seen in the stock.
All right, Saumil, if I could come to you. So One MobiKwik, he's bought at 360 rupees. So what do you make of the stock? Should he stay invested? Should he, exit the stock?
Yeah, I think it's in the downtrend, and I don't see any reversals at this point of time in the medium-term outlook. In the very short term, there's a bounce, definitely a bounce. The bounce could go till 192 levels. That would be a very, very crucial resistance to look at. If it sustains above 192, then the next level would be around 208. But I'm not looking for 208 levels as a target, because there are a lot of resistance here on the charts, and my view would be negative.
All right, so view is negative for that stock. But our next query coming in from Sandeep, who's writing to us from Bangalore. He holds 1,200 shares of Eternal at 288 rupees and is currently making a loss on the stock. Eternal is now at 243 rupees. That's where it's trading at. And he wants to know if he should continue to hold or sell. Sneha, let me come to you first. What's the fundamental view on the stock? What are the long-term prospects for it?
From long-term perspective, we are positive on Eternal, and we believe that the overall, the fundamental structural story remains intact. Basically, Blinkit became EBITDA positive recently, and their core food delivery business is doing well. It's growing at 15 to 20%. Now, the the watch would be on the Q4 numbers, which is likely to get announced on April 30th. And though we are expecting about 207 crores of profit, which is almost double of 102 crores with what was seen in Q3. And we believe that the overall Blinkit's grocery expansion will continue to drive the growth for the company. But there will be few key things which we'll watch out on the from the con call. One would be on the in the management's take on the competition intensity and the Blinkit volume share and the overall their strategy with regards to quick commerce given the heated competition. So for us currently, I would say hold on to it. We are really bullish on the company, but we'll actually watch out for the management commentary, and then one can take a call to average it at these levels.
Okay, and Saumil, your view for Eternal, what should the viewer do? They bought it at 288.
In the very short term, yes, there is a bounce. I would not deny that, and there's be a very strong resistance around 245 and 255. So that zone is very important. Overall, the trend is still negative in the medium term outlook. So I'll be looking for downside levels of around 200, 195 levels. So wait and watch. I would not suggest to go short, but wait and watch. For a long-term story, looks great to me, but buy on decline should be the strategy around 200 levels.
Okay, buy on decline should be the strategy for the stock, but as of now, hold on to the stock. That's the view coming in there on the technical front as well. On that note, we're going to slip into a very short break. We'll come back with more of your stock-related queries, but a quick check in terms of the markets also, and a quick check of what is happening there. As of now, what we're seeing, more stocks, obviously, most of the stocks trading in the green versus the red. We have a few 8 names that are trading in the red in the Nifty 50 as well. Leading the chart is Freedom Finance, Adani Enterprises, Tata Motors, PV, while on the flip side, Coal India, Techem, Nestle are a bit on the laggard side. But yes, on that note, a quick break. We'll be back with more.
Welcome back. You're still with us on Your Stocks, and we still have with us Somil Mehta of Mirae Asset Sharekhan and Sneha Podar of Motilal Oswal Financial Services to answer all of your stock queries. So the next query is coming in from Kashyap, who's writing to us from Karnataka, and he holds 1,000 shares of Blue Jet Healthcare at 370 rupees. He is making a profit on the stock, and it's currently trading at 372. He wants to know the long-term outlook on the stock. You know, the last quarter we saw its revenues come down a little bit, but Sneha, let me come to you. What do you make for the long-term view on this stock?
Okay, last time their quarter was affected, and that was largely because of the temporary destocking by the global pharma clients. This quarter we are expecting weak numbers for the company. What management has, said in the last con call was they expect this entire thing to get normalized over next few quarters as the supply chain adjustment settles. What we believe is that Blue Jet is a niche, contrast media player. It's one of the very few global players in this field, and the overall outlook for this segment remains really bright. Apart from this, they are also very strong in the cardiovascular drugs, and where the growth outlook remains strong. In fact, the upcoming Vizag facility and the new R&D center will be focusing on the GLP-1 drugs, which is the new upcoming thing. So the growth outlook remains quite bright for the company, but in the 1 or 2 quarters the strain will be felt. But from the long-term perspective, the company is expected to do well.
Long-term perspective, company is expected to do well. So continue to hold that one. Somil, your view for Blue Jet Healthcare on the technicals also, what are the long-term levels maybe they could keep an eye out on, or would you say better to get out of this one right now?
Yeah, I think the trend is down, and I'm not very positive on the stock. There would be a bounce. The bounce could go till 450 levels, maybe in the very short term, but that would be an exit opportunity for the stock. I don't see any basing out pattern or any reversal at this point of time for medium term or long term. But a 450 would be the best case scenario in the medium term outlook, and that would be an exit opportunity.
Okay, 450 could be the level that you could watch out for, and that would be the exit that maybe Somil would highlight as well for you to get out of the stock. But let's move on then to the next query. We have Jeetu, who's writing to us from Mumbai. It's an investment query. Is it the right time to start investing in TVS Supply Chain Solutions? Sneha, your view on this one?
My suggestion would be to avoid it at the current levels, and this is largely because if we look at the balance sheet, the debt is pretty high for them. So while they are making good operating profit, the strain can be felt at the net profit levels. And if we look at the EBIT to interest ratio, that is less than 1, which is very alarming. So my suggestion would be to wait and watch, let the debt come down a little to the comfortable levels, and then probably one can look at it in terms of entering. But currently we should avoid it.
So currently you suggest to avoid the stock. Somil, what do you make of it? Do you think that it's a good time to invest in TVS Supply Chain?
No, I'm not very positive on the stock at this point of time. It has been, going down in the downtrend for a very long time. It's been struggling to stay above 200 daily moving average. So definitely stay away from the stock. Avoid at this point of time.
So avoid and stay away from the stock. That's the advice coming in there for that particular stock. Now, Pradyumna is writing to us from Andhra Pradesh. He holds 200 shares of UPL at 600 rupees a share. He wants to know the long-term outlook on the stock. The stock is currently trading at 638, but he has made a profit on it. So, Sneha, what's the long-term outlook for UPL?
I'm not really very positive on UPL. Currently the crop protection industry is not doing very good. There's a lot of overcapacity in China, and global pricing pressure is there. Now UPL has a diversified presence both geographically and product wise, so that's why they are somewhat resilient to this, but still the pressure can be felt, and moreover the debt burden is pretty high on their balance sheet, though they are trying to deleverage it, but I would suggest to be on a wait and watch mode. Let the deleveraging come down a little, and let the tide turn in the overall crop protection industry, which is likely to probably turn around by the end of 2026. So the visibility, recovery would be very slow and steady, and thus the visibility looks to be very limited in the near term. So my suggestion would be only from the if the horizon is pretty long term, more than 1 year, then probably one can hold on. Otherwise, better to get out.
Okay, if it's a long-term horizon, then hold. Otherwise, get out of the stock. That's the view there on the fundamental front. Let's move on, and Saumil, your view on the technical front for this one as well. We've spoken before as well, right? Because every time it reaches some of those high levels that you see of 670 odd or 700, above that mark somewhere, and then you see a fall coming back. So what is the story this time? Is it a different story from the chart point of view for the long term?
In UPL, since 2024, start of 2024, the stock was at around 440 levels, and from there it went till till the end of 2025, starting of 2026. It reached 800, 810 levels, almost double within 2 years. It was a great run. Now, in the last 3 to 5 months, I think the retracement which we have seen, the correction which we have seen, a very good buying opportunity. I would be positive. However, in the long run, we may see more sideways correction, time-wise correction around these levels. But overall, I'll be very positive. But be ready to see some time-wise correction and then a move on the upside.
Okay, that's the view coming in there for UPL as well. Important to keep an eye out on those levels over there.
Absolutely. And, before we leave you guys, let's also take a look at how the markets are faring right now. As we pointed out, it's been a good day for the markets. Everything is in the green. The Nifty, as we speak, is 855 points in the green at that 23,978 mark. So very close to those 24,000 levels. We've got the mid-cap index that's 3.8% in the green. And we've got the Nifty Bank that's outperforming the Nifty and the Sensex. It's about 5.3% higher. We had, the ceasefire. We had the RBI announcement, all of that boding well for the markets today. Every index is in the green, and we look at the top Nifty gainers. We've got Shriram Finance, Adani, and Tata Motors, PV at the top of the list. And at the bottom, we've got a few of those stocks that are losing. We've got Coal India, Tech Mahindra, and Nestle. Those are the stocks on the downside. And if you take a look at the sectors, we've got the Realty Pack that's right on top, 7% in the green, and we've got that Auto Pack also doing very well. PSU Bank, Nifty Private Bank, all of those sectors in the green for the day.
Saumil, as well as Neha, thank you so much for joining us on the show. And viewers, thank you so much for tuning in. As always, we will keep solving your queries Monday, Wednesdays, Fridays at 2 p.m. on your stocks. Email us your queries and WhatsApp us your queries, any of the two options that you have available. So do send us your queries and we'll get them answered. Thank you so much for tuning in. Up next, your closing bell to take you through the last set of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Well, markets are up and about. This is Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. 850 odd points. So holding on with all of the gains that we started with and then some. So this is a very, very good looking screen. Very, very good looking Wednesday afternoon. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi. Afternoon.
Hi, afternoon. Bulls are completely fired up. We had a gap up opening. We've held on to it. The Nifty is flirting with that level of 24,000. The Brent crude price is still hovering below $95 per barrel. And we've seen their momentum spread to Europe as well. So frontline European indices have opened straight away with a gain of about 3.5% to 4%. So it's looking strong all around.
Well, that's right. The post-mortem or the post-market data will be very interesting. You know, whether or not the FI selling has cooled off, but it's going to be an extremely big short covering bounce. I'm looking at a few stocks and I'll cover that in just a bit. But many stocks that actually had fallen a good deal, they have come in for a massive short covering bounce. So by the end of today, we'll have to see, I think, the shorts, they would have run for cover in today's trading session. With the kind of gap up that we've seen, a good start, building on to those gains, and hopefully a good close as well, guys. And Prashant's got the color right, a green tie. Good times.
Good times, and let's hope it continues to be good. Although I suspect that a lot of the good has been taken in on day one with this 850 odd point bounce. You know, the morning, the levels that we put out, 24,100 was basically if you project the earlier channel, it's a narrow channel upwards, extrapolated higher, it gets you to 24,100. And we are not very far away from 24,100. So I think at about 24,100 after this snapback, and by the way, the Nifty is up 7% so far this month. Maybe it's not 24,100, maybe it is 24,400 or 24,500, but around those levels, we'll see if there is more steam or this is, I mean, at that level, it would make sense to start to reevaluate. I would say, starting about 24,100, 24,200. So can we continue with this pace is what we'll have to see. The other point is if you can put up that quote, right? The quote from the Iran foreign minister actually, about the Strait of Hormuz. The underlying issue is the price of oil, price of energy, and the price of energy has fallen sharply to 94. Can it go from 94 to 84, 74, right? I mean, what will determine the next $10, $15 on the lower side? Or is 70s kind of is 90s, beg your pardon, around 90, 93, 94, is this the new kind of holding pattern, holding zone now? And how do you answer that question? You can sort of think about it in two ways. One is to say that, as that statement says, Iran is saying that they will exercise control over the Strait of Hormuz. I mean, they said it explicitly. So they're basically talking about most likely a toll of some sort, and the IRGC, which is the Revolutionary Guard, who are in control of the country, dictating who gets to go or not. Will it be acceptable to the US? Most likely no. It won't be. But the point is, there is a 2-week period for this negotiation to take place. That is one. Second, markets only care about if the oil is going through. There's toll, no toll, doesn't matter. But it will at the end of 2 weeks be there some kind of agreement which is acceptable to the West, which is acceptable to the US, where Iran seems to be more in control of the Strait than before when this war started. I think that perhaps will determine the next leg lower as far as oil is concerned. This one big leg has happened and markets have reacted to it. But from 94, can we go to 80-ish kind of $80-ish, which is another 14 odd dollars from here? I think that'll be the real one after today's fall. So let's see. There is a lot which will happen once the negotiations start, lots of back and forth, etc. And by that time, which is this Friday, I suspect we will already be at these 24,200, 24,300 kind of levels. Let's just run you through a quick sort of run through of what's coming up here. So autos and real estate we'll focus on. Autos, Sudarshan comes up and tells us what's happening. The index is up very sharply. Real estate index is up 7%. Actually, the only two indices which are flat are IT and Pharma. Actually, CPSE, IT and Pharma. These are three indices which are flat. Actually, CPSE is the only index which is even lower. L&T is something we'll discuss. KEC, Kalpatru, etc. Also with Vivek in a bit in terms of order flows, order book, rebuild, all of that. That's what's coming up here on closing bell. The RBI policy, what's the standout 2 or 3 announcements? Ritu will come up in a bit from now to take stock of that as well. All right, so that's the lineup. How should you position yourself is the question. Mitesh is with us from Bonanza Portfolio to take us through the trade setup and what he wants you to do. Mitesh, not many, unless you went long yesterday, not many got the opportunity this morning to go long because everything opened like it's trading now. So what's the trade?
Good afternoon, Prashant. See, the idea was, yes, in fact, day before yesterday, I was saying that, this market is now showing first signs of reversal and the indicators on the 2-3 hour chart have started on the upside. And I think today, obviously, fueled with good news, there's some short covering as well, because with a big gap, I think people who are on the short side would be scrambling to cover. So I think that's happened. Now, the question is, where can we head from here? On the Nifty, my first target was around 23,900, 850,900. So I think that was clear in the gap itself. And we're trading about that. So the next leg of supply zone, I think, comes around this 24,400 and then at about 24,750, 800 zone. So these are the two targets which I have on the index. What can happen is that, after the euphoria cools out, some part of short covering is over, you might get an intraday dip, or if not today, maybe tomorrow. That would be still a fresh buying opportunity. But yeah, the directional bias is on the upside, so trade with long bias.
Okay, what about individual stocks that you're looking at?
On the stock side, I have a buy on Coromandel fertilizers. I think, obviously, with the crude cooling out, fertilizers also get some kind of benefit, and the chart is also good over here. So Coromandel is a buy with a stop at 2095 for targets 2170. And IRNDA, that's the buy with a stop at 117.5 for targets of around 128.
Thank you, Amitesh. We'll come back to you. Let's get chatting about the big movers today. Realty is the top sectoral index gainer. That's up nearly 7%, but it's also the one which has been hardest hit. So it's rebounding most ferociously. And then you've got the auto index. That's gaining nearly 7%. Autos, too, got impacted on account of supply challenges. And now you are seeing relief in many names. Ashok Leyland, Tata Motors, commercial vehicles, big gains, big volumes. Sudarshan now joins in with some details and numbers.
So, along with the market, auto index has been gaining. It's amongst the top gaining indices, currently up almost 7%. On all its constituents are currently in the green, with big move being seen in all the, you talk about four-wheelers, two-wheelers, all the stocks are sharply higher. But ahead of this, if you take a look and see the move from since the time the war had begun on February 27 till March 30th, the index had fallen as much as 18%. And since March 30th to till now, the index has regained half of those 18% losses, and since March 30th, it's up almost 9%. But why there was a sharp fall in the last few weeks? So first, there was a sharp increase in the crude price, and also all the other metal names, you talk about aluminium, steel, or prices of all these metal names had seen a sharp increase. And because of that, there was a sharp increase in the input cost of all these auto companies. Also, there was a concern regarding supply chain challenges. All the companies and when all the agencies were talking that if the war gets prolonged, then there might be an impact on supply chain challenges. And if it happens, there can be a production cut announcement by majority of the companies. But why there is a big recovery? Well, there is a sharp fall in the crude price. Both Brent and NYMEX are currently down almost 13 to 14%. And also, as of now, the production for majority of the companies has been normal. They were saying that if the war gets prolonged, then they will have to go and take the production cut. So now with the ceasefire announcement, there is an expectation that production will remain normal for majority of the companies. And as far as input cost increase is concerned, all the companies have announced price increase to offset the input cost increase Yesterday, Escorts Kubota had announced. Day before yesterday, it was Tata Motors. Today, Hyundai has announced price increase. So all the companies have taken price increase. But we'll have to see if the demand sustains after the price increase, because in the first week of April, the registration data is showing muted trend. For four-wheeler companies, there's a sharp drop in the registration. For two-wheeler companies, it's largely muted, just 3% increase. For even three-wheelers, it's just 3 to 4% increase. So we'll have to see if the demand sustains despite price increase. But as of now, for today, it's a top gear move for auto companies.
Sudarshan, what's the registration numbers for the first week of April for four-wheelers? You said there's a decline.
So overall, in the first week, if you talk about total registration, which includes four-wheelers, three-wheelers, and two-wheelers, it's down 3%. For four-wheelers, it's down as much as 24%. For two-wheelers, it's up 3%. And for three-wheelers, it's up 3 to 4%.
Wow, so 24% decline in four-wheelers. So far, it's only the first week, but then there are those price hikes which are also in effect. Thank you very much for joining in. Siddharth Khemka, Head of Research, Wealth Management, and Motilal Oswal Financial Services is now joining us on the show. Siddharth, 3 stocks that you've recommended to your clients to buy today in this environment.
Yeah, good morning. Good afternoon, sorry. We are seeing finally some relief in the market and the much awaited ceasefire being announced. Now, what remains a key monitorable is how the negotiations go ahead from here and how the supply disruptions eases over the next few days. That will be a critical for the markets to sustain this kind of rally. And among these environment, some of the stocks, the way you asked, the top 3 stocks that we recommended to buy within the banking and financials, SBI, one of the stocks which was battered heavily because of the market fall. Before the market post the Q3 commentary, stock had seen sharp rally, and we believe that the credit growth would remain strong while the M2M losses would remain minimal for a large bank like SBI. Valuations are comfortable compared to some of the other peers in the private banking space, and hence we believe to look at a company like SBI, which is a high beta name in the fall, to play the recovery. The second is Larsen. Again, the stock got battered largely because of their exposure in the West Asia, Gulf regions, and we believe with the Trump administration talking about allowing some of the regional reconstruction activity to start, I think the sentiments definitely are much better for Larsen, as well as the valuations now looking much attractive. So those are the 2 stocks that we like. Third one is from the auto space. M&M is the stock, again, a stock which has fallen sharply. And we have seen that the company has reported very strong numbers in the tractor segment, far outpacing the industry growth, as well as in the passenger SUV segment. Their numbers remain pretty strong. Plus, we are seeing that there is an increasing trend of EVs that is picking up both in the two-wheelers as well as in EV space, where M&M has a market leadership in India, and where they're gaining a lot of strength. They have launched a lot of products in the EV segment, in the SUV segment, and which is gaining market share there, giving a tough competition to Tata Motors, which is a market leader. Plus, again, the correction offers a good entry opportunity for a strong stock like M&M, which is also a kind of rate sensitive and benefits from what the RBI said in the conducive liquidity environment that has been provided.
Okay, all right. Got that said. Well, let's focus on some Gulf-focused companies, businesses that had West Asia exposure. Well, they have bounced back after that ceasefire was announced. Vivek joins us to break it down for us. Vivek, take it away.
Well, that's right. The contractors, who have significant exposure to the Gulf region, who are working there, making EPC contracts, making EPC construction, a lot of these names had seen significant value destruction ever since the start of the West Asia conflict. A whole host of names, none larger than L&T, seeing a sharp rebound in this session today. Let's try and quantify, the exact amount as far as the exposure was concerned. As you can see on your screen, L&T, almost 37% of the total order book export to that region, 33% of the order inflows till FY26 so far coming in from that region. The other name, of course, is KEC. 20% of the order book is exposed to the Middle East region or West Asia region. 28% of order inflows in FY26 came in from there. Kalpataru, just around 11% order book, 2% order inflows in FY26. But the company, remember, was L1 or lowest bidder in quite a few order wins. Not only the capital goods infra space, even a company like a KRBL, rice exporter, company gets over 60% of its annual revenue actually from the West Asian region. Again, so this particular name too was significantly impacted due to the various supply chain bottlenecks that most of the companies are facing. Now, other than this, a whole host of companies that have direct exposure there. Have a look at a name like Vatek Wabag, even a Siemens Energy, ABB India, Triveni Turbine, a whole host of these names, capital goods, infra players are making projects over there. A lot of these companies today seeing a significant relief rally.
Particularly on L&T and BHEL, Vivek, these have emerged as the lowest bidder, L1 bidders in some large orders and tenders?
Well, that's right. So, what we are picking up from our industry sources and various experts and people who actually track the tendering work as far as thermal orders are concerned, what we understand is that L&T has actually emerged as the lowest bidder for two packages. The total value of these packages is over 22,500 crore. So the first package is for the construction of NTPC's Lara super thermal power project in Chhattisgarh. L&T has emerged as L1, our lowest bidder over here. And the second one, of course, is Damodar Valley Corporation, Coal India. It's a thermal power station in Jharkhand. So L&T again has emerged as the lowest bidder here. 22,000 crores. So again, it's a ultra mega project as L&T would classify it as. More importantly, for BHEL, they've emerged as the lowest bidder, or L1, and this is for a package that is valued in excess of 10,000 crore. Now, this particular order is for an Odisha Power Genco expansion of a thermal power plant over there. And, for BHEL, this actually means that the company now is L1 in orders worth over 40,000 crore. So, especially for BHEL, it's a large order win and clearly a positive development.
Okay, all right, got that. Thanks a lot for that, Vivek. Sid, any of these stocks that Vivek spoke about, you're comfortable to buy? Some of them gapped up and they're holding on to those gains, but they're still a far cry away from the peak.
Nigel, yes, Larsen is something that we already spoke about. We have a buy rating and a target price of 4,400. Some of the other capital goods name, I think Siemens Energy, that is something that we like. We believe that the overall power sector, transmission, distribution, and the cap goods sector would see significant increase in demand over the next few years, especially after what has happened to some of the data centers in the West Asian region. And I think demand for them will only go up in India. If you look at within utilities, what we like, Tata Power, JSW Energy, and within the renewable space, and Acme Solar is something which is under coverage, and we believe these are some of the stocks which would benefit from the increasing power demand that is going to happen over the next few years.
Okay, all right. Sid, quick word on some of these, pipe makers. I think APL Apollo is the one that you'll track closely. JTL, that's a stock, that's locked in upper circuit. It's up close to 20%. When the markets were moving very, very well, this stock was a favorite. JTL should come up on the screen. The reason I'm pointing it out is there's, I think, 50-60 lakh shares pending at the buyer circuit. There was a trade trade that took place today, and maybe, in fact, there's a large hand that's gotten. We'll know this post-market hours. But for the time being, that's up. Any view on JTL? APL Apollo Tubes as well, things were looking good, but then the guidance that they laid out, they couldn't, get to that because of this Middle East crisis. View on both these two names?
Yeah, Nigel, I think JTL, we don't have coverage, but APL Apollo, something that we track very closely. So Q4, they missed the guidance, especially because of the delay in execution in the West Asian countries. But I think, again, the reconstruction activity that will pick up will be very beneficial for a company like APL Apollo, which is scaling up its business model, has a strong presence in the structural pipes, which is largely used for some of these structures, airports and other infrastructure development. And looking ahead, we believe that the growth visibility would improve. We'll have to definitely wait for the con call and to get updates. But as the reconstruction activity picks up in the West Asian countries, some of these stocks, including APL Apollo, would be a key beneficiary.
Okay, thank you very much for that. There is some updates coming from Maersk, that's the global shipping company. And the key takeaway is that shipping companies are still in a wait-and-watch approach. So despite the ceasefire that's there, and US saying that they want a complete safe passage through the Strait of Hormuz, as of now, Maersk says we're taking a cautious approach. The 2-week ceasefire agreed could open up some opportunities for vessels in the Strait, but did not yet provide enough security certainty to resume normal operations. We'll keep tracking the marine traffic to understand how many ships have actually transited and moved through the strait versus the pre-conflict level. Also, some other important updates.
Yeah, this is, this is the Iran National Security Council. They're the ones who, along with the Foreign Ministry, which had put out a statement earlier, and they say that within a few hours, if firing does not stop in southern Lebanon, air and missile units will bomb Tel Aviv, the capital of Israel. So, remember when the Pakistani Prime Minister had tweeted in the morning, and that the social media post contained the agreement that this will be, as part of the agreement, as part of the ceasefire. South Lebanon is also part of that ceasefire. Israel, of course, has put out, I think the government has put out a social media post saying that operations in Lebanon against the Hezbollah will continue. So is what's happening in Lebanon part of the ceasefire or not? Iran seems to believe it is. And I think, they've quoted the Shahbaz Sharif's tweet saying, well, Lebanon is very much part of the ceasefire, whereas, of course, Israel is saying IDF will continue, that is, Israeli Defense Forces will continue operations in Lebanon. So we'll see. But these are essentially the kind of things which will come up as we go forward. And they're important enough to potentially blow up the deal, blow up the ceasefire. So we don't know as yet, but who would have thought we'd get to this kind of a situation a month ago, and here we are. So we'll have to just take it as we move forward. So it's not just between Iran and the US. There is Israel as well, which is very much part of this conflict, and it's not just limited to attacks on Iran. There are these operations in Lebanon, which Iran is saying is very much part of the ceasefire. So no more attacks there, no more operations there, which is what we wanted to put out. All right, more on this as the story develops. But commodities in focus, and it's not just oil. Manisha is back with us with just a quick snapshot view across a range of commodities. Oil, precious metals, base metals. Manisha, take it away.
Well, thank you so much for that, Prashant. Well, as you said, things are not very clear even now, and 2 weeks truce is what we are talking about. But very limited ships are expected to go via Strait of Hormuz. So what we have seen is a bit of a fatigue into the markets, and the biggest of the price moves really have come in only for the crude oil prices. The immediate geopolitical premium seems to have gotten away. So is the reason we are looking at 13 to 15% of a decline in crude prices, holding since the Asian markets, and that's exactly how European markets seem to be dealing with it right now. Well, as you mentioned, there's just too much into the play right now, and even as 100 to 120 ships every day have been going via Strait of Hormuz, most of the people that I have been speaking to tell me that not more than 10 to 12, at max 15 ships perhaps will go via Strait of Hormuz in the matter of these 2 weeks. So that's not so much of a number, but as I said, at this point in time, it's a relief and a knee-jerk reaction that we are looking at in sense of crude oil prices. No other commodity, by the way, has reacted so strongly to this news, not the agriculture space, not the fertilizer prices as well. A bit of a buying, yes, we have seen come back in sense of gold and silver, which have behaved as less of a safe haven and more of a financial asset class. So 2% of gains in gold, 6% of a jump up in silver is what we are dealing with. And that's exactly what we are looking at in sense of metals as well. Aluminum, which had been rising because 10% of aluminum of global supplies comes in from Middle East. And with this news, there's a bit of a relief here as well. So aluminum, which had been surging, has gone in for a bit of a profit taking. What has gained in metal as a space has been zinc and copper. That seems to be trading in the positive right now.
Okay, all right. Thanks a lot for that, Manisha. And we'll also thank Sid Khemka for joining in and giving us his view on all of the stocks that we discussed. Thanks, Sid. We look forward to chatting up with you rather soon. Well, let's do a quick check on the F&O markets then. And today by the end, maybe by 7 p.m. odd, we'll get that Bow copy data that will come out and the participant-wise data that will come out. And that should be indicating a massive short covering bounce today. I expect the FI net short positions to come down by anything more than 15 to 20% as well in a single trading session. So let's see how that goes. 2.6 lakh contracts should come down effectively. The positive is that the markets have rallied, and the India VIX that just a few trading sessions ago had gone to around 29. That's sitting at around 19. So the cooling of the VIX is an indicator. The fear factor really is cooling off, which is good. Remember, from the start of the conflict, the India VIX had doubled from the low point till the high point. Now, in today's trading session, there is some writing that we're seeing at around the 23,900 put. The premium, remember, at the start of today was at around 800 rupees. That's yesterday. That's come down to around 172 rupees. So those writers, you know, they're being very, very aggressive. And if you just punch in that premium number, roughly ballpark around 700 rupees odd, you'll see the 20 DMA is very, very important in terms of a support level, because, you know, you do around 23,900, you deduct 700, 600 rupees or thereabouts. That's coincides with the 20 DMA. On the call side as well, there appears 24,000 call. That's actually seeing some writing now. So these writers, they are hoping that 24,250 odd level, that actually holds out. You know, so that's around 300 points away from current levels. The Nifty Bank has conquered that 20 DMA. The Nifty as well as conquered the, the 20 DMA. And both those two now become supports from being resistance levels. The velocity that we are seeing of the move, that's what's caused the 20 DMA to be left behind. Individual stocks, you know, you had Force Motors corrected from around 24,000 rupees to around 19,000 rupees very, very swiftly. Now, that's coming for a massive short covering bounce. The stock is up more than 10%, and there were some shorts that were getting added to the system. Similar is the case with Ashok Leyland. I recall even on the day that the auto stocks were doing well, this one was under pressure. The numbers were quite disappointing. Now, there's a big shedding. I think 30-40 lakh shares have got shed on the short side. So that's selling a bit of a short covering bounce. And PG Electroplast as well. From around 550 rupees, the stock fell one way to around 450 rupees. And on days sometimes when the markets were bouncing back. But today, clearly, close to around 5% of the open interest is down, with the stock up close to 9%. Telling you, a big, big short covering bounce is what we are seeing. So good day of trade with the shorts scampering for cover. I think that's the way I like to put it. Well, we'll slip into a short break. On the other side, though, Deepak Shenoy of Capital Mind Mutual Fund is waiting for us. Stay tuned.
Welcome back. A very strong advance decline ratio. We've got 13 stocks advancing for one stock declining. In absolute terms, it's nearly 3,000 stocks in the green right now. But let's drill it down to individual stocks. Hormus joins in, as always, with the top movers.
Today's day belongs to a lot of these beaten down names that were taken a bit of a pounding during the war, and real estate is one such name. The entire sector is the top sectoral gainer today, is almost 7% higher on the index. Take a look at the stocks as well. Lodha is up 8.5%. The stocks were down to 52-week lows. Prestige Estates is up 8%. Godrej Properties and DLF2 seeing healthy gains of 6 to 7%. And take a look at the FNO positioning as well. For Lodha is the 800 call. And for all of these, the most active options have at least doubled, if not more, in today's session in terms of premiums as well. So look at the 800 call for Lodha and even the 1700 call for Godrej Properties. So take a look at the volumes as well. Now, the volumes though leave a little more to be desired, barring DLF, whose volumes are at least 3x its 20-day average. Most of the others are around about their 20-day average. Of course, slightly higher, but not significantly higher either. And almost 30 to 60% of the shares that have been traded have been marked for delivery in today's trading session. The stock that has moved well today has been Ashok Leyland, is the biggest single day gain since March of 2020 for the stock. The premiums today on the 170 call option has been the most active one. That has gone up by almost 5x in today's session. The volumes today are set to be the highest in the last 5 months, with over 9 crore shares that have been traded today. The 20-day average is around about 2 crore shares, and 40% of those are marked for delivery. The stock has moved back above its 200-day moving average of 154. The next level to watch is the 100-day moving average, which is at 178.70. The stock still is around about 20% lower compared to its 52-week high. And lastly, BSE is one name that has been traded very heavily in today's session. The stock is up around 7%, has gained around 20% in the last 5 sessions. Volumes are at the highest level in 2 months. The premiums on the 3200 call, which is the most traded today, 160% higher on that one. 90 lakh shares have been traded on BSE. The 20-day average is just about 30 lakh shares, and 37% of those shares are marked for delivery so far. And today's turnover, interestingly, on the BSE is higher in comparison to ICICI Bank and even Reliance Industries so far, and that has made it the second most traded stock today on the Nifty 500 after HDFC Bank.
Right. Thanks very much, Hormus, for that. Interesting list of stocks as always. Deepak Shenoy is with us, CEO at Capital Mind. Deepak, good to have you with us here. Thanks for joining us. Are we, once we snap back to this 24,000, maybe 24,200, or maybe even a little higher than that, is that, is it a one-time snapback to those kind of levels, or is this the start of something bigger, Deepak? How would you read it?
So, Prashant, to be fair, I can't really say that, this is the end of the downturn or the upturn, because things change with tweets nowadays, and, ceasefire announcements, non-ceasefire announcements are all seem to be, coming in one day after the other. Yesterday, the world was going to end. Today, it seems hunky-dory. But by and large, I think the markets have kind of, in the last 4 days in India at least, you've seen the markets going up despite the first 3 days of having really bad news. So in that, it's a little bit of a positive sign, because when markets start to go up in the face of bad news, I think that's the time it tends to become interesting for market players to get an idea of how market sentiment is changing. However, we have a result season ahead of us. A lot more commentary will come about how the industrials are dealing with this crisis, whether asset quality at the financials is under some stress. I think all of those will play a larger role in a more medium term or even the next 2 or 3 months kind of an approach. Hopefully this ceasefire lasts and we can go back to doing business with business rather than thinking of what's next is going to happen in a small straight, many thousand kilometers away from here. So I would say looking forward to, being able to analyze stocks again rather than to, focus on just the geopolitics.
All right. Hi, Deepak. Yeah, we hope, right, that things cool off. It's not good for humanity. It's not good for portfolios as well, but humanity first, I think so, in terms of the news flow. That said, we've got markets to look at, and given the kind of cues that we have, if you were to select a couple of sectors that you would be looking at allocating fresh money to, which one stands out for you in this post-war era?
So, I mean, the recovery notwithstanding in terms of what stocks have been beaten down, if you look at fundamental approaches here, one of the things that will clearly be making a comeback is defense at some level, because obviously there has to be an increase in indigenous defense expenditure and therefore all the related industries in that place. Oil and gas exploration, because we can't have this kind of level of dependence on cooking gas and all of that stuff that comes in. So players that will cause energy independence to move away from crude oil, that will be, I think, an interesting factor. Whether it is at some level, maybe green hydrogen, could be solar at some level, but also oil exploration and alternatives to LPG and so on. Those are, I think, clear sectors that you would find takers for, even if this war were to continue. So that is where I would say intermediate focus may kind of move to. But I believe by the end of the year, we'll also get a much better aggregate demand. Credit is already up. We're looking at credit growth of about 15%. So that way things are going to look better. The RBI policy eases a little bit of pressure on the bank. So some of the losses that they will make in this NDF change will probably reduce because they don't have to do incremental provisioning on investments. So I think that those factors will kind of help you kind of stabilize some of the other sectors, but the growth sectors really remain defense/industrials and some of these energy independence plays.
Yeah, and nuclear as well, right? With that breakthrough on that fast breeder reactor. Although, I mean, stage 3, where you're able to actually use the thorium here to produce power, and then that's some years away. But in any case, I think it's a significant breakthrough. Deepak, just mathematically, right, the market from the 27th of February fell about 12%, actually fell exactly 12% to the lows that we made, which was about 22,200 or so. If I look at it from that low, and we are almost at 24,000 now, we've recovered 8%. So you're kind of you've recovered about what about 70% of the fall. I mean, just purely in that sense, right? I don't know, and is that kind of analysis useful? I mean, just from a broader perspective, how much more to answer that question?
Yeah, Prashant, I'll tell you what that number scares me. Here is the scary part. Okay, in 2008, the market fell 60 to 70%. But in January, it fell a certain number. It fell about 25 or 30%. It recovered 75% of that fall by March and then went on to fall another 40% or 50% after that. In 1929, in the US Great Depression, the stock market fell, I think, a ridiculous 40% or something like that, and then recovered 75% of that fall. That same 75% number, it recovered by 1930. Of course, by 1932, it fell another 80%. So there is a problem in recovering only 75% and stopping there, because the precedents of extreme falls in the past, the 75% number is not a good thing. We should actually break through beyond, but I do think there will be volatility before that. Hopefully our fundamentals are way better than what we were in 2008 ourselves. Our dependence on foreign equity is also lower. So to that extent, I don't expect a very, very steep fall, but I do expect that we will have volatility. So I won't call this having won yet. I think we need to go back to those highs and probably show the earnings growth as well before that high comes. And given the pressure on earnings, don't expect earnings growth to really start coming in before December. So a cautious approach is better. However, there'll be some stocks that will be beaten down too much or have more opportunity. That's where I think you can get some alpha. When you compare it with the pure index, you want to buy sectors that will recover faster than the index in this upside. So it's not just the beaten down players. Sometimes you have to buy the players that have fallen the least in this fall, because they might actually be more resilient on the upside.
Got it. All right. Thanks a lot for joining in, Deepak, and giving us that view. It's a good day for the markets. And as we had that conversation, we in fact moved to the high point of the day. Well, time now for our special segment of D-Street Chatter. Nimesh is joining to give us an insight into dealing room chatter. Nimesh?
Hi, Nigel. It's a very strong day. It's a global risk on. It's playing out in India as well. The Nifty is up 3%. The Bank Nifty is up almost 6%. And aggressive short covering seen in sectors like autos as well as real estate in today's market. So a very strong short covering rally and a bit of buying back in the broader market names. Still the sense is in the large cap names, the FIs are net sellers, but there are enough bids in the broader markets in today's market. So it looks like some bit of buying is back, especially in the mid and small cap stocks from large institutions. From a technical point of view, the next level to watch on the Nifty would be for 44,200 on the upside. That's a bit of a first resistance, so to speak, on the Nifty. So that's a level to watch out. But clearly, it looks like most of the beaten down names in the broader market is where investors are looking to add into, given that there could be at least relief rally for the next 2 weeks because of the global development. So, as I said, flow still mixed from larger FIs, but clearly there is a very strong visibility of bids now opening up in the broader market names.
Nimesh, in terms of, we'll see, right? I mean, on both, as Nigel has also been pointing out, the covering which happens because there were large short contracts. On the cash side, will that selling reduce? Will we get a small number? I guess we can live with that for now. Individual names, Nimesh, what's on the list?
Well, a lot of stocks are buzzing in trade, so it was a bit difficult to find out, but anyway, I've identified a few names. The first name is HDFC AMC. Nothing to do with war, nothing to do with, the crude as well. But stock is in a big rally in today's market. Couple of reasons. One, there was a selling pressure from a domestic mutual fund. That's largely over. The Q4 updates, or for that matter, the preview seems to be quite strong for most of the AMC names. So that's the reason why HDFC AMC is buzzing in trade today. Selling is largely over, and a bit of buying as well from large institutions. Same is the case with Nippon as well. It's not part of the list, but even Nippon is buzzing in trade. And I understand there is good amount of buying interest from institutions in Nippon AMC as well. The second name is Loda, a part of the real estate name. Entire real estate pack has done well today, in fact, for the last few days. But Loda stands out. One, the selling pressure from a leading global FI is largely over. And also now there is a buzz that maybe you will hear some fundraising from Loda very soon. So that's a trigger as far as Loda is concerned. The third, a couple of names where there is buying after the gap up opening. So Eternal and SBI both stands out in terms of very strong delivery-based buying. So watch out for delivery volumes there. And the last is Dixon Technologies. Even that's buzzing in trade. Part of the rally is short covering, is my sense. But for Dixon, the next big trigger to watch out would be the Vivo JV. That's the next big trigger to watch out for Dixon after the first JV that got approved. So that's something which the street is anticipating very soon. And hence you're seeing a bit of covering in Dixon as well in today's market.
Thank you very much for that. That's Nimesh, hard pressed to find. There were so many stocks. It was hard for him to drill it down to a few of them. But all the AMC stocks, as he was pointing out, whether it's ICICI Pru, that's also up nearly about 4-5%. They got beaten down as the markets itself corrected nearly 10-12% in the last couple of days. And you are seeing a rebound. Get into a break. On the other side, we'll get you a few short-term trading ideas. Mitesh once again joins us. Welcome back. All gains intact. 24,000 is the level on the Nifty, almost there. And capital market plays across the board are surging, whether it's Anand Rathi, that's up 12%, Nuvama Wealth 9, MK Global 9, BSC 7, Angel One 8, Aditya Birla Capital. Grow has been a big mover, and all these stocks are moving up on very, very large volumes. So this entire capital market space is very active and buzzing. Mitesh is now back with us for a few more BTST calls. Mitesh.
Yeah. Well, I have a BTST on Adani E-Solutions, or Adani Energy Solutions. Keep a stop at about 1,064, target of around 1,100. And short-term, want to take kind of a trading call. That's a buy on Deepak Fertilizers with a stop at about 1,034 for target of 1,080.
Thank you very much for that. The other important development today was the RBI MPC minutes. Ritu now joins in to tell us what happened at the policy and what the key takeaways are.
Well, it was not really a reactive policy, a more cautious policy. So as expected, the repo rate being left unchanged at 5.25%, the stance at neutral, pretty much along expected lines. On the growth numbers, you had the FY27 numbers being released for the first time. 6.9% is the growth figure and 4.6% is the inflation figure. Keep in mind, all of this is assuming crude averages about $85 to a barrel this year and $75 next year. If there is an adverse scenario, these numbers could be impacted. Apart from this, there's a few other non-policy highlights that were really the focus of the policy this time around. The first is on banks' capital measures. The first is, banks were allowed to count their quarterly profits as part of their capital adequacy if the NPA provisioning divergence was not more than 25% in the last 4 quarters. That has been done away with, so it helps release more capital. The second is the investment fluctuation reserve, which is about 2% of your available for sale portfolio. That has been completely done away with. That, as per various analyst calculations, will release about 2 to 6 basis points of Tier 1 capital. Keep in mind, the release of additional capital is a net positive because, a lot of things are linked to your CET1 ratio, whether that is the bank's dividend payout or the large exposure framework, so how much they can lend. So net, that is a positive. Apart from that, the RBI governor saying that they will soon come out with a new framework for the categorization of NBFCs into various buckets, mid, small and large layers. And finally, on the Forex rules, RBI making it clear this is just a one-time measure to control the current situation and it's not a permanent fixture and will be revised at a later time.
Thank you very much, Ritu, for that. That's the RBI policy today. The other pocket of strength are many of these travel names. So Interglobe Aviation, we spoke about it, but look at Easy Trip, Late Revenues Tech, 8% up, very large volumes. BLS International, which is a visa play. That stock moving up on very large volumes. Mayuresh Joshi, Director Research, MarketSmith India, is now joining us on the show. Mayuresh, you want to tell us 1, 2 stock ideas?
Afternoon, Rima. So, I think the enthusiasm is well taken by the markets as we speak. And therefore, from a Q4, Q1, Q2 perspective, our own sense is that certain sectors like power will hold up, certain sectors like mining stocks should hold up. And therefore, Godavari Power, as an example, is something that we recently added on to our portfolios. Our take is that the integrated operations that Godavari Power has will hold it in good stead. What has really transpired over the last 5 years, the revenue growth has been 10%, but the EBITDA growth of 14% and the bottom line growth of 36% has been exemplary. The mine expansion, the captive mines, is expected to go significantly higher from 3 million tons to almost 6.7 million tons. And this entire process, I think what has probably happened in terms of pellet realizations, for 9 months 25, they were close to 10,500 rupees. It's come down to 9,600 rupees. For sponge iron, 29,000 rupees has come down to 25,500 rupees. In spite of that, I think the expectation in terms of better levers going forward and the expansions that they're probably doing, that's setting up a 0.7 MNT CRM complex, they're setting up a 1 MNT integrated steel plant, they're venturing into the BESS manufacturing. And in spite of such a huge capex, they still have around 863 crores of cash onto their books. So our own sense is that mining stocks should continue doing well. I think the entire ecosystem that it supports with demand levers, growth drivers would continue auguring well for those stocks. The other 2 stocks which we probably kept on our radar at this point of time, one of them is Welspun Corp. I've spoken about this time and again. Our own sense is that the expectations in terms of the infrastructure damage that has probably happened in the Middle East and the good presence that they probably got in Saudi Arabia, I think a large part of those line pipes and even the ductile pipes, which are largely used for oil and gas, might come back very, very strongly as we get some amount of sanity happening in the Middle East over the next few weeks and months. And therefore, with the existing order book that Wellcome already has at 23,600 crores, a large part of that coming through the line pipe market, the expectations in terms of more pipelines added in the US, in Saudi Arabia, or the Middle East in particular, where Saudi Arabia has actually embarked on a 52 billion capex, which might get accelerated as we head into the next few months as well. And even in the domestic context, the expectations in terms of 10,000 kilometers of lines expected to get added, LNG terminals expected to be get added from 8 to 13, from 52.4 MMTPA to almost 88 MMTPA. There's a huge scope in terms of the business prospects, and they've delivered in numbers. Almost 14.5% EBITDA, 25% in terms of ROCs. It's again very, very cash rich in spite of the 1,800 crore capex that they've done. So I think some things which might actually work as the markets recover.
Okay, Welspun Corp as well as Godavari Power and Ispat. Both those two, we have discussed Welspun Corp in the past as well. Yeah.
Angel, so along with Welspun Corp, right, the usual around Middle East, because they have a facility in Saudi Arabia, etc., it's reconstruction, etc. There was a Financial Times story which said that longer term, not longer term actually immediately, because the strait is where it is geographically located, etc. Will countries, oil-producing countries, look at other ways of evacuating oil, basically carrying oil through pipelines through the region? Like, for example, the East-West pipeline, which Saudi Arabia has. Similarly, can countries further into the Persian Gulf build pipelines to kind of circumvent the entire strait and, and get that oil to ships on the coastline, but not through the strait? So we don't know if that will happen. That, of course, is a big one, but it was an interesting story.
Yeah, I'll tell you what, Prashant, I've read a couple of other stories. I don't know whether we're talking the same one, but my agenda for this morning was trying to go to a Middle East plant, which is producing pipes. One of the companies was Welspun. And go to the United States as well, because evacuation of oil as well as gas are going to be top of mind now. So that's why, hopefully at some time during this year, I'll be at one of those plants in the Middle East or United States as well. So I've been working.
The plan this morning was to go to the Middle East.
This morning, the plan in the next few months.
Oh, the next few.
Not this morning. Come on, Prashant.
I said, well, boy, that is like, a jetpack.
But we'll get that visit. We'll get that visit done, and we'll see exactly how the evacuation takes place on,
No, the pipeline is already, the Saudi pipeline exists, and that is operating at full capacity. It's not small. It's some 6 million barrels per day, which is east-west, from the west of Saudi Arabia to the east to load the oil. And if it's got to get done for other countries as well, then you're looking at a very large opportunity. And Welspun, of course, is a company which is right there with production, etc., in that part of the world. We'll take a quick commercial break here. We'll come back. I think there is J.D. Vance, the U.S. Vice President, saying that not just the U.S. but allies have assured not to attack any further, which I think is explicitly an indication that he's talking about Israel. Military objectives have been achieved, but the point is not about attacking Iran, it's Lebanon. And I think we've heard statements which are contrary to what we heard earlier from Israeli Prime Minister coming through. Take a break. We're back on the other side. There's about 7 minutes to go for close.
Welcome back. We're going to be winding down a very, very good trading session. And the bulls, they'll look to party this evening. It's been a long time. Mayuresh, quickly talking about partying. What about the liquor stocks? You know, we had some news that Telangana will be affecting a price increase in May. Input costs have gone up drastically, mind you, particularly glass prices. In today's trade, you have stocks like Allied Blenders, fallen one way 30%, 35%, I think, from the top. That's popped up in trade. You have Tilak Nagar as well is up. Do you like any of these? Radico, you know, that's the poster boy in terms of the re-rating candidate. They've all corrected big time, 20, 30, 35%. Any of them on your radar?
Nigel, specifically, I think we'll watch out for Radico in particular. I think the entire premiumization story has been the forte for alcobev players, and therefore I think a large part of this universe is moving towards the premiumization space. So with lesser volumes, with better realizations and better margins, I think the overall numbers probably look far better. However, I think you're absolutely right in terms of input costs, specifically glass prices going through the roof, as well as packaging costs. The packaging costs will also increase quite significantly as crude derivatives have also gone up significantly higher. And what about extra neutral alcohol prices as well? It all depends in terms of how much of a pass-through is allowed by state governments, because ultimately alcohol is a state government-controlled area. So I think wait and watch for Q4 numbers, but Radico is something that I'll keep particularly in mind as far as Q4 numbers are concerned.
Okay, Mayuresh, we'll leave the conversation for now. We'll continue chatting in markets forward, wrapping up today's session with the Nifty closing above 24,000, the Sensex skyrocketing 3,000 points, the mid-cap index outperforming with a gain of more than 4%, and the Nifty Bank. Look at that. Nearly more than 3,000 points up on the Nifty Bank. That's a near 6% rally on the Nifty Banking Index. The big trigger was the 2-week ceasefire between US, Iran and all the allies. Global markets rallied hard. There was complete risk-on across Asia being carried forward in Europe. Crude prices slipped. Crude prices plunging 14-15% and below $95 per barrel. And even the RBI MPC policy meet was unanimous in the decision to hold rates. FY27 inflation and growth forecasts were also announced. Largely all green on the gainers list. You had Shriram Finance, many auto names like Tata Motors Passenger Vehicles, Eicher Motors, M&M. Large cap banking names provided leadership like Axis Bank, HDFC Bank, 6% gain. Interglobe Aviation was a big mover today, benefiting from the drop in crude prices. Along with that, you had Asian Paints. Titan's update looked good. That provided support. And L&T climbed back above that 4,000 mark on the back of relief on the Middle East front. On the way down, you had some PSUs weak in trade. So Coal India, ONGC, Oil India subdued. IT stocks rallied in the last couple of trading sessions, and they were on the back foot. Well, that brings us to a close in this edition of Closing Bell. Don't go anywhere. On the other side is Markets Forward.
US-Iran ceasefire sparks a sharp rally on Dalal Street. Frontline indices are up 4 to 5%, with all sectors in the green, while the Nifty crosses 24,000 intraday for the first time in a month. Companies add nearly 16 lakh crore rupees in market capitalization. RBI maintains status quo on policy rates and keeps neutral stance unchanged as expected. Central bank adopts a wait-and-watch approach on how the Gulf crisis pans out. Projects 6.9% GDP growth in this financial year compared to 7.6% growth in the last year. Sectors with direct West Asia exposure see recovery in trade. Auto, realty, capital goods, aviation and fertilizer names see a significant gain. Hello and welcome to Markets Forward on CNBC TV 18. Today, surely had been an interesting day, a positive day. We started on a strong footing, ended on the strong footing as well. Look at the Nifty, about 24,000, right, is what it closed at. Just around that mark, actually. Just there. Okay, 23,997 is the close, what it's coming at, but 3.7% uptick for the Nifty 50. Sensex too, obviously seeing very strong gains. And obviously, what was the positive news that came in this morning was that we are going to be seeing a ceasefire between US, Israel and the Iran war that has been going on. That's going to be for 2 weeks. Possibility of, more passing through the Strait of Hormuz as well. That is going to be a bit conditional, but still a positive sign that came in there. And that is what kept the street upbeat as well. Look at all the sectors today. Any of the sectors that you pull up, all closed in the green. Leading the charts was going to be Nifty Auto, Nifty Realty, Nifty Bank. That also started supporting in terms of the gains. So all of these closed with gains of more than 5% in the trading session. IT, which was seeing the lowest amounts of gains, that also closed with 0.5% of gain. Tomorrow, we're going to be watching out for earnings that will come in from TCS as well. So that is going to be the starting of the IT companies in terms of earnings. That will be key to watch out for. A lot of individual movers that came in from the broader end of the market as well. We saw the Nifty mid cap and small cap also close with very strong gains in the trading session. But let's move on. And is the worst behind now for the markets? And could this be the start of a strong up move? Abacus Asset Managers founder Sunil Singhania told CNBC TV 18 that we can see a potential revival for the Indian markets, especially after the underperformance versus other emerging market peers that we've seen. He also sees crude oil prices to dip to $70 to 80 per barrel by the end of May. Let's listen in to the conversation we had with him.
So actually, March was not that bad because a lot of companies had, raw materials with them. The challenges were more on the supply side and the logistics side. And, it was across. It was not that it was, only one sector or some other sector, because plastic and oil is needed by everyone. Like FMCG, for example, they were not impacted because of demand, but because of packaging cost going up. So, it was across. And more importantly, I think the last 1 week, 10 days, companies were getting nervous because if this would have continued for another month or two, then the disruptions would have been pretty severe. Hopefully, this ceasefire gets extended and, the little bit of impact which we saw over the last couple of weeks gets negated. But it was more a sentiment impact. And in some sectors, obviously, we all know which sectors did not have gas. I think there also there were challenges. Now, we also have to see that even with this ceasefire, whether the gas supply, particularly from Qatar, gets normalized, because there will definitely have been some impact, some damage to a lot of crude assets. But I would say that it was across. It was not related to any one sector. For example, even banking faced pressure because there was this whole narrative about inflation going up and yields had already crossed 7%. So, all these kind of events cause impact across, barring a few sectors like IT and all, which are relatively immune. So, I would say it was general.
I wanted to ask you about the crude oil prices though, Sunil. I recall in March, we had put out on social media that silver went one way, 50 to 70, 70 to $120. And then it reversed. Will crude follow suit? You think so?
Yeah, that's why I think that was exactly. I am very optimistic that 31st of May, when we complete 2 months of silver hitting, crude hitting 120, we would be more like 70, 80. And it is already showing. Nigel, what is also happening is that because of this conflict, a lot of other supply side, actions have been taken. So Venezuela has started producing oil more than ever. Sanctions on Russia have been eased off. And with this truce, I'm very sure that something on the Iran sanctions will also ease off. And therefore the supply side action will be pretty dramatic. Demand is not going to flare up, for crude. And, hopefully there will be normalcy. Already the September futures for crude as of yesterday were $25 lower than this month. So there was already a $25 war premium, maybe out of which 15 has already got adjusted today. Let's see. But, I would stick my neck out and say that 31st of May, we should see oil anywhere between $70 to $80.
All right, so there are calls for ghee shakkar. Hopefully that happens, in the next 2 months. So Neil, what about the small caps as an asset class? We talk about the headline index pulling 10, 15%. The pain in small caps has been immense. Now, you all had raised some money as well in the small cap fund. What is the deployment strategy out there? Do you think small caps as an asset now can do better, given the cues that we have and given the kind of underperformance? And also, what would be your top bets out there? Would it be cap goods, engineering, real estate? Some of these sectors that have actually pulled back a great deal.
I think, Nigel, you are right. A lot of small caps have bore the brunt of the correction in the market, and largely also because they had moved up significantly far beyond their fair value. And there was a lot of FOMO, a lot of momentum which had built into this segment. However, if you actually see last 3 months, the sector has been performing in line with the large caps. In fact, slightly better than the large caps. For us, we were lucky. The funds were raised at a time when the markets immediately started to correct. I think we have already deployed 65% in this correction of the fund corpus, and it's been across the board. Obviously, we continue to be positive on the financials. Obviously, capital good is a core area. But a little bit of allocation, which we normally used to avoid, which we have been aggressive, has been on the discretionary consumption side, and particularly the smaller the consumer discretionary names. We were getting it at valuation which we have not seen over the last 3, 4, 5 years. So I think it's been a lucky period. More importantly, impact cost also reduces. In good times, it's very difficult to buy stocks. And in times like this, it's a buyer's market, So I think that has also helped. We continue to be optimistic. I think India is a country of entrepreneurs. The country is definitely going to grow despite all these sporadic shocks which we keep on having. I would say entrepreneurs in India would look for faster growth.
So just one last sort of question for it's been an absolutely crazy, bizarre period, right? All the way from January of 2025. Let's just hope it's more boring now for the next 2.5 years. And fingers crossed on that. For India, it's been generally a tough phase, right? Since the highs that we've had. Beyond this bump and 1 day, 2 day kind of thing, are we in a more constructive phase? Can we say that? With a lot of the negatives priced in and, markets getting stress tested. So sometimes those things also work in your favor once you've experienced all that, right? So are we at that point now?
No, I think that is exactly what we felt in February. In fact, we came out with a note saying things are falling in place. And then instead of things falling in place, the missiles started falling in place. But actually, if you see, the tariff thing is behind us. We are ignoring that. We are at 10% tariff. I think the exports to US should bump up pretty well. Middle East reconstruction, India has huge opportunity. I think here, because of the income tax and GST cut and because of this huge liquidity surge which RBI has done over the last 1 year, we have seen auto sales, cement sales, steel sales, a lot of retail sales. You see the numbers of the retail companies which they have declared in March, DMart and Titan and every retail chain has done better. So things were already falling in place. I think we got this root shock in the form of this Iran conflict. But hopefully, as I said, if this is resolved, and I am very sure it will be resolved, we are looking at a good 2 years. India has underperformed massively. If you look even year to date, Korea is up some 35-38%. India is down 11%. So in 3-4 months, we have underperformed 50%. I think the valuation premium of India compared to the emerging market peers is a 10-year low. The underperformance of India vis-a-vis the emerging market index is at like a 15-year high. We've underperformed by 30% over the last 1 year. All these point out that a revival is near. Foreigners have sold a lot now. I don't think they can go more underweight on India, particularly given the fact that India stands out as a diversified and the fastest growing large economy in the world, and that hasn't changed. So we remain quite optimistic.
Also in the day, we spoke to Nilesh Shah of Kotak Mahindra AMC, who says investors should keep a close eye on banking and consumer discretionary going forward. He also remains bullish on gold. Let's listen in.
For last almost 10 calendar years, Nifty has delivered positive return. This is one of the longest streak. No one complained that, oh, Nifty didn't give any negative return in a calendar year. In equity market, that should have happened. Now, you have made money for 10 years. Maybe 11 years, you'll have to be happy with no return. Number two, what about asset allocation? Did you put all your money only at 26,000 Nifty? What did you do when the market was correcting? So equity investment, if you measure on a 1 year basis, that will not be fair. Businesses don't get built in a 1 year. You'll have to take a longer term view. And if you take a longer term view, again, I will stress, please moderate your return expectation. We are not going to see high double-digit return like post-COVID lows, because that was when market was 10 times forward. Today, it is probably 18 or 19 times forward. Those returns are not going to come. Be happy with moderate return and then only invest.
So if you have to construct a portfolio right now, could you give an indication of what's the best way? Let's start with the asset allocation, and then for someone with a long-term view, and then which sectors are considered safe or attractive from a valuation point of view where there will be some earnings?
So from a longer-term point of view, we think banking and financial services is one sector where valuations have corrected. Maybe there will be some impact on their margin for the March quarter, but thereafter FY27 earnings growth should be double-digit. The second sector where one could look at is domestic-focused consumer discretionary. If oil prices come down in double-digit, then there will be beneficial impact of all the steps taken by government, from EMI burden reduction through interest rate cut, GST cut, income tax cut. And we did see Jan, Feb, March consumption, improving further. So consumer discretionary space, maybe it's the summertime. So first consumer durables, then probably airline, travel, tourism, which has been hit very hard because of this geopolitical situation. And maybe thereafter healthcare and hospital. So this will be the consumer discretionary plus banking and financial services sector, which should outperform the market.
Nilesh, since you briefly mentioned about asset allocation, for investors that are looking to allocate money, what would the buckets be now if you just break it up into three: equities, precious metals, and then you have debt? What should it look like at this juncture?
So on the equity side, we are kind of neutral weight to equity, but at the higher side. So all our multi-asset allocation fund, balance advantage fund, are towards the higher side of equity allocation, but in the neutral range. So if neutral range is, let's say, 40 to 60%, we are at 60%, not at 40 or 50%. So higher side of neutral equity allocation. Within that, we are overweight large and mid cap and underweight small cap. Small caps have shown better earnings growth, but they are trading above their historical valuation. Large cap yesterday were trading below their historical valuation. On the fixed income side, we are advising barbell kind of strategy, where you go and buy extreme long end, 30-year, 40-year, 50-year. We believe that's where interest rates, market interest rates, are unlikely to move further up. They'll consolidate over there or may even come down. And then you create barbell by investing in up to, let's say, 3-year carry product, corporate bond fund, short-term bond fund, money market fund, and those kind of shorter funds. On precious metal, we still remain bullish on gold. The central banks of Russia, Turkey, probably Poland sold gold. Central banks of India, China, Japan probably didn't buy gold. ETF also saw sharp drop in gold in subscription, and hence gold buying was reduced. But going forward, we think with ceasefire, if US interest rate starts coming down, DXY, the dollar, starts weakening, gold prices should start moving up.
Okay. Another point, Nilesh, is the kind of selling we have seen from the FIs. But we have to focus what is in our own hands, right? And the strategy, as you have been explaining for a long time, is that you need to stagger it out, keep your staggered flows going in, the SIPs and the likes. What about liquidity in the domestic mutual fund industry? If you could help us out with that number, because the FIs, they sold more than 1 lakh crore in the last month. And this month, we're just a few days in, already 35,000 crores odd. So how is the domestic liquidity situation looking?
So domestic mutual funds liquidity will vary fund house to fund house. At Kotak Mutual Fund, we did not believe in keeping cash. Our investors gave us money in equity fund to invest in equity. And we have told them that we won't be taking any cash call. So whatever money came, whenever they came in, we decided to deploy. We are not absolute return chasers. We are relative return chasers. My job is to outperform benchmark indices, not generate absolute return. So we operate our funds at less than 1% cash.
Okay, those are some of the top voices of the market talking to us about their outlook going forward from here on and individual sectors. But on that note, we're going to step into a very short break. But don't go anywhere, because after the break, we will get your views that came in from Samir Arora, founder of Helios Capital, on the outlook for the Indian markets as well. Welcome back to Market Forward on CNBC TV 18. Now, the founder of Helios Capital said that his fund added HDFC Bank and one defense stock amid market volatility and remains highly bullish on quick commerce names like Eternal. Listen in.
So we are hoping, in theory, you are hoping that this is the Venezuelan model, where as of now, previously it was a different model that you're changing the regime. Now you're basically saying keep the regime, but the top guy is a little bit more mellow, or he has done his bit and now he thinks there is no this thing. So the top few guys are changing, and who may be a little bit I mean, they won't be as anti-US or whatever, and then life moves on. That is, I guess, the new outcome.
What have you done in the last 37 days while this conflict has been yeah. And are you looking to add risk today?
So actually, in my long short fund, I had come in very aggressive into March. My net was something like 74, 75, which after 10, 15 days, I reduced the oil and gas and refining things. And a few others, and my net is now maybe 67, 68. Not much different, but it was actually lower. But, it's a long short fund and you have to react. But in the other funds, we are basically, I have a long only fund here, quite big here. And then we have the mutual funds there. and all of them would be 99% invested. I can prove it again and again. You can see the data for the last 1 year for all the guys who come on TV and on your channel and say, now we are becoming bullish, now our model is turning green, now we want to sit up. But their returns are plus minus the same in a period which should have helped the guys sitting on cash or thinking that valuations are this and that. In the end, a few days here and there, like today will be a good day, where if you're sitting on some cash, what you will lose is maybe 20 days of returns, and by that time, something else will happen. So we have realized that I forget my long short fund because that is just the nature of that and the way it is sold, is that broadly being fully invested is okay. You change the stocks as you go, and therefore you can't say I am long term. I will never. I will time the market, but I will not change the stock, because once I buy a stock, that I am always married to. If you are willing to change the stocks, it's okay to be fully invested.
So how have you rebalanced and churned your portfolio in this period?
As I said, we have changed some of these energy-related stocks, and we bought a few means added, and maybe we added one new name to defense stocks. And I think that even though you may say today that the war is ending, but defense now people will realize that everybody needs to be more and more self-dependent. And secondly, in oil and gas and energy, you will have to find or put effort in trying to do something about gas, something about alternative, more than it was before. And other than that, we didn't change much. We actually added to the great stock, which fell 25% in the month or year to date. And we felt that the stories around it were more to do with egos of people rather than any scam that had happened in the company and stuff like that.
The stock that fell 25%, I think it would be the delivery company, Eternal.
Sorry,
HDFC, the frontline name. All right, one of the two.
I'm saying we even added to that, including in our offshore fund in March.
So added positions in both HDFC Bank and Eternal, stocks that you have been positive.
Eternal, I don't think we added, maybe I added, but that was with new money. We didn't change the weights.
Got it.
But we are very, very bullish on it. And actually, it is even more bullish now. If you see on that the Tata guys are crying that Big Basket is not making money. And of course, many others are not. So that is less pressure. And at this valuation, the new IPOs cannot happen at the valuation they dreamt. So they will have to be less aggressive. Also, of course, now the market from today may have turned. But otherwise, till yesterday, you would have imagined that if this weakness lasts for 3-6 months and that IPO does not happen, then what would have happened? So you can already see that the pressure is less, and there is no way you can avoid using quick commerce in your life, whether you are lazy or you are athletic and you have time and you are vela and you want to go shopping yourself. It doesn't matter. That thing is now there.
All right. Samir, one niggling worry is the kind of selling we are seeing from FIs. As you said, till February, things actually were looking up, both on the economic front. We look at dispatches, if we look at even heavy sectors like cement, steel, offtake was very good. And suddenly March, it put a bit of a spanner in the works. Now, the problem is the FI selling has got very, very intense. In March, it was very aggressive, but that was because we had a war that was ongoing. But the start of April as well, we have seen aggressive selling. Do you think you're reaching a point with some stability in our currency that actually we could expect them to come back, because $1 billion per day is a lot of pressure?
So actually in Feb, even though the IT sector fell some 18-20%, even then the index was up and FI flows were net positive and currency was also up. So we have to think that, okay, that was the default scenario and not what happened in March, where of course, it's negative for everybody, but for India, considered also very more negative, maybe because of oil imports and the fact that our currency, which was already weak, if the oil prices go up $30-40, then into 5 million barrels, so that is a daily loss. So the fact that there is some reasonableness in currency, and if these guys announce, I think they should have a $50 to $75 billion NRI bond. In 2013, it was 30-odd billion. The cost of that, extra cost will be maybe 2%. You have to give 2% more to greedy pigs like me, and you can get all the money, leverage money. And that is like $2 billion a year for 3-4 years. It's nothing to get that stability. But the FII flows actually have been negative, even very big negative in Korea and Taiwan. Actually, although their markets are up a lot, Actually, the Korea-Taiwan market have had bigger scale of selling by a proportion. I can send you the thing from a Goldman report, which I saw yesterday only. But like they would have had 30-40 billion of selling in the last few months. Okay, so it's pretty big everywhere. And we hope that it's now at least settles down to a 0 to plus, particularly if the currency is a little clear and steady and not cracking every day. As I told you last year, the currency was embarrassing. Let me say it, even though I'm an India fund and I sell to foreigners, it is embarrassing to see how it fell for the last many years, 1 or 2 years. Yeah, it's pretty bad.
If you had to go in with news like this behind a tailwind, where would you focus? What does best from here? Just it's all relative, of course,
So
but
one
without
is
any
you can
baggage.
look at one is you can look at the beaten up names, like L&T types, which are down, and knowing that one day it become okay and the orders will increase even more maybe, or at least your orders will come back. And also these other things where food delivery and all, of course, we always like. Even the banks and all, 25% down is not a normal this thing that this is because something happened and some chairman resigned for reasons which he can't even explain clearly to Shireen Bhan after 40 minutes. So things like that are very easy to just see the ones which were otherwise known, well known. And particularly if you think they've fallen 15-20% in this month or over this period from December end, then those are the initial starting point. Otherwise, you can give it to our mutual fund also.
Okay, and with that, it's a wrap on this edition of Markets Forward on CNBC TV 18. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The US and Iran agreed to a ceasefire for 2 weeks. Both sides declare a victory and credit Pakistan for mediation. Tehran promises safe passage through the Strait of Hormuz for 2 weeks under Iranian military management. President Trump says the US will assist with ship traffic congestion at the Strait. Pakistan's Prime Minister says Islamabad will host high-level delegations from the US and Iran for negotiations to clinch, quote-unquote, a conclusive agreement on Friday. President Trump says China likely played a role in pushing Iran towards the negotiations. Israel's Prime Minister Netanyahu says Lebanon is not part of the ceasefire deal and military operations will continue. This contradicts statements from Pakistan and Iran. Tehran threatens to bomb Tel Aviv if Israel does not stop the attacks in southern Lebanon. Crude oil prices plunged below $100 a barrel. Stock markets rally across the world. Iran is planning a $2 million fee for ships to cross Hormuz, which could yield more than $70 billion annually. But Oman, which also controls part of the strait, says no fee will be imposed for safe passage. There is no official confirmation on a toll just yet. The Sensex gains nearly 3,000 points and Nifty reclaims 24,000 after a month as all sectoral indices gain ground. Dalal Street adds 16 lakh crore rupees to market cap today. The rupee gains over 40 paise against the dollar and moves to the 92 mark. RBI maintains the status quo on policy rates, keeps the neutral stance unchanged as expected. The central bank adopts a wait-and-watch approach on how the Gulf crisis will pan out, projects 6.9% GDP growth in this financial year compared to 7.6% growth in the last fiscal. RBI provides a capital boost to banks and non-bank finance companies, allows banks to count quarterly profits in their capital adequacy, dispenses with the investment fluctuation reserve. NBFCs get access to the call money market for their liquidity needs. India's airport tariff regulator cuts landing and parking charges across major airports by 25%. The move is aimed at providing some relief to airlines struggling with soaring fuel costs. International Air Transport Association warns that jet fuel prices will take months to normalize, even if Hormuz remains open. Q4 earnings season kicks off tomorrow. IT major TCS expected to report a modest 1% growth in revenue. The Nifty IT index is down 24% in Q4 amidst fears of a SaaS apocalypse. A meeting between Trinamool Congress leaders and Election Commission official turns acrimonious. Trinamool alleges the Chief Election Commissioner told the delegation to, and I quote, get lost. The Election Commission accuses the TMC of shouting West Bengal votes in less than 2 weeks. Well, straight to the top story this evening. United States and Iran have declared victories as they have announced a ceasefire which will go on for 2 weeks or till there is further notice. This after 39 days of intense airstrikes. U.S. President Donald Trump making the announcement in a Truth Social post an hour ahead of his own deadline to bomb Iran's power plants and bridges. Now, Trump said that Pakistan's Prime Minister Shehbaz Sharif and Field Marshal Asim Munir asked him to hold off on attacking Iran, subject to Tehran agreeing to open the Strait of Hormuz. Trump reiterated that the U.S. has achieved its objectives in Iran. He said that almost all of the various points of past contention have been agreed upon and the agreement will be finalized in the next 2 weeks, adding that Washington has received a 10-point proposal from Iran, which he called a workable basis on which to negotiate. Now, Iran's 10-point conditions include a permanent cessation of war, continued control over the Strait of Hormuz, acceptance of enrichment of uranium, lifting of all sanctions, compensation and withdrawal of U.S. forces from the region. Iran's Foreign Minister Abbas Araghchi confirmed the tentative ceasefire but maintained that Iran will stop military operations if U.S. and Israel stop their attacks. Araghchi also said that the passage through the strait will be possible via coordination with Iran's armed forces and the acceptance of Iran's 10-point plan. However, Lebanon's inclusion in the ceasefire remains uncertain. Although Pakistan's Prime Minister said the agreement included Lebanon, Israel's Prime Minister Netanyahu maintains that it does not. In fact, airstrikes by Israel continue in the region. Israeli military said it will continue to attack Hezbollah infrastructure. This as the militant group accepted the 2-week agreement. Iran's National Security Council has warned that Tel Aviv could come under attack if hostilities in southern Lebanon continue. Now, according to media reports, the council said, and I quote, if the firing does not stop in southern Lebanon within a few hours, the air and missile unit will bomb Tel Aviv.
Meanwhile, Pakistan's Prime Minister has said that Iran's president has confirmed in a phone call that Tehran will participate in the negotiations in Islamabad. This comes as US Vice President J.D. Vance has said that the truce remains fragile while reiterating that all military objectives have been achieved by the US.
The Iranians have agreed to open up the straits. The United States has agreed to stop attacking. And that, not just the United States, but also our allies, have agreed to stop attacking. And that is the basis of this fragile truce that we have, which is now, 8 to 12 hours old. Now, here's what I'll say about this. I've learned a lot about the Iranian system and a lot about the way the Iranians negotiate. As the president told me last night, the Iranians are better negotiators than they are fighters. I'm sure they don't like to hear that, but it's true. But here's a couple things. So, one, just in the response that we've seen from various segments of Iran, you have on the one hand people within Iran who have responded very favorably. The foreign minister who said, look, we agreed to the United States' terms. We'll do a ceasefire, we'll do a negotiation, we'll open the Straits of Hormuz, and then we'll see if we can come to more agreement down the road. So some of the people have responded favorably and have said the right things. And then you have some people on social media within their system who are basically lying about what we've accomplished militarily. They're lying about the nature of the agreement. They're lying about the nature of the ceasefire. And so you have just, even within their system, and this is why I say this is a fragile truce, you have people who clearly want to come to the negotiating table and work with us to find a good deal. And then you have people who are lying about even the fragile truce that we've already struck. And that's just an interesting thing about their system. And the final point that I'll say about this is the President of the United States has told me, and he's told the entire negotiating team, the Secretary of State, the Special Envoy, Steve Witkoff, he said, go and work in good faith to come to an agreement. That is what he has told us to do.
A fragile truce, but J.D. Vance there, the U.S. Vice President, saying that President Trump wants to get a deal done with Iran. Now, President Trump believes China played a role in the ceasefire deal. Speaking to AFP, Trump said China is likely to have persuaded Iran to come to the negotiating table. Trump was forced to delay his visit to China, which was scheduled in March. He will now visit Beijing next month. China's foreign ministry also welcomed the ceasefire and said it is supporting Pakistan in making active mediation efforts. Several world leaders have welcomed the ceasefire announcement. British Prime Minister Keir Starmer is scheduled to travel to the Gulf. India has also welcomed the agreement. External Affairs Minister S. Jaishankar will visit the UAE next week. Here's Australia's Prime Minister on the ceasefire deal and what it means.
This is positive news. We've been calling for a de-escalation for some time. We want to see a resolution of the conflict. The potential of damage to civilian infrastructure in Iran was an extraordinary statement to make. And then also the impact that would have arisen from an escalation within Iranian response would have led to greater global economic damage.
Well, that is the response there coming in from Australia's global leaders react to that two-week ceasefire deal. Crude prices have fallen below the $100 mark for the first time in nearly a month. The global stock market also rallied, with Asian markets closing largely in the green. Precious metals also up in trade today. Reports suggest Iran is planning a $2 million fee for ships to cross the Hormuz. JP Morgan estimates the fee could yield more than $70 billion annually. But Oman, which also controls part of the strait, says that no fees will be imposed for safe passage. There is no official announcement on any potential fee so far. Manisha is here with more on the future of the Strait of Hormuz. Manisha, this is the big bone of contention.
Well, there is a 2 week of a ceasefire, and the crude oil prices have reacted to this with 15% of a decline. But what this also has led to is Iran creating a Strait of Hormuz revenue projections therein. If you look at the overall mathematics of this, as per various reports, we do understand that Iran currently is charging 2 million barrels for every vessel that is crossing Strait of Hormuz, and that perhaps would continue going forward as well. Now, 100 to 130 vessels is what crosses Strait of Hormuz on a daily basis. This is, of course, a number that comes in from before West Asia conflict. If you do the maths of this, that means that Iran would perhaps be generating a revenue of around $70 to $90 billion on an annual basis there. therein. This is much higher than the toll that is charged by various other water canals or waterways. Panama Canal, for one, generates a revenue of $5.7 billion. You have Suez Canal that does $4 billion. This was in 2025. Suez Canal actually has been doing $10 billion and more than that as well. But now, because the congestion or the traffic has declined, the amount also has declined same way. Also, when you look at the St. Lawrence Seaway, it just about generates $86 million. And then you have Bosphorus and Dardanelles, which does $227 million in an annual basis on revenue there. And then you have Kiel, which is one of the busiest one in Germany, just about does 20 to 30 million therein. Much of this is really funded by the government therein. But there are other important waterways as well, which have the right of free passage under the international law. They are not private waterways and there is no toll on these. So within this, you have Strait of Malacca, which does 100,000 vessels in an year. And then you have Gibraltar Strait, which does 300 ships on a daily basis, one of the busiest one again, also known as the oil artery of Asia therein. And then you have Singapore Strait as well, which does 90,000 to 100,000 ships on a daily basis. This list actually had Strait of Hormuz as well until a couple of months ago, but now it is generating revenues for Iran, with the street anticipating it's going to be the most expensive one or the highest generating revenues Strait canals ever.
Well, Manisha, many thanks. But as we've been pointing out, there is no official confirmation just yet on that toll. If it does go through, it is going to change rules of the game forever. On to the day's market action. The Sensex and the Nifty posting sharp gains today on the back of that ceasefire between the US and Iran. Frontline indices registered gains in the range of 4 to 5%. The Nifty 23,997, up almost 900 points, a gain of about 4%. The Sensex up 4% as well. The Nifty Bank up 5.5% and a 4% gain there coming in for the Nifty Mid-Cap as well. So we've seen across the board gains coming in. BSE listed companies have gained market cap of nearly 16 lakh crore rupees. But from equities to the currency market, the rupee gained 40 paise against the dollar and has moved closer to the 92 mark. RBI Governor Sanjay Malhotra reiterating that RBI's recent intervention in the forex market was solely aimed at curbing volatility, and we will have to wait to see what the RBI's response will be going forward.
These are reactions to the specific market movements. These are not, in any sense, they are not signaling any structural change. We stand committed long term, we stand committed to the development, broadening and deepening of these markets, to the internationalization of the rupee. And so obviously, these are not measures which are going to remain there forever.
Well, that is the RBI on the currency market. The government has allowed the supply of commercial LPG to a wider set of industrial sectors. The centre has also asked states to operationalise the decision. The Petroleum Secretary has said that industries including polymer, agriculture, packaging and others will be eligible to receive up to 70% of their pre-March consumption levels. However, the allocation will be capped at an overall sectoral limit of less than 1,000 metric tonnes a day. Now, India's airport tariff regulator has cut landing and parking charges across major airports by 25%. This move is aimed at providing some relief to airlines that are struggling with soaring fuel costs. The International Air Transport Association has warned that jet fuel prices will take months to normalize, even if the Strait of Hormuz remains open. Shivani standing by with the details. Shivani, this was a demand that airlines had put forward to the government. The government has now provided temporary relief for the next 3 months.
Well, while the ceasefire news is a good news for the global economy, the jet fuel prices are still elevated and refusing to cool off, and that's now becoming the biggest overhang for the aviation sector. The International Air Transport Association has warned that the aviation turbine fuel prices could take months to normalize from these levels, even as ATF prices have more than doubled in just the past few months since the West Asia conflict broke out. Even as the government has stepped in with some relief, pressure on airlines continues. The ATF prices have still seen seen an 8.5% hike, lower than expectations, while airlines have revised the surcharges as well. Now, the bigger move, however, comes from the airport's Economic Regulatory Authority of India, which has slashed the charges on the landing and parking by 25%, offering a direct cost relief to airlines. This relief will apply to domestic flights for 3 months and comes into effect immediately following the centre's directive amid the West Asia crisis. Importantly, any under-recovery during this period will be trued up in the future, meaning costs could be recovered later, keeping the longer-term fare pressures intact. Back to you.
The immediate concern is around supply in Asia, followed by supply in Europe. I don't think Europe is in the same situation as Asia quite yet. About 80% of jet fuel for Asia comes through the Strait of Hormuz, which has been closed. Good news in the past hour that there is a temporary ceasefire and that oil will start flowing through the Straits of Hormuz again. So hopefully that will provide some short-term relief, and we've seen that in the price of crude oil, which has fallen significantly in the past hour or so. So it's a challenging situation.
A challenging situation, but some relief coming in for airlines. On to the other big story today, monetary policy. The Reserve Bank has kept interest rates unchanged as was expected. The central bank has opted to wait and watch as this West Asia crisis develops. RBI lifted the estimate for India's GDP growth in the last financial year to 7.6% from 7.4%. However, it has projected a growth rate of 6.9% for this financial year. RBI Governor Sanjay Manotra indicated that the West Asia conflict could impact growth as energy and other commodity prices remain elevated. He also flagged the upside risk to inflation. Now, the RBI expects the consumer price index to be at 4.6% for FY27. Core inflation is estimated at 4.4% for the same period. The RBI also provided a capital boost to banks and NBFCs. They will now be allowed to count quarterly profits in their capital adequacy, while NBFCs get access to the call money market for their liquidity needs. Here's the governor.
The government has taken several measures targeted at supporting exports and protecting supply chains. The fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook.
Well, that is the RBI governor. Lata joins us now with more on the monetary policy. Lata, status quo on rates as was expected, but what did you pick up from the commentary?
I would argue that the policy is absolutely neutral. It has got some hawkish elements and some dovish elements. Hawkish because the hike in the inflation forecast is more. It's about 50 basis points, whereas the cut in growth is a little less. So some people can read that as a little hawkish. However, the governor was very clear when asked. He said that maybe you should say we will pause for a long time. And they removed the word lower for longer. All this gives the impression that there are enough number of hawkish and dovish elements, and therefore I would call it as neutral can get, appropriate given the geopolitical uncertainty. A point in terms of liquidity is a little dovish. The governor almost assured that they will continue to keep liquidity surplus in the interbank market so that there is better transmission. They are not reintroducing the VRRR, which is a means by which excess liquidity is sucked out on a daily basis. That's not going to be reintroduced in a hurry. Gives banks some breathing space. An important contribution of this policy is core CPI forecast is being given by the Reserve Bank. Until now, they gave us only headline CPI. Core CPI is inflation minus food and fuel, which are volatile elements. I think it gives the RBI a certain maneuverability. Let us assume diesel and petrol prices at the pump are raised. That will only increase headline. It won't increase core. So the RBI may be able to argue at certain points in time if needed that headline is up but core is not up. So the announcement is one step towards transparency, but it also improves the nimbleness and space available to the Reserve Bank. Important announcement on the FX. The Reserve Bank went hammer and tongs last week on March 28 and March 31st to tell banks to bring down their speculative positions. The Reserve Bank clarified it is temporary and that as normalcy returns, they will allow banks to do more arbitrage trades between the onshore and the offshore market, and this limit of $100 million on open positions on the onshore market will be relaxed in course of time. That will be a bit of relief. Finally, there are some improvements to, some changes to the way which will improve the capital of banks. That is, the investment fluctuation reserve need not be kept anymore. Quarterly profits can be transferred to reserves. However, both RBI and bankers tell us it is not going to make a material difference to their capital adequacy ratio. So that's more, an ease of doing business kind of step. Doesn't change EPS.
Lata, many thanks. Now, Governor Sanjay Manotra also spoke about the recent developments at HDFC Bank. The governor said the RBI has not found any material governance concerns in HDFC Bank during its oversight. This comes after the bank's chairman, Athanu Chakrabarti, stepped down, citing ethical disagreements.
हमने प्रेस में अपना एक प्रेस नोट दिया था तब, जिसमें हमने ये कहा था कि हमारे हिसाब से कोई भी मटेरियल कंसर्न हमें चाहे गवर्नेंस या कंडक्ट से संबंधित हो वो नहीं है। तो उस बात को मैं यहाँ पे दोहराना चाहता हूँ कि कोई भी मटेरियल हमें कभी भी अपने सुपरविजन में या उनके रिकॉर्ड को देख करके ऐसा कोई गवर्नेंस और कंडक्ट से रिलेटेड मैटर हमारे सामने में नहीं आया।
The RBI reiterating what it said in a statement that they have found no cause for concern when it comes to governance lapses at HDFC Bank. Assembly elections in Kerala, Assam and Puducherry will take place tomorrow. Voting will be in a single phase. There is a fresh controversy brewing between the Trinamool Congress and the Election Commission. Santhya is here with the election update for today. Santhya, let's start with the meeting between the Trinamool Congress and Election Commission, which turned acrimonious.
Yes, absolutely. And it is the biggest election story, and it is coming from the state of West Bengal, where the Election Commission of India and the ruling Trinamool Congress got into a very public face-off. TMC claims its delegation went to meet the CEC but was told to, quote, get lost, unquote. The ECI, on the other hand, put out an extremely controversial post on X targeting the TMC. In the post, the ECI said, and I quote, Election Commission's ultimatum to TMC. Elections in West Bengal this time will be fear-free, violence-free, intimidation-free, inducement-free, raid-free, and booth and source jamming-free. Coming from an apolitical agency like the ECI, this has raised further questions about its neutrality. Another key story is the completion of SIR in West Bengal. Overall, 90.8 lakh voters' names, around 12% of the state's total electorate, have been removed. TMC claims that of these, at least 55 to 56 lakh are Hindu voters, while the Bharatiya Janata Party claims 80% are Muslims and 20% Hindus. Murshidabad, North Chobis Parganas, Malda, South Chobis Parganas and East Burdwan are among the districts with the highest number of deletions. West Bengal Chief Minister Mamata Banerjee filed her nomination from the Bhawanipur seat on Wednesday. The Bharatiya Janata Party's Suvendu Adhikari had filed his nomination from the same seat last week. Remember, in the last election, Adhikari defeated Banerjee from Nandigram, though she later won Bhawanipur in a by-poll. Mamata Banerjee filed her nomination while showcasing strength through a roadshow. Moving on to the southern corner of the country, Tamil Nadu Chief Minister M.K. Stalin has raised objections to the special parliament session, accusing Prime Minister Narendra Modi and the BJP of shrouding the delimitation process in secrecy instead of coming clean on its roadmap. Stalin warned that a calm south should not be turned into a storm. Meanwhile, namesake proxies are adding intrigue to an already high-voltage election. Reports suggest that in Tamil Nadu alone, in at least 100 constituencies, multiple candidates share names with key contenders. Vijay of TVK's Senthil Kumar, DMK's N. Karthikeyan and AIADMK's Saroja are among those with namesakes in the fray. To counter this tactic, the Election Commission has introduced candidate photographs alongside party symbols. However, parties argue this may not be enough, especially with the new entrants in the race. Finally, voters in Kerala, Assam and Puducherry will vote tomorrow. Polling will be held in a single phase with counting scheduled for the 4th of May. Alongside the promise of freebies by all parties, regional dynamics, the relevance of local players, dominance of regional leaders and the ambitions of national parties will be at the center of these elections.
All right, Santya, many thanks for joining us. And that is the election update for the day. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Welcome to our monetary policy special. The Reserve Bank, as expected, kept the repo rate and its stance unchanged, but it has cut its growth forecasts by about 20-25 basis points for the first half of the current year. It has also hiked its inflation forecast rather sharply to 4.6% for the full year versus only around 2% for the previous year, that's FY26. The governor refused to be drawn into any clear interest rate guidance, though he did assure continued surplus liquidity. So, should we expect a rate hike at all in the latter half of FY27? Is the RBI too optimistic in its growth estimates? And more importantly, is the worst over for the rupee in terms of its fall? The Reserve Bank did give some math as to why it expects FY27 to be a balance of payments positive year. To discuss all these issues, we are now joined by an A-team from the market, Shailendra Jingan, the head of Treasury and Economic Research at ICICI Bank. Also joining me is Samiran Chakrabarti, Chief Economist at Citi India, Mridul Sagar, Professor at IIM Kozhikode, former ED at Reserve Bank, and thereafter the country's top banker, the SBI chairman, will also be with us. But first, for the economic discussion. Thank you very much, gentlemen. Shailendra, going into this policy, the markets, the bond markets were pricing in like 2, 3, 4 rate hikes. What have you made of the RBI speak?
I think definitely it's more dovish than what the market expectation was going into the event. I think just for context, I think till yesterday when RBI would have been making the policy, I mean, crude was at 115 and today, we are down to $95. So there has been a big change. I mean, so I wouldn't attribute the entire move to, the RBI's language or the way they have drafted the policy. I think it's also driven by what's happened globally, that, there has been a ceasefire and it seems that, both the parties are kind of okay to, stop the war. So
I take a point on that, Shailendra. Even before the RBI speech was read out, the bond yield started at 6.95 and then at 6.91 after the speech. So the speech was seen as dovish. I take your point on that. But I'm asking you, could you make out from the way the governor spoke and forecast whether you're penciling in a rate hike in the second half?
No, so I think, when I look at the policy, I think, something which needs to change is this, that monetary policy is being looked just from the prism of, growth and inflation. There is another angle which has become pretty evident in the last 2 years, which is the balance of payment. In the last 2 years, I mean, even though you could say that from a growth inflation perspective, I mean, we are at equilibrium, the growth is at 7%, which is pretty much at target. Inflation is sub 4%. But what about the external account? I mean, what about the fact that, rupee has been continuously under pressure and the balance of payment for a second year running is in deficit? I think this year the deficit could be, for FY26, it could be about $30-35 billion. Assuming a crude price of $85, we think that next year also the BOP could be in deficit. So I think once, you get the external side of the picture into the equation, then it is very clear that, rates have to be a little higher than where they are today. And I think, so if you ask me, from a growth inflation perspective, even though the average inflation is at 4.6%, I don't think RBI needs to do anything. But I think once you put the external picture into account and the fact that, we are not getting any capital flows, I think the market clearing interest rates need to be a little higher than where they are today.
Fair point, fair point. Samiran, what about, first let's do the state of the economy discussion. Are you sanguine about the 6.9% or is the RBI overestimating? Likewise, your take on the inflation forecast.
Thanks, Lata. So I think the growth side and the inflation side, these projections are subject to whether the ceasefire continues or not. I mean, we have to all understand that if you look at the RBI's growth and inflation forecast fan chart, they are much wider in this iteration than they are normally. So the confidence bands are much wider now in terms of these forecasts. Having said that, I think the new and interesting thing that the RBI has brought in is this introduction of core inflation forecast. We all know that RBI MPC used to look at core inflation, but to put that forecast out for in the public domain would, in our view, gravitate the market expectations also towards that variable. So our sense is, particularly at a time like this, when both energy price shock as well as an El Nino-led food price shock are concerns for the market. In that kind of a scenario, to make the market look only at the core inflation or primarily at the core inflation was actually a very good move on RBI's part. This will ensure that the market expectations about future rate hikes are not driven simply by the supply side shock on both these accounts of energy and food. So that way, our sense is that as long as the core inflation does not cross 4.5 on a durable basis, there is possibility that RBI can ignore this view that, real rates are coming off from a headline inflation basis and focus more on the core inflation to determine the future policy path.
Fair point. That's exactly what even I thought. It was a very clever introduction, though it went in the name of transparency. When the pump prices, when prices are raised at the pump, the RBI has a fallback excuse if it wants to use it. But of course, it could use Shailendra's argument and want to defend the currency as well. But Mridul, what is therefore your sense? One, is this core inflation introduction merely an excuse to use it when you don't want to hike rates? And secondly, like Shailendra, do you think that there is no scope to be too dovish anymore and that the currency will force the RBI to be, on the hawkish side later on in the year?
Lata, I think it's not just the currency which can force RBI to be on the hawkish side. We also need to watch out for the inflation. I know the current numbers don't look too worrisome. So they are all contingent essentially on what might happen still in the Middle East. Because you have a 2-week pause, it has given a chance to open up basically a possibility of a truce, which is more elongated. But we don't know what happens, what Israel might do, what if there are further damages to the energy infrastructure, the oil prices could climb again. I was watching what the forward curve says today. It has fallen by roughly $6 a barrel from April 2nd, but the average for the Brent is still close to 85. It's 83.75 as we are talking. Now, this kind of a forward curve doesn't leave much chance that basically we can forget about oil and presume there will be no further hikes. So I think RBI has rightly kept its option open. When you step in a dark room, the cardinal principle of the monetary policy is take small steps. That's what the Brainard rule says.
Okay.
And it's a time-tested central banking rule. So for now, they are not communicating any rate hikes, but it's not ruled out for the rest of the year. It depends on how inflation behaves, how exchange rate might behave. And if you would notice, the inflation projections have been firm. Also, I don't think there's a complete understanding on that, but my understanding of those numbers is that the new CPI, actually the weight of petrol and diesel in transportation is rightly reflected higher. So it is more than doubled there. And that is putting pressure really on the inflation numbers. And we need to watch out how Q3 behaves. Okay. If there is some further shock, if, for instance, El Nino also comes in, there is a 40 basis point upside to these projections.
Yes.
So if all that happens, then there is every chance that the RBI may not just keep the holds on hold, rates on hold. It will have to deal with inflation. And if it is stagflation, then also you can't rule out curbing the inflation expectations. That's the classic monetary policy response. but there's no need to cause a worry as of now because there is room. So you can hold the rates for now, at least for the first half.
Yes, that's true. The governor did say almost openly that you can interpret this as a pause for now, for the current and the medium term, was the impression he gave. Shailendra, what do you see in terms of where the currency is headed from the limited numbers or guesses you can have about the BOP? At least up until September 30, what is your guess for the currency? And secondly, the more important, Reserve Bank saying that that huge, shocking curbing of speculative positions, curbing of arbitrage positions is temporary and that they will restore the old status quo ante in course of time. So your reactions to both, when do you start seeing the NDF onshore market starting to merge? Will it happen later in the current year itself? And where do you see the rupee September 30?
So firstly, I would just, on the inflation point, I think I would just like to add to what Mithil said. I think what would matter is the second-round effects. I mean, the policy also clearly states it, that, if let's say inflation is just going up because of, supply disruptions and we don't see any second-round effects, I don't think RBI needs to act as long as inflation is, somewhere in the 5% vicinity. If there is a second-round effect, I think then RBI steps in. Coming to the question on currency, I think, right now, of course, there has been, a liquidation from the domestic banks, and that's, kind of added to the downward pressure on the currency. But I think come 10th April and, those positions would have been cleared. And then after that, we are back to, what's happening on the current account, how capital flow situation is. So I think, the fact is that, even after this, there are many headwinds to capital flows. I mean, one is that, of course, we know that FPI flows haven't been coming in. I mean, of course, you leave aside this episode in March when we had almost $13-14 billion of equity outflows, but that was driven more by the geopolitics. But let's say the normalcy comes in, and still we see that capital is going out. It's moving towards the markets which have AI themes, etc. Or FPIs feel that valuations in India are a bit stretched still. So those are the things which will drive the currency. So I would think that the best is kind of over. We should start to see rupee move in the 93, 94 kind of vicinity going forward. I think, interestingly, even the RBI assumption in the MPR is for 94 rupees average exchange rate, in the current year. Of course, that really doesn't mean that they are telling us that it will be there. But but I think it kind of ties in with what we are thinking. That there will be a gradual depreciation pressure, as far as the currency is concerned.
Fair point.
As far as the last point on the NDF, of course, we will wait for the, RBI guidelines. But, I think this time around, when the domestic banks step in, they will step in more cautiously. I think all banks will, have some kind of internal limits as far as the exposure to NDF is concerned. Because, I mean, this was, of course, it was done for the right reason. I mean, this was creating, pressure on the reserves. RBI was spending too much reserves. I mean, had these positions just been in NDF, that wouldn't have led to this kind of pressure. So I think it was done for the right reason. But I think, the risk managements of banks will kind of want to take this a little cautiously. So I don't think that, we will come to the market.
I take your point, Shailendra. Actually, running out of time, I want a very quick vote from all three of you. Don't give me ifs and buts. As of now, from what you know, do you see a rate hike in the second half? Mridul?
Yes.
Okay.
Maybe towards.
Okay, no ifs and buts. Shamiran?
Not in our baseline forecast.
Okay. One yes, one no. Shailendra?
Yes.
Okay, so there is a good chance of a rate hike. I would have wanted more votes, but let's see. There's no point taking a vote from you on currency at this point in time since there are so many moving parts. For the moment, gentlemen, thank you very much for giving us a better understanding of the way markets are headed. 93, 94 the rupee, that's useful, Shailendra, to point out that's what the RBI's assumptions are. Thanks for joining us, but don't go anywhere. After a very short break, We're going to be joined by the country's biggest banker. The SBI Chairman C.S. Setty will be with us in a minute when we return. Welcome back to our monetary policy special. The governor announced a status quo policy as far as rates and stance were concerned, but there have been sharp revisions to growth and to inflation. I'm being joined by the SBI chairman, Mr. C.S. Setty. Mr. Setty, thank you very much for your patience and for joining us. What do you make of this assessment of the economy? It's not a very, very negative assessment. For the first half of the year compared to what we were previously told, the growth rate has come down by about 20 basis points. Do you think that growth volume, credit growth, which has been your strong point, will be maintained in FY27, 15% thereabouts?
First of all, thank you, Lata. It's good always to interact with you. The broad assessment, what has come out of this monetary policy announcements is that there will be definitely the primary as well as second order impacts of the West Asian crisis. That is getting reflected in the slight moderation in the growth as well as inflation expectations, which are building up now. But it is also important that most of the effects would be more pronounced if things linger for a long time from the Q2 onwards. If you see, the inflation also is projected to go up from Q2 onwards. But I think there definitely would be some impact on the growth rate, which I agree with the
forecast,
the broad assessment which is coming out of that. As far as credit growth is concerned, obviously it's a function of the macros, and the banking system has been on the growth path. Credit growth has been robust. We have not seen any impact in the last quarter broadly in the banking system. Q1 generally may not be a great indicator because it is generally a tepid quarter for credit growth.
Okay.
So we need to see Q2 and Q3 how the credit growth is going to play out. There is an impact on many of the sectors, particularly which are dependent on the gas supplies. We have seen some of the SME clusters being, really impacted on account of lack of availability. So what I understand from many of the industry players is that supply constraints probably will be addressed. That means, you go from one source to another. But the cost-led inflation is a major challenge, and which may probably impact the overall consumption sentiment. I think that we need to be watchful on that. But broadly at this juncture, I think let's wait for one more quarter before we take a call what kind of impact will be on the credit growth.
No, I take your point on this prices being likely to be higher because there were several industrialists who spoke to us over the last few days, and they said, we are ready to buy gas at any price because they just want, their paint shops to go and their autos to hit the road. So there will be a price impact. But Mr. Sethi, what about credit quality? Even if there was stress already, you're not going to know it in 30 days, but you will know it in 90 days. It will show up in Q1. Are you expecting that the best of credit quality is over and now we will start seeing it climb? I mean, credit cost.
First of all, we believe, and let's hope that, this disruption will come to an end as soon as possible. The ceasefire is definitely a good positive development. But the disruption of this level would impact the businesses.
Okay.
And we hope that there will be statutory, fiscal as well as regulatory support coming. We are engaged with the Government of India as well as RBI to see that some of the support, the cash flow support, as well as regulatory forbearance, which can be given. At least we can prevent the immediate impact, while the long-term impact would have to be addressed structurally. Whether we can provide solace in terms of additional financing, the way we have done during COVID period, we got a very positive response from the Government of India on that.
You are discussing with RBI on that?
And on the regulatory measures, the relief measures, what RBI has given on the tariff-related regulatory measures, as you are familiar, they've given those measures during tariff issues.
Yes.
And they have extended further beyond 31st March. But we are now seeking that there should be some relief, a broader relief, which should be available to everyone, because it is very difficult to say who is impacted by West Asian crisis and who is not impacted. Yes. I think hopefully there will be some measures from the RBI point of view. They are also looking at the developments. The first thing what I would expect is Government of India's support in terms of the emergency credit line coming up soon, and followed by some regulatory forbearance is something what the banking industry is seeking.
Okay, that's fair, since this is a sudden and unexpected shock and not expected to linger, not a structural problem. So have you all made any calculations that you can share on what may be the hit of this sudden reduction in arbitrage positions that the Reserve Bank ordered on March 28? There would be mark-to-market losses. Any numbers you'll have come up with?
No, numbers anyway, definitely I cannot share because we're on the silent period. But I think you're talking about the yield movement, right?
Yes, yes. No, not yield. I meant the arbitrage dollars. Yeah, the basis point difference between onshore, offshore.
No, see, one thing is that as a large bank, we definitely had large positions. But we are able to unwind these positions at a very insignificant impact on our PL.
Okay. That's good to hear. If you can, if a large bank can, I would assume that the banking industry has escaped. A very quick word, will margins improve this quarter?
Sorry?
Will margins improve this quarter? The governor has assured surplus liquidity, which means call rate is going to be below repo rate. Will that margins improve, or are they going to be, just where they were in fourth quarter?
Margins are also kind of sticky in the sense that sticky at certain level. While the liquidity is definitely welcome, and I think as governor promised, proactive and preemptive kind of actions which have been taken in providing the liquidity have been quite useful to the banking industry. But the deposit rates are still elevated. We were not able to reduce the deposit rates as the repo rate, as the transmission which has happened on the loan side is not fully happened on the deposit side. I'm talking about the industry as a whole.
Fair point, sir.
So I don't think really we got benefited on account of on the margin side, purely based on the liquidity front. Liquidity has ensured that the good credit growth is supported by the system without constraining, without being constrained by the deposit growth rate. That's a major outcome of providing a durable liquidity in the system. Margins, I think there are so many other factors. I think people went overboard on the wholesale deposit side, paid higher rates of interest. So it's a discussion in itself, Lata. I think.
I take your point. I take your point, but I think it will help if you used your persuasive skills with the government to make them change the capital gains. I mean, the tax on deposits perhaps is going to be, the next discussion point, but that perhaps for another day. Mr. Sethi, pleasure having you with us on the channel on such an important day and elaborating what it means for the banks. I think the big takeaway we're getting from Mr. Sethi is it is an insignificant impact, the loss on winding down those dollar positions. That was a big worry for bank analysts and investors. That's a big relief. On that note, let's wrap up on this edition of the Monetary Policy Special. Thank you very much for watching. Stay right there. More news and updates are lined up for you.
Hello and welcome to this special show on the West Asia war. I'm Ashmit Kumar. Now, after 39 days of fighting, the United States and Iran have agreed to a ceasefire for 2 weeks. Both sides declared victory and have credited Pakistan for mediation post the news. Crude oil prices fell below the $100 mark per barrel, and the stock markets, in fact, have rallied across the world. The announcement came just an hour before President Donald Trump's deadline to bomb Iran's power plants and bridges was set to expire. Trump said that the ceasefire is subject to the complete opening of the Strait of Hormuz. Iran's Foreign Affairs Minister Sayed Abbas Araghchi has said that the country's military will ensure safe passage through the strait during this period, while President Trump has said that the U.S. will assist with ship traffic congestion at the strait. In a social media post, Trump claimed that the U.S. had met all its objectives. He confirmed receiving a 10-point proposal from Iran, which he said is a workable basis on which to negotiate. The 10-point plan includes a permanent cessation of war, continued control over the strait, acceptance of enrichment, lifting of all sanctions, compensation, and withdrawal of U.S. forces from the region. But where does Israel stand? Well, Prime Minister Benjamin Netanyahu's office has said that he supports the ceasefire. However, it added that Lebanon is not a part of this deal and military operations will continue. This contradicts statements coming in from Pakistan and Iran. Tehran has threatened to bomb Tel Aviv if Israel does not stop the attacks in southern Lebanon. So what's next? Pakistan Prime Minister Shehbaz Sharif has said that Islamabad will host high-level delegation talks from the US and Iran to clinch a conclusive agreement on Friday. Iran is planning a $2 million fee for ships to cross the Strait of Hormuz, which could yield more than $70 billion annually. But Oman, which also controls parts of the strait, says that no fees will be imposed for safe passage. President Trump also hinted that China likely played a role in pushing Iran towards negotiations. China has welcomed the truce and said that it supports Pakistan in making active mediation efforts. Even as a ceasefire has been announced, Kuwait has intercepted multiple drones over just the last few hours and reported significant damage to power and water desalination plants. The United Arab Emirates Defense Ministry has also reported that it actively engaged with missiles and UAV threats. The U.S. Vice President, meanwhile, J.D. Vance, has said that it is a fragile truce.
The Iranians have agreed to open up the straits. The United States has agreed to stop attacking. And that, not just the United States, but also our allies, have agreed to stop attacking. And that is the basis of this fragile truce that we have, which is now, 8 to 12 hours old. Now, here's what I'll say about this. I've learned a lot about the Iranian system and a lot about the way the Iranians negotiate. As the president told me last night, the Iranians are better negotiators than they are fighters. I'm sure they don't like to hear that, but it's true. But here's a couple things. So, one, just in the response that we've seen from various segments of Iran, you have on the one hand people within Iran who have responded very favorably. The foreign minister who said, look, we agreed to the United States' terms. We'll do a ceasefire, we'll do a negotiation, we'll open the Straits of Hormuz, and then we'll see if we can come to more agreement down the road. So some of the people have responded favorably and have said the right things. And then you have some people on social media within their system who are basically lying about what we've accomplished militarily. They're lying about the nature of the agreement. They're lying about the nature of the ceasefire. And so you have just, even within their system, and this is why I say this is a fragile truce, you have people who clearly want to come to the negotiating table and work with us to find a good deal. And then you have people who are lying about even the fragile truce that we've already struck. And that's just an interesting thing about their system. And the final point that I'll say about this is the President of the United States has told me, and he's told the entire negotiating team, the Secretary of State, the Special Envoy, Steve Witkoff, he said, go and work in good faith to come to an agreement. That is what he has told us to do.
And in fact, even as we speak, we're getting some interesting insights. President Donald J. Trump has posted on Truth Social once again, and this time he says a country supplying military weapons to Iran will be immediately tariffed on any and all goods sold to the United States of America. 50% effective immediately. There will be no exclusions or exemptions. President Donald J. Trump. So again, hinting possibly at Russia or China? These are, of course, aspects that we'll unfold with the benefit of the guests that we have on the panel with us. Joining us now to discuss this are with us former Foreign Secretary Mr. Shashank, Banyan Tree Global's founder Sanjeev P. Yadav. Also joining us from Iran is Mr. Dr. Javed Rad, the assistant professor coming in, joining us from Iran. Professor Rad, let me come to you first. Again, we've just heard Donald Trump hinting at possible action against the likes of possibly China for militarily supporting Iran. Going forward, again, there's a lot of speculation on what brought Tehran to the negotiating table. They've rejected earlier attempts, earlier overtures by Donald Trump, by the United States. So again, the question many are asking is what turned things around for Tehran to finally agree to join the negotiations? Was it the China factor? Was it Donald Trump threatening possible genocide of an entire civilization? What are the factors that led to this ceasefire on part of Iran?
Well, that's a very good question. Iranians have always been open to negotiations, and provided that they are meaningful, they are towards a lasting peace. What we had before this was that we didn't have quite confidence in the American proposals, and so the idea behind prolonging war and making the war a war of attrition for the Americans was that so we could continue the defense until they are really exhausted. And of course, Iranians weren't out of arms, weren't out of plans to further retaliate if Trump decided to commit those heinous crimes that he pointed at. So in the eyes of at least the administration in Iran, the time was quite ripe. 40 days of resisting, 40 days of punishing the aggressors, not for the sake of a probable negotiation in the future, but for the sake of a longer-term peace. In the sense that if any other nation, any other president, even in the United States, decides or thinks to wage a war against Iran, they would think twice. So this is what the idea was behind the prolonging of the defense against the Israeli and American invasion. That said, Iranians have always been open to negotiations, provided they are meaningful. They have said, as Mr. Arafchi has pointed out, and Trump reposted that on his Truth Social, I guess, there are 15 points by the Americans, there are 10 points by Iranians. They are probably far apart from in many perspectives, but it seems that since Trump posted that, it means that, and J.D. Vance is behind the wheels this time, not the warmongers in the administration. It seems that there are good signs for a probable negotiation. We don't know what may happen during the 2 weeks of negotiations, and Iranians are quite worried about that. That's why J.D. Vance also mentioned that there are people in Iran who are worried.
2 weeks is a very long window to look at. We're not quite sure what might happen over the next 2 days as well. 10th of April is when the talks are slated to happen in Islamabad. But Mr. Shashank, if I may come to you again, there are questions being raised as to how sustainable this ceasefire is even for the 2-week period. J.D. Vance himself says that this is a very fragile truce. We've seen comments coming in from Prime Minister Benjamin Netanyahu's office that this truce does not apply to Lebanon. So again, there are fractures in terms of even the initial assessment of what covers, what is the scope of this ceasefire. So again, I ask you, how tenable, how sustainable is this ceasefire? Will it hold? Is question that many are asking.
No, good thing is that there is a ceasefire, and this ceasefire has come after total lack of trust between the two sides, where the 15-point plan from the United States was seen as a completely contrary to the 10-point plan of Iran. Now suddenly the 10-point plan has become the plan which can be a good basis for discussion. I think Iran also feels that perhaps the American democracy has exerted itself, and so President Trump, after making his very dramatic and foreboding claim that the whole civilization will land never to rise again, I think he has perhaps been made to realize that this is not a language which an American president should be using. So I think perhaps he has gone back on that, is willing to go on the basis of the Iranian 10-point proposal. But I'm not very sure about the Israeli thing. You are quite right at this point, because the understanding may be that the proxies of Iran would also be covered under the ceasefire, but Israel does not think so. And I think they will perhaps continue as the Hezbollah will continue. So I think this is the thing which is likely to continue for some time. The other part maybe perhaps in the next 2-3 days we'll get to realize as to what all is going to happen. But it's a fragile piece because Iranian leadership, I think, is divided on its opinion about trusting the Americans. American leadership is divided about trusting the Iranians. So I think those things still remain. Those points are still to be considered.
Sure. Mr. Yadav, coming to you again, there seems to be a big pivot by the President of the United States, again, under heavy fire for the language that he's used on Truth Social, on his social media posts. But that aside, there seems to be a big pivot. Just a few hours back, we saw him threatening the ending of an entire civilization as far as Iran is concerned. 90 million people there in Iran. And then just a few hours later, we see Donald Trump talking and accepting some of these terms that have been prescribed by Iran, 10 of them, calling them how this is, quote unquote, a workable basis on which to negotiate. And again, mind you, these terms that have been put forth by Iran include lifting of sanctions, allowing enrichment of uranium, exercising control over Hormuz. Again, what has led to this shift in stance by Donald Trump? What compelled him to make this change?
So, Ashwin, I don't think it's actually been a pivot. I think it has been a coordinated, classic President Trump controlled pressure campaign. And we can debate the word controlled there, but it has been a maximum pressure campaign that has been up and down in terms of the levers of pressure that have been exerted by the United States and in some cases in concert with the Israelis. And you saw yesterday evening the initial attacks against military targets in Karg Island, which had been, this pending action that all of us globally have been debating if and when that might occur. I think a lot of pressure in the last 2-3 days militarily was being put on the Iranian side. You saw proposals being sent back and forth and exchanging hands from both sides. And as I've mentioned many times here with you, I think the silent figure sitting behind the scenes has been China. And I think the Chinese role definitely played a role also on the Iranian side from a pressure perspective at the last minute as talks were going on. But I think if we take a step back, one, yes, peace has won today, and I think that's a very strong positive, hopefully going forward. It is 2 weeks, as you said, is a very long time. A lot can happen. A lot can happen within hours and days. We've seen attacks continuing today. Reports are of missile attacks and drone attacks in the UAE, Kuwait, Qatar, Israel as well. There's reports of an attack in Iran at Lavon, I believe, gas field. So the question is really, one, can this hold? And two, where do we go from here? And I think over the next 2 weeks, I think you're going to see, and especially by probably this weekend and Friday, you'll see the beginnings of where is the basis. We have the 15-point plan, the 10-point plan, and going forward, I think the United States is really going to be focusing on those core issues about the nuclear program, the missile program.
Right.
And
Mr. Yadav, I'll just come in on that one aspect as to where do we go from here. I just want to get your thoughts on this latest post by Donald Trump when he says that there will be effective immediately 50% tariffs on a country that's militarily supporting Iran. Now, there have been also reports which suggest that China was the one which pushed Iran to actually join the negotiating table. And here's a tweet by the President of the United States hinting at strong tariff action, possibly against China. Why this position now? And is this, again, one of the strong arm tactics used by Donald Trump?
This is all part of the pressure campaign. I think if we just take a step back, and I'll give a quick encapsulation of the last 12 months leading up to this point, you have President Trump come into office. You have the initial actions to remove Chinese involvement or control of the Panama Canal. You have the actions in Venezuela. You have the broader actions in the so-called Americas region, pushing China out of the Americas region. You have the removal of Russia de facto from the Middle East now with what happened in Syria. So you've had these two global powers, so to speak, removed from their spheres of influence, and then you have energy as the other wild card in terms of Venezuela and then Iran. So I think, as I've been saying, keep your eyes on China, keep your eyes on May 14th and the summit between President Xi and President Trump. I think this is all a message to the Chinese and to a lesser degree to the Russians. We saw in the week prior to the launch of this conflict reports that the Chinese had deliveries pending or on their way of anti-ship missiles to which would have been a serious threat, obviously, to allied forces in the region, to Iran. So this is part of this coordinated maximum pressure campaign and the various levers that are being put on not only the Iranians, but also the Chinese and to another degree, the Russians.
That's clearly something that's on Donald Trump's radar as we speak. I'd like to request all of our panelists to continue to stay on with us. We're slipping into a very short break, but we'll continue this conversation on the other side. Welcome back. We continue to discuss what's next in the 14-day ceasefire that has been announced between US and Israel. I have with me former Foreign Secretary Mr. Shashank, Banyan Tree Global's founder Sanjeev P. Yadav, as well as Dr. Javed Rad, Assistant Professor from the University of Borjnud in Iran. Dr. Nath, again, coming to you, I just want to get a sense in terms of Iran has confirmed that there is a delegation that will be heading towards Islamabad come this Friday. That's April 10th, of course. A two-part question. Number one, any details emerging as to who will be leading this delegation on behalf of the Iranian leadership, one? And two, is there an appetite, is there that flexibility, especially on some of the thorny issues, such as continuing the enrichment of uranium, such as control over the Strait of Hormuz, levying that $2 million fee? Are those coded, are those carved in stone, or is there flexibility around these demands, these proposals put forth by Iran?
Well, it seems that the Iranians, from the very beginning, if they wanted to yield away, they could have done it before even we had the 12-day war. So foregoing, for example, the nuclear rights of Iran is something that I don't personally believe. And the general idea here, at least, is that Iranians cannot forego that. So the idea for the nuclear program might lead into some sort of consortium, inviting other countries to not only produce and enrich uranium less than 3.5% like the nuclear deal under the Obama administration. And Iran has always mentioned that it doesn't really need more than that, provided there are sanctions relief, there are and stable situation regarding regarding the region. So, first of all, with regards to the nuclear issue, I don't think that Iran would forego that. The second, there are probably the Strait of Hormuz is up for negotiation. $2 million fee could be up for negotiations, provided that there is some sort of mechanism for war reparations. As you all know, that the attacks have destroyed many civilian projects in Iran, and it needs to be fixed. Might be due to sanctions relief, they can be repaired, but it is something for the negotiations. Regarding the persons or the delegation who might attend the negotiations, there are talks that, for example, the Speaker of the Parliament, Mr. Ghalibaf, would probably attend, or the Speaker of the National Security Council in Iran. We don't know yet. There are talks, but for sure, Americans would not probably meet somebody like Javad Zarif, who led the delegation during the 2015 nuclear deal. It is probably somebody who is more hardline and more responsible towards the supreme leader and the military group in Iran.
So interesting details, interesting insight, Dr. Rad, in terms of how there may be perhaps certain flexibilities, even with the Iranian position, as far as whether that's nuclear enrichment or the control of Hormuz is concerned. But Mr. Shashank, let me come to you. Let me get your thoughts on the choice of Islamabad, again, acting as a mediator as far as this entire negotiation is concerned. Friday, of course, is the big day. Delegations will be coming from all sides in terms of negotiating a settlement. What I want to understand is, how does this position Pakistan? Does it elevate their stature, especially when it comes to the South Asian geopolitics? After this, should these talks yield any results, Pakistan will have close ties with West Asia, with the Gulf region, with United States as well. Does that change the dynamics for the regional geopolitics of South Asia?
Well, I think Pakistan used to look after the Iranian interests in USA. So therefore, it was a natural conduit for the American proposals to be sent to or shared with Iran. Now that Iran has also agreed to use Pakistan as one of the channels for these talks, I think it's good for Pakistan that they have confidence on both sides, in Iran as well as in USA. This is good for the start of the talks. And then China, of course, is also interested that Pakistan should remain under some kind of indebtedness to China. And you know, China has spent several $1 billion in Pakistan. Pakistan must have conveyed to the Americans that in case they want to wipe out a civilization right next door to Pakistan, there are likely to be impact on the Pakistani population also. And perhaps please keep that in mind. And that would be affecting the Chinese interests and investments in Pakistan, as well as President Trump's personal investments and Bitcoin's investments in Pakistan in Bitcoins and in the various kind of minerals, rare earth minerals and other commodities there. So I think therefore Pakistan has that position and they have played very nicely and very good. I must say that what we want is peace in the region, and irrespective of whatever goes on about the Strait of Hormuz, I think Pakistan would have been the first affected party in case the war was prolonged.
Right, Mr. Shashank. The long and short is that all eyes will be on Islamabad come April 10th. That's when the delegations will be heading towards Pakistan for greater negotiations, and that's when perhaps we can expect more clarity on the way forward. I'd like to thank all of our panelists for joining us, Mr. Yadav, Mr. Shashank, Mr. Dr. Rad, for joining us with your insights. But with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Qasem Soleimani, to tearing up the disastrous Obama-Iran deal, to the precision campaign that obliterated Iran's nuclear sites in Operation Midnight Hammer, to the decisive military victory we just achieved in Operation Epic Fury. No other president has shown the courage and resolve of this commander-in-chief. President Trump forged this moment. Iran begged for this ceasefire, and we all know it. As the President truth this morning, a big day for world peace. Iran wants it to happen. They've had enough. Operation Epic Fury was a historic and overwhelming victory on the battlefield. A capital V military victory. By any measure, Epic Fury decimated Iran's military and rendered it combat ineffective for years to come. You see, in less than 40 days, one of our combatant commands, Central Command, CENTCOM, using less than 10% of America's total combat power, dismantled one of the world's largest militaries. The world's leading state sponsor of terrorism proved utterly incapable of defending itself, its people, or its territory. We untied just a fraction of our strength, and Iran suffered a devastating military defeat. Together with our Israeli partners, America's military achieved every single objective, on plan, on schedule, exactly as laid out from day one. Iran's Navy is at the bottom of the sea, whether it's the Soleimani class, their frigate class, their prized drone aircraft carriers, submarines, mine layers, sunk. Iran's Air Force has been wiped out. Iran no longer has an air defense, any sort of a comprehensive air defense system. We own their skies. Their missile program is functionally destroyed. Launchers, production facilities, and existing stockpiles depleted and decimated. And almost completely ineffective. Iran shot hundreds and hundreds of missiles and one-way attack drones at our aircraft carrier. They were obsessed with it, and they never got even close. Every single one of those shots easily shot down miles and miles away from the Abe Lincoln. They were blowing ammo into fantasy land. Contrast that with, most significantly, in last night's wave of more than 800 strikes, we finished completely destroying Iran's defense industrial base, a core pillar of our mission objective. What little they have left buried in bunkers is all they will have. They can still shoot, we know that. Their command and control is so decimated they can't really talk and coordinate, so they still may shoot here and there, but that would be very, very unwise. But they can no longer build missiles, build rockets, build launchers, or build UAVs. Their factories have been razed to the ground, set back in historic fashion. You see, had Iran refused our terms, the next targets would have been their power plants, their bridges, and oil and energy infrastructure, targets they could not defend and could not realistically rebuild. It would have taken them decades, and we were locked and loaded. They couldn't defend against it. President Trump had the power to cripple Iran's entire economy in minutes, but he chose mercy. He spared those targets because Iran accepted the ceasefire under overwhelming pressure. The new Iranian regime understood that a deal was far better than the fate that awaited them. This new regime just happened to look at what happened to their predecessors. Their top leadership was systematically eliminated. The previous Iranian supreme leader, dead. The Supreme National Security Council Secretary, dead. The Supreme Leader Office Advisor, dead. The Supreme Leader Military Office Chief, dead. The Defense Minister, no longer with us. The IRGC Commander, dead. The Armed Forces General Staff Commander, dead. The Intelligence Minister, dead. The IRGC Navy Commander, no longer here. The IRGC Intel Chief, dead. I skipped over a bunch, and I could go on and on and on, to include the so-called new supreme leader wounded and disfigured. This new regime was out of options and out of time, so they cut a deal. They know this agreement means that they will never, ever possess a nuclear weapon. Under the terms, any nuclear material they should have will be removed. Any material, they should not have will be removed. Right now, their dust is deeply buried and watched 24/7 overhead. The president has been clear from the beginning, there will be no Iranian nuclear weapons. Period. Full stop. Other presidents said it. President Trump did it. Operation Epic Fury. Less than 6 weeks, clear mission, decisive action, overwhelming firepower, America first, a historic battlefield victory. For decades, Iran killed Americans with roadside bombs in Iraq, using cowardly proxies to do their dirty work while they hid safely in Tehran. They struck our embassies with car bombs and attacked from the shadows, never daring to face us toe-to-toe. They thought they could bleed America with impunity. Well, they just learned the hard way what happens when you try to fight us directly. And even when they got lucky, one time in 40 days, and down 2 of our pilots, they couldn't hold them. In a daring 14-hour rescue operation, 7 hours in daylight and 7 hours of night, both pilots were recovered safely. Not once, but twice. A daylight thunder run right up the middle of their country, boots on the ground. A midnight raid right up the middle of their country, boots on the ground. 0 American casualties. The Iranians humiliated and demoralized. We control their fate, not the other way around. That's why they came to the table. Iran's defeat is America's retribution for every American lost to Iranian terror, especially those brave troops killed by Iranian-made roadside bombs in Iraq that my generation knows so well, and for the suffering their regime has inflicted around the world. Now we have a chance at real peace and a real deal. The War Department, for now, has done its part. We stand ready in the background to ensure Iran upholds every reasonable term. And as everyone knows, nobody makes a better deal than President Trump. To the warriors of Epic Fury, I say well done. You're the backbone of our country. Your skill, your bravery, and sheer guts and grit showed the world what America is all about. I'm proud of you. We're proud of you. President is proud of you. Job well done. But stay vigilant and stay ready. To the families of our fallen, your sacrifice was in service of a historic cause, and we will always remember your heroes, our heroes. We will continue to honor them. And to our Israeli allies, thank you for being a brave, capable, and willing ally on this battlefield. The rest of the world and the rest of our so-called allies saw what real capabilities look like. They should take some notes. Our troops, our American warriors, deserve the credit for this day. But God deserves all the glory. Tens of thousands of sorties, refuelings, and strikes carried out under the protection of divine providence, a massive effort with miraculous protection. Dude 44 Bravo spoke for all of us. God is good. The chairman will now provide an even deeper military detail on the historic success of Operation Epic Fury. Mr. Chairman.
Thank you, Mr. Secretary, and good morning, ladies and gentlemen. Thanks for being here. I want to start this morning by honoring the 13 members of our American Joint Force who were killed in action thus far during this operation. Their sacrifice and that of their families is deeply important to us, and we are grateful for each of them, and will continue to mourn their loss. Their names and their bravery will never be forgotten. On February 28th, the President of the United States ordered the Joint Force to execute Operation Epic Fury with the direct a direction to accomplish 3 distinct military objectives: destroy Iran's ballistic missile and drone capabilities, destroy the Iranian Navy, and destroy their defense industrial base to ensure that Iran cannot reconstitute the ability to project power outside their borders. Over the course of 38 days of major combat operation, the joint force achieved the military objectives as defined by the President. We welcome the ongoing ceasefire, and as the Secretary said, we hope that Iran chooses a lasting peace. But as Secretary Hegseth said, let us be clear, a ceasefire is a pause, and the joint force remains ready if ordered or called upon to resume combat operations with the same speed and precision as we've demonstrated over the last 38 days, and we hope that that is not the case. I want to congratulate and thank the leadership today at U.S. Central Command, including the Commander Admiral Brad Cooper, the Deputy Commander Lieutenant General Kevin Leahy, the Senior Enlisted Leader Fleet Master Chief Compton, and every one of the component commanders, senior enlisted leaders, and especially the staff down at U.S. Central Command, who does not get called out for any of the credit, but grinds 24/7 to help offer the options that we bring to the Secretary and the President. I also want to highlight the forces in the United States European Command under the command of Alexis Grinkowicz, who protected the western flank in support of CENTCOM. And I want to thank our partners across the intelligence community. Our ability to see and understand what an adversary is doing help us to be as decisive as we must be on the battlefield. And that includes DIA, NSA, NGA, the CIA, and the National Reconnaissance Office, and others. I want to thank the other combatant commands who have thus far contributed along the way to U.S. Central Command. This includes Transcom, Stratcom, Spacecom, SOCOM, and Cybercom, all of whom poured all in support of CENTCOM's efforts. And I want to thank, as the Secretary did, our Gulf partners who fought alongside each and every one of us every day. From the Kingdom of Saudi Arabia, the UAE, Bahrain, Qatar, Kuwait, and Jordan, all who joined us together to defend and protect our people and our assets, and who, if required, stand ready to do so again. And I want to thank my team at the Joint Staff who work literally around the clock in order to help me offer the options that I must with the associated risks to the Secretary and to the President. They are the hardest working people that I know, and I am deeply grateful for their service. Most importantly today, I want to thank America's members of the Joint Force who've poured everything that they can into Operation Epic Fury, and their families who've worked 24 hours a day for 38 days. The Secretary and I could not be more proud of each and every one of you. And we deeply appreciate the support of the American people, who we know always have us in our thoughts and prayers. And we can feel this literally every single day. As the Secretary said, the United States has devastated the regime's ability to harm Americans and our interests for years to come. Since the beginning of major combat operations, the United States Joint Force has struck more than 13,000 targets, including in that 13,000 more than 4,000 dynamic targets that popped up on the battlefield and were immediately addressed, thanks to the exceptional command and control system and intelligence, acumen, and agility of our Joint Force. CENTCOM forces destroyed approximately 80% of Iran's air defense systems, striking more than 1,500 air defense targets, more than 450 ballistic missile storage facilities, 800 one-way attack drones storage facilities. All of these systems are gone. We've devastated Iran's command and control and logistical networks, destroying more than 2,000 command and control nodes and degrading their ability to target U.S. and friendly forces. It is, and we know this, incredibly frustrating right now to be a lower-level Iranian commander trying to fight your fight. As the Secretary said, the Iranian Navy now lies mostly at the bottom of the Arabian Gulf, and we assess that we've sunk more than 90% of their regular fleet, including all of the major surface combatants, as the Secretary said. 150 ships are at the bottom of the ocean, and half of the IRGC Navy's small attack boats. Joint fires protected from the land, sea, and air executed more than 700 strikes against naval mine targets, and we had assessed that we destroyed more than 95% of their naval mines. And perhaps most importantly, we've destroyed Iran's defense industrial base, their ability to reconstitute those capabilities for years to come. We attacked, along with our partners, approximately 90% of their weapons factories. Every factory that produced Shahed one-way attack drones was struck. Every factory that produces the guidance systems that go into those drones was struck. Their missile defense industrial base is shattered, with more than 80% of their missile facilities gone, as well as their solid rocket motor production capability. It will take years for Iran to rebuild any major surface combatants, as more than 20 naval production and fabrication facilities have been damaged or destroyed, and nearly 80% of Iran's nuclear industrial base was hit, further degrading their attempts to attain a nuclear weapon. Throughout Operation Epic Fury, our joint force struck at the heart of Iran's ability to project power and threaten the United States and the region. And in order to do this, it required the service and sacrifice of more than 50,000 American warfighters deployed across CENTCOM, EUCOM, and stateside. The joint force flew more than 10,000 missions, including 62 bomber missions, 18 of which flew round trip from the United States to deliver bombs on military targets. Each of these missions was more than 30 hours in duration, and we did that 18 times. No other military in the world can do that. And it's a testament to the logistical force that quietly serves behind them. I cannot thank TRANSCOM and the Air Force Tanker and Mobility Force more. Combined with Army and Navy joint fires, we struck more than 13,000 targets. And along with our Gulf partners, we've thus far intercepted 1,700 ballistic missiles and one-way attack drones, defending our forces and our partners in the civilian population. And we remain ready to do so should the need arise. Along the way, we consume more than 6 million meals, and by my estimate, more than 950,000 gallons of coffee, 2 million energy drinks, and a lot of nicotine, but I am not saying that we have a problem. I've laid out the statistics, but it does not truly capture the nature of combat. This is gritty and unforgiving business. It's chaotic, it's hot, it's dark, it's unpredictable, and there's always unknowns. And our people proudly walked into those unknowns and continue forward. And through it all, the joint force has demonstrated the unwavering resolve that the nation demands of us. We are a mission-focused force, and our objectives always is to create the conditions for peace, and today we have, while be ready should that peace break, which we hope it is not. And we remain ready. Before I turn it back to the Secretary, I also want to quickly revisit the rescue of the Air Force fighter crew over the weekend. To give you an update, we've had, the Secretary and I have had the profound honor of speaking directly with many of the warfighters on that mission, from the downed crew that were picked up to those forces that went and got them. Hearing these stories firsthand has only deepened our appreciation for their tenacity, creativity, courage, and grit of the American Joint Force. This is a story that gets to the very heart and soul of who we are as a joint force, who we are as Americans. Selfless sacrifice in service of others. From the backseater, Dude 44 Bravo, whose pure and unadulterated joy at seeing those helicopters come into the valley to get his front seater in daylight, because he knew the front seater did not have a jacket, and was so filled with heart-leaping joy at his front seater getting picked up, to the nighttime folks that went in and then got him, to the tanker forces that did the things that they had to do to give their own gas away, to the support packages, to those that went into the desert landing site not once, not twice, but 3 times as we fought through multiple contingencies. This was and is a joint force that has the guts to try, that does not quit, and who each and every day does the things that we must to dare to win. No lives were lost. We succeeded because the joint force is always at the ready. They trust each other, they trust their leaders, and they trust their training. And they remember first, foremost, and always that we do these things so that others may live, and we will never leave anyone behind. The success of Operation Fury thus far, and we hope it remains, culminates with this incredible rescue over the weekend, a direct example of the professionalism and courage of the United States military and our joint force. It's the service members on the front lines, our partners in the region, our teammates in the intelligence community, our civilian leaders in the OSW side of the house, the American workers who build the tools and weapons that we use, and the American people who back us up that help us to go do these things.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The US and Iran agreed to a ceasefire for 2 weeks. Both sides declare a victory and credit Pakistan for mediation. Tehran promises safe passage through the Strait of Hormuz for 2 weeks under Iranian military management. President Trump says the US will assist with ship traffic congestion at the strait. Pakistan's Prime Minister says Islamabad will host high-level delegations from the US and Iran for negotiations to clinch, quote-unquote, a conclusive agreement on Friday. President Trump says China likely played a role in pushing Iran towards the negotiations. Israel's Prime Minister Netanyahu says Lebanon is not part of the ceasefire deal and military operations will continue. This contradicts statements from Pakistan and Iran. Tehran threatens to bomb Tel Aviv if Israel does not stop the attacks in southern Lebanon. Crude oil prices plunge below $100 a barrel. Stock markets rally across the world. Iran is planning a $2 million fee for ships to cross Hormuz, which could yield more than $70 billion annually. But Oman, which also controls part of the strait, says no fee will be imposed for safe passage. There is no official confirmation on a toll just yet. The Sensex gains nearly 3,000 points and Nifty reclaims 24,000 after a month as all sectoral indices gain ground. Dalal Street adds 16 lakh crore rupees to market cap today. The rupee gains over 40 paise against the dollar and moves to the 92 mark. RBI maintains the status quo on policy rates, keeps the neutral stance unchanged as expected. The central bank adopts a wait-and-watch approach on how the Gulf crisis will pan out, projects 6.9% GDP growth in this financial year compared to 7.6% growth in the last fiscal. RBI provides a capital boost to banks and non-bank finance companies, allows banks to count quarterly profits in their capital adequacy, dispenses with the investment fluctuation reserve. NBFCs get access to the call money market for their liquidity needs. India's airport tariff regulator cuts landing and parking charges across major airports by 25%. The move is aimed at providing some relief to airlines struggling with soaring fuel costs. International Air Transport Association warns that jet fuel prices will take months to normalize, even if Hormuz remains open. Q4 earnings season kicks off tomorrow. IT major TCS expected to report a modest 1% growth in revenue. The Nifty IT index is down 24% in Q4 amidst fears of a SaaS-pocalypse. A meeting between Trinamool Congress leaders and Election Commission official turns acrimonious. Trinamool alleges the Chief Election Commissioner told the delegation to, and I quote, get lost. The Election Commission accuses the TMC of shouting West Bengal votes in less than 2 weeks. Well, straight to the top story this evening. United States and Iran have declared victories as they have announced a ceasefire which will go on for 2 weeks or till there is further notice. This after 39 days of intense airstrikes. U.S. President Donald Trump making the announcement in a Truth Social post an hour ahead of his own deadline to bomb Iran's power plants and bridges. Now, Trump said that Pakistan's Prime Minister Shehbaz Sharif and Field Marshal Asim Munir asked him to hold off on attacking Iran, subject to Tehran agreeing to open the Strait of Hormuz. Trump reiterated that the U.S. has achieved its objectives in Iran. He said that almost all of the various points of past contention have been agreed upon and the agreement will be finalized in the next 2 weeks, adding that Washington has received a 10-point proposal from Iran, which he called a workable basis on which to negotiate. Now, Iran's 10-point conditions include a permanent cessation of war, continued control over the Strait of Hormuz, acceptance of enrichment of uranium, lifting of all sanctions, compensation and withdrawal of U.S. forces from the region. Iran's Foreign Minister Abbas Araghchi confirmed the tentative ceasefire but maintained that Iran will stop military operations if U.S. and Israel stop their attacks. Araghchi also said that the passage through the strait will be possible via coordination with Iran's armed forces and the acceptance of Iran's 10-point plan. However, Lebanon's inclusion in the ceasefire remains uncertain. Although Pakistan's Prime Minister said the agreement included Lebanon, Israel's Prime Minister Netanyahu maintains that it does not. In fact, airstrikes by Israel continue in the region. Israeli military said it will continue to attack Hezbollah infrastructure. This as the militant group accepted the 2-week agreement. Iran's National Security Council has warned that Tel Aviv could come under attack if hostilities in southern Lebanon continue. Now, according to media reports, the council said, and I quote, if the firing does not stop in southern Lebanon within a few hours, the air and missile unit will bomb Tel Aviv. Meanwhile, Pakistan's Prime Minister has said that Iran's president has confirmed in a phone call that Tehran will participate in the negotiations in Islamabad. This comes as US Vice President J.D. Vance has said that the truce remains fragile while reiterating that all military objectives have been achieved by the US.
The Iranians have agreed to open up the straits. The United States has agreed to stop attacking. And that, not just the United States, but also our allies, have agreed to stop attacking. And that is the basis of this fragile truce that we have, which is now, 8 to 12 hours old. Now, here's what I'll say about this. I've learned a lot about the Iranian system and a lot about the way the Iranians negotiate. As the president told me last night, the Iranians are better negotiators than they are fighters. I'm sure they don't like to hear that, but it's true. But here's a couple things. So, one, just in the response that we've seen from various segments of Iran, you have on the one hand people within Iran who have responded very favorably. The foreign minister who said, look, we agreed to the United States' terms. We'll do a ceasefire, we'll do a negotiation, we'll open the Straits of Hormuz, and then we'll see if we can come to more agreement down the road. So some of the people have responded favorably and have said the right things. And then you have some people on social media within their system who are basically lying about what we've accomplished militarily. They're lying about the nature of the agreement. They're lying about the nature of the ceasefire. And so you have just, even within their system, and this is why I say this is a fragile truce, you have people who clearly want to come to the negotiating table and work with us to find a good deal. And then you have people who are lying about even the fragile truce that we've already struck. And that's just an interesting thing about their system. And the final point that I'll say about this is the President of the United States has told me, and he's told the entire negotiating team, the Secretary of State, the Special Envoy, Steve Witkoff, he said, go and work in good faith to come to an agreement. That is what he has told us to do.
A fragile truce, but J.D. Vance there, the U.S. Vice President, saying that President Trump wants to get a deal done with Iran. Now, President Trump believes China played a role in the ceasefire deal. Speaking to AFP, Trump said China is likely to have persuaded Iran to come to the negotiating table. Trump was forced to delay his visit to China, which was scheduled in March. He will now visit Beijing next month. China's foreign ministry also welcomed the ceasefire and said it is supporting Pakistan in making active mediation efforts. Several world leaders have welcomed the ceasefire announcement. British Prime Minister Keir Starmer is scheduled to travel to the Gulf. India has also welcomed the agreement. External Affairs Minister S. Jaishankar will visit the UAE next week. Here's Australia's Prime Minister on the ceasefire deal and what it means.
This is positive news. We've been calling for a de-escalation for some time. We want to see a resolution of the conflict. The potential of damage to civilian infrastructure in Iran was an extraordinary statement to make. And then also the impact that would have arisen from an escalation within Iranian response would have led to greater global economic damage.
Well, that is the response there coming in from Australia's global leaders react to that two-week ceasefire deal. Crude prices have fallen below the $100 mark for the first time in nearly a month. The global stock market also rallied, with Asian markets closing largely in the green. Precious metals also up in trade today. Reports suggest Iran is planning a $2 million fee for ships to cross the Hormuz. JP Morgan estimates the fee could yield more than $70 billion annually. But Oman, which also controls part of the strait, says that no fees will be imposed for safe passage. There is no official announcement on any potential fee so far. Manisha is here with more on the future of the Strait of Hormuz. Manisha, this is the big bone of contention.
Well, there is a 2 week of a ceasefire, and the crude oil prices have reacted to this with 15% of a decline. But what this also has led to is Iran creating a Strait of Hormuz revenue projections therein. If you look at the overall mathematics of this, as per various reports, we do understand that Iran currently is charging 2 million barrels for every vessel that is crossing Strait of Hormuz, and that perhaps would continue going forward as well. Now, 100 to 130 vessels is what crosses Strait of Hormuz on a daily basis. This is, of course, a number that comes in from before West Asia conflict. If you do the maths of this, that means that Iran would perhaps be generating a revenue of around $70 to $90 billion on an annual basis therein. This is much higher than the toll that is charged by various other water canals or waterways. Panama Canal, for one, generates a revenue of $5.7 billion. You have Suez Canal that does $4 billion. This was in 2025. Suez Canal actually has been doing $10 billion and more than that as well. But now, because the congestion or the traffic has declined, the amount also has declined same way. Also, when you look at the St. Lawrence Seaway, it just about generates $86 million. And then you have Bosphorus and Dardanelles, which does $227 million in an annual basis on revenue there. And then you have Kiel, which is one of the busiest one in Germany, just about does 20 to 30 million therein. Much of this is really funded by the government therein. But there are other important waterways as well, which have the right of free passage under the international law. They are not private waterways and there is no toll on these. So within this, you have Strait of Malacca, which does 100,000 vessels in an year. And then you have Gibraltar Strait, which does 300 ships on a daily basis, one of the busiest one again, also known as the oil artery of Asia therein. And then you have Singapore Strait as well, which does 90,000 to 100,000 ships on a daily basis. This list actually had Strait of Hormuz as well until a couple of months ago, but now it is generating revenues for Iran, with the street anticipating it's going to be the most expensive one or the highest generating revenues trade canals ever.
Well, Manisha, many thanks. But as we've been pointing out, there is no official confirmation just yet on that toll. If it does go through, it is going to change rules of the game forever. On to the day's market action. The Sensex and the Nifty posting sharp gains today on the back of that ceasefire between the US and Iran. Frontline indices registered gains in the range of 4 to 5%. The Nifty 23,997, up almost 900 points, a gain of about 4%. The Sensex up 4% as well. The Nifty Bank up 5.5% and a 4% gain there coming in for the Nifty Mid Cap as well. So we've seen across the board gains coming in. BSE listed companies have gained market cap of nearly 16 lakh crore rupees. But from equities to the currency market, the rupee gained 40 paise against the dollar and has moved closer to the 92 mark. RBI Governor Sanjay Malhotra reiterating that RBI's recent intervention in the forex market was solely aimed at curbing volatility, and we will have to wait to see what the RBI's response will be going forward.
These are reactions to the specific market movements. These are not, in any sense, they are not signaling any structural change. We stand committed long term, we stand committed to the development, broadening and deepening of these markets, to the internationalization of the rupee. And so obviously, these are not measures which are going to remain there forever.
Well, that is the RBI on the currency market. The government has allowed the supply of commercial LPG to a wider set of industrial sectors. The centre has also asked states to operationalise the decision. The Petroleum Secretary has said that industries including polymer, agriculture, packaging and others will be eligible to receive up to 70% of their pre-March consumption levels. However, the allocation will be capped at an overall sectoral limit of less than 1,000 metric tonnes a day. Now, India's airport tariff regulator has cut landing and parking charges across major airports by 25%. This move is aimed at providing some relief to airlines that are struggling with soaring fuel costs. The International Air Transport Association has warned that jet fuel prices will take months to normalize, even if the Strait of Hormuz remains open. Shivani standing by with the details. Shivani, this was a demand that airlines had put forward to the government. The government has now provided temporary relief for the next 3 months.
Well, while the ceasefire news is a good news for the global economy, the jet fuel prices are still elevated and refusing to cool off, and that's now becoming the biggest overhang for the aviation sector. The International Air Transport Association has warned that the aviation turbine fuel prices could take months to normalize from these levels, even as ATF prices have more than doubled in just the past few months since the West Asia conflict broke out. Even as the government has stepped in with some relief, pressure on airlines continues. The ATF prices have still seen seen an 8.5% hike, lower than expectations, while airlines have revised the surcharges as well. Now, the bigger move, however, comes from the airport's Economic Regulatory Authority of India, which has slashed the charges on the landing and parking by 25%, offering a direct cost relief to airlines. This relief will apply to domestic flights for 3 months and comes into effect immediately following the centre's directive amid the West Asia crisis. Importantly, any under-recovery during this period will be trued up in the future, meaning costs could be recovered later, keeping the longer-term fare pressures intact.
The immediate concern is around supply in Asia, followed by supply in Europe. I don't think Europe is in the same situation as Asia quite yet. About 80% of jet fuel for Asia comes through the Strait of Hormuz, which has been closed. Good news in the past hour that there is a temporary ceasefire and that oil will start flowing through the Straits of Hormuz again. So hopefully that will provide some short-term relief, and we've seen that in the price of crude oil, which has fallen significantly in the past hour or so. So it's a challenging situation.
The Reserve Bank has kept interest rates unchanged. As was expected, the central bank has opted to wait and watch as this West Asia crisis develops. RBI lifted the estimate for India's GDP growth in the last financial year to 7.6% from 7.4%. However, it is projected a growth rate of 6.9% for this financial year. RBI Governor Sanjay Manotra indicated that the West Asia conflict could impact growth as energy and other commodity prices remain elevated. He also flagged the upside risk to inflation. Now, the RBI expects the consumer price index to be at 4.6% for FY27. Core inflation is estimated at 4.4% for the same period. The RBI also provided a capital boost to banks and NBFCs. They will now be allowed to count quarterly profits in their capital adequacy, while NBFCs get access to the call money market for their liquidity needs. Here's the governor.
The government has taken several measures targeted at supporting exports and protecting supply chains. The fundamentals of the Indian economy are on a stronger footing, providing it with greater resilience to withstand shocks now than in the past. It also noted that the economy is confronted with a supply shock. It felt, therefore, prudent to wait and watch the changing circumstances and the evolving growth inflation outlook.
Well, that is the RBI governor. Lata joins us now with more on the monetary policy. Lata, status quo on rates as was expected. But what did you pick up from the commentary?
I would argue that the policy is absolutely neutral. It has got some hawkish elements and some dovish elements. Hawkish because the hike in the inflation forecast is more. It's about 50 basis points, whereas the cut in growth is a little less. So some people can read that as a little hawkish. However, the governor was very clear when asked. He said that maybe you should say we will pause for a long time. And they removed the word lower for longer. All this gives the impression that there are enough number of hawkish and dovish elements, and therefore I would call it as neutral can get, appropriate given the geopolitical uncertainty. A point in terms of liquidity is a little dovish. The governor almost assured that they will continue to keep liquidity surplus in the interbank market so that there is better transmission. They are not reintroducing the VRRR, which is a means by which excess liquidity is sucked out on a daily basis. That's not going to be reintroduced in a hurry. Gives banks some breathing space. An important contribution of this policy is core CPI forecast is being given by the Reserve Bank. Until now, they gave us only headline CPI. Core CPI is inflation minus food and fuel, which are volatile elements. I think it gives the RBI a certain maneuverability. Let us assume diesel and petrol prices at the pump are raised. That will only increase headline. It won't increase core. So the RBI may be able to argue at certain points in time if needed, the headline is up but core is not up. One step towards transparency, but it also improves the nimbleness and space available to the Reserve Bank. Important announcement on the FX. The Reserve Bank went hammer and tongs last week on March 28 and March 31st to tell banks to bring down their speculative positions. The Reserve Bank clarified it is temporary and that as normalcy returns, they will allow banks to do more arbitrage trades between the onshore and the offshore market, and this limit of $100 million on open positions on the onshore market will be relaxed in course of time. That will be a bit of relief. Finally, there are some improvements to, some changes to the way which will improve the capital of banks. That is, the investment fluctuation reserve need not be kept anymore. Quarterly profits can be transferred to reserves. However, both RBI and bankers tell us it is not going to make a material difference to their capital adequacy ratio. So that's more, an ease of doing business kind of step. Doesn't change EPS.
Lata, many thanks. Now, Governor Sanjay Manotra also spoke about the recent developments at HDFC Bank. The governor said the RBI has not found any material governance concerns in HDFC Bank during its oversight. This comes after the bank's chairman, Athanu Chakrabarti, stepped down, citing ethical disagreements.
हमने प्रेस में अपना एक प्रेस नोट दिया था तब, जिसमें हमने ये कहा था कि हमारे हिसाब से कोई भी मटेरियल कंसर्न हमें चाहे गवर्नेंस या कंडक्ट से संबंधित हो वो नहीं है। तो उस बात को मैं यहाँ पे दोहराना चाहता हूँ कि कोई भी मटेरियल हमें कभी भी अपने सुपरविजन में या उनके रिकॉर्ड को देख करके ऐसा कोई गवर्नेंस और कंडक्ट से रिलेटेड मैटर हमारे सामने में नहीं आया।
And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute. With more.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Credit B enters the Unicorn Club with a $280 million pre-IPO round valuing the consumer lending startup at $1.5 billion. The funding round was led by Motilal Oswal Alternates, Hornbill Capital and MUFG-backed Dragon Funds.
Skincare brand Clayco has raised nearly 35 crore rupees in a Series A funding round led by 29 Capital Partners Ventures. The brand reported revenue growth from 5 crores in FY24 to 33 crore rupees in FY25, reaching 75 crores in FY26.
Deep tech autonomy company Roche AI has raised 22 crore rupees in a funding round led by IAN Group through its Alpha Fund. The fresh funds will be used to strengthen its product, expand deployments and scale its presence across global industrial markets.
Angur AI, an AI-native customer interaction platform, has bagged 2 crore rupees in a pre-seed funding round led by Venturizer. The startup has onboarded over 20 brands across India and the UK and plans to expand into the US market as part of its next growth phase.
Greece to ban social media for under 15-year-olds from 2027. Ban aims to address rising anxiety, sleep problems and screen addiction. Platforms will need to be able to restrict users or face fines. Greek Prime Minister also urges the European Union to adopt a block-wide system. Well, those were the headlines we've been tracking for you this evening. Let's start with a CNBC TV 18 exclusive. Digital fresh food and clean label FMCG brand Pluck has raised 100 crore rupees in a Series A1 round, taking its total capital raise to $26 million. The round was led by existing investor Euro Gulf Investment, with a presence across 50 cities, integrations with quick commerce platforms, and a fast-growing portfolio of value-added products from meal kits to plant protein. Pluck is now gearing up for its next big leap, an aggressive offline push, global expansion, and a sharp focus on profitability within the next 12 months. Joining me now is Pluck's co-founder and CEO, Prateek Gupta. Prateek, welcome to Startup Street. 100 crore rupees in fresh capital. Prateek, how much closer does this take you to building a sustainable, profitable fresh food brand? You're targeting EBITDA positivity in 12 months. What are you doing differently to make unit economics work? And how do you plan to deploy this fresh capital as well?
Yeah, hi Shruti, thank you very much and nice to speak to you again. I think this 100 crores is very, it's an important milestone for us. And we are looking at 4 key things, one is the most important R&D, where because our products we do not add any preservatives or any sugar or anything else. We have to engage more in R&D to get the product shelf life right, to make the product reach to more people. That is the number one, 30 to 40% goes there. And the other one is increasing the brand awareness. And then a very important pillar is to take the brand into distribution areas like, tier 2, into retail, into offline, into international markets. And then the very last, but probably the most important is AI and tech, because we see a lot of use cases from demand to supply to price to trend spotting over there. So that's where we really end up investing this month.
Okay. All right. Prateek, you're entering offline retail for the first time. Why now and what has changed? Also, you are looking at 1,000 stores in 12 months. What's the playbook to get to this aggressive target?
Yeah, so why now? Because we already built a strong brand on quick commerce, and we are already there on 6 quick commerce platforms. Amazon, Blinkit, Swiggy, Big Basket, Flipkart, and Zepto, and it's been a very focused journey for us so far. And at this point of time, we know that the product is working, the TG is very clear, the playbook is very clear, and from here, if you want to grow and reach the next level of audiences, it has to be offline. It has to be the tier 2 people who are also equally aspirational. So that's what we are really looking at, and that's why offline now.
Okay,
So,
yeah, go ahead.
No, I just wanted to say that we are just started offline, and 1,000 stores is actually just a starting number. But if you really look at it, India has millions of stores offline, and so it's just a start. And maybe in the next few years, we want to grow to much bigger numbers on offline.
Okay, and I believe, Prateek, offline sales are expected to contribute around 20% of overall business revenue.
Definitely, this year we are targeting about that number.
Okay.
And yeah.
And even as you deepen integrations with platforms like Swiggy, Instamart, Zepto, and Blinkit, like you mentioned, and you plan to scale to 2,000 dark stores from the current 1,000, does this kind of scale translate into profitability or just higher volumes?
So definitely, see, volume is a very important part of getting to profitability, because we once built the product, we built the brand, the technology, all the costs that we really load on to the current sale channels will get distributed as the volume increases onto other channels. So we are definitely looking at all these spends getting distributed on these other P&Ls, on the other channel P&Ls, which will lead us to profitability.
Oh. Prateek, your value-added categories, meal kits, protein bars, juices are scaling fast. So is Pluck evolving into a branded food company rather than just a fresh produce player? And what new categories can we expect going forward?
So Pluck has taken a very important and I would say a brave step of branding fresh, because it was not easy to brand the fresh category. But having spent these few years on it, and I think that brand development has finally happened. So we definitely observe that the current meal kits categories, the juices, plant protein bars are very important categories. What we are looking at in the future is something which is again very connected to the source of ingredients and fruits and vegetables. For example, a clean label ketchup is something that we are launching. We are launching a few frozen fruits and vegetables. We are looking at dips categories, where again the customer is looking for the freshness element. That's what they want to make at home every day, but they end up doing packaged foods. Yeah.
All right. So ketchups and dips to look forward to. But Prateek, you're betting big on AI as well, from pricing to demand forecasting. What tangible impact has it had on the business so far? And you say AI can cut costs by 20%. So where exactly are those savings coming from?
While AI has so many different use cases, the top three for us is one is the demand forecasting bit, where we end up like if we predict the right SKU to be sold in the right market at the right time, we end up saving a lot of food wastage. The second one is quality check. At every time, every day, we inbound millions of products, and every month we inbound millions of products, and when we do a quality check of that, it will if it is AI based, there's a lot of accuracy, there's a lot less labor required. So that's a huge cost saving over there. And the last one is very important, that we are able to spot the right ingredients, the right trends, the right health trends, to create the right product in one go and target it to the right customer. And that really saves a lot of marketing costs, a lot of CAC, because if you end up really creating the right product on one go, that's a huge saving as well on the business. Yeah.
Okay, Prateek, you're also now looking at international markets. What geographies are you targeting, and what will be your playbook? What's your edge outside India?
The most important edge outside India is that Pluck is a brand coming from India, and it is clean label, so there is no hassle around getting this product cleared in other geographies, because it's not like we have something of it's not like we have less preservative or less sugar or less of something. We have absolutely 100% clean, and that's what makes Pluck products acceptable not just in India but in almost all geographies outside India, whether it's Western markets, it's UK, US, UAE, KSA. And made in India is also very important, because India has a certain trust factor. It's an agricultural economy, so people know it's coming from the source. And also there's a cost of the reasonable cost of development leads into a better priced product end of the day. So made in India for the world is a real concept. And I think that Pluck is a great example of that.
Okay.
And those are the geographies that we are looking at that I just mentioned.
All right. And we wish you the very best for that. Many thanks, Prateek, for joining us on Startup Street today.
Thanks a lot. Nice to meet you.
And moving on, Now Purchase, an AI-led B2B platform focused on metal procurement and production optimization, has raised 80 crore rupees in fresh funding led by Bajaj Finserv. The company is looking to tackle one of the most fragmented and inefficient parts of the industry, from raw material sourcing to shop floor decision-making, using AI, IoT and data. With plans to expand its scrap recycling infrastructure and scale its platform, Metal Cloud, the big question is, can Now Purchase redefine how India's metal manufacturers operate at scale. Joining me now to discuss this further is Naman Shah, the founder and CEO of Now Purchase. Naman, thank you so much for taking time out and being here with us on Startup Street. You know, you're not just a procurement platform, right? You're also trying to digitize one of the most unorganized parts of manufacturing. What's the core pain point that you're trying to solve for metal manufacturers, and why has this problem sort of remained unsolved for so long?
So thanks, Arundhati, for having me here. If you think about it, metal forms the physical backbone of everything around us, right? Whether it's automobile, electronics, even data centers. And the raw materials which go into making metals are extremely, extremely fragmented. Whether you talk about metal scrap, alloys, refractories, additives, and so on. Majority of them are being serviced by network of traders, brokers, agents. And given that there's so much of fragmentation, and it is such a key part of our economy, of the entire Make in India manufacturing movement, the ability to sort of organize it, streamline it, and build a data layer on top of it becomes extremely valuable.
Absolutely. And you've sort of built Metal Cloud using AI, IoT, and computer vision, right? If you can sort of break that down for us, what actually changes on the shop floor when a manufacturer uses your platform? Are you sort of improving output, reducing wastage, or fundamentally changing how decisions are made?
Sure. So if you think about, you mentioned the word decisions, right? If you think about decisions, right, decision depends on what kind of data we have. If you think about the Indian manufacturing landscape, most folks do not have good quality data. And if the data is not real time, it is just not real, right? And our first goal is to build a strong data infrastructure for them. It's a combination of IoT, HMI, as well as using computer vision. And once we have that, we're able to provide them insights and to make better decisions, which eventually reduces their production cost and reduces their rejections.
All right. And you're doubling down now on scrap recycling and your own processing centers, right? That's a very asset-heavy bet. Why take that route instead of staying a pure marketplace? And how does this improve margins and control for yourself?
So the way we think about our business, right, is that we want to service the metal manufacturer by providing them the key raw materials as well as the technology to produce the right metal using these key raw materials. That's how we think about our business. And if you think about scrap, by nature, scrap can't be really serviced well through a marketplace route, given it's extremely unorganized. And if you want to create a standardization layer, give it that quality experience to the customer, it's important to create these scrap recycling centers. The way we're creating these scrap recycling centers is also interesting because we're keeping the assets still relatively light and going to a place where we are trying to SKUize the scrap, right? Scrap is no longer scrap, but it's more so like a recycled raw material, which they can trust rather than having doubts on its quality, whether it's physical or chemical characteristics.
Absolutely. And you've raised this 80 crore rupees that's led by Bajaj Finserv. How are you sort of thinking about capital allocation? How much goes into tech versus supply chain infrastructure? And when do you expect this to reflect in revenue growth?
Sure. So, we're delighted to have partners as Bajaj Finserv leading this round for us, along with participation from InfoEdge and Orias. In terms of the way we're thinking about capital allocation for this round, it's primarily 3 to 4 buckets. First is, of course, scaling up the scrap recycling centers, like you mentioned. Second, expanding our range of own branded label products. Third is investing heavily into Metal Cloud's AI platform. And fourth is geographical distribution of our services. So those are the 4 key areas we're looking at. In terms of our business has always been extremely, we always thought through around unit economics, ensuring we hit the right numbers. We've been growing consistently between 40 and 70% year on year for the last few years, and we expect to continue that growth. So we expect to see some revenue numbers showing up this year itself.
Okay, you expect it to show up this year itself. Now, metal manufacturing globally is sort of seeing this China +1 shift, right? Where does India sort of stand today, and how are you positioning Now Purchase to capture that opportunity, especially with global expansion on the horizon?
Sure. So, if you think about the entire Make in India movement, a lot of people talk about China +1, but India is turning out to be beyond the China +1 opportunity. If you think about today's global climate, there's a lot of uncertainty, war, etc. India is, geopolitically positioned in a way to be able to really, really reap rewards and capture the import-export space as well. So we're not just thinking about the China +1 opportunity, but in this world which is having so much of volatility, India is very carefully positioned as well. And as we go ahead, we are looking at in our key markets like foundries, almost 20 to 30% of their output is currently being exported. And we see this number growing for all our customers. I would say almost 50% of our customers are key exporters. So we see this pretty much hands-on with our customer base.
All right, and you've built a strong pan-India presence, but this is also a low-margin, working capital-heavy business, right? So talk to us about your unit economics. You had mentioned a little bit about it previously, but where's profitability today, and what does the path to sustainable margins look like?
Sure. B2B as a sector, a lot of people talk about margins, but the way to think about this business is not just gross margins or profits, but think how does gross profits eventually lead to PAT, but more so, what is the ROCE this business gives? And if you start thinking about ROCE from day one, you're already taking into account profitability and working capital. And the way we have been building our business is always thinking about ROCE. How does the business generate 25-30% ROCE in the next 2 to 3 years? And that's the key, holy grail metric for us, rather than just thinking about PAT or working capital. Because if the business starts generating ROCE, you're already addressing these two things. As a business today, we have been unit economics positive, obviously, since day one. And as well as today, we are closing in on being EBITDA positive as well.
So closing in on being EBITDA positive as well. All right, Naman, thank you so much for taking time out and being here with us on Startup Street.
Thank you, Arundhati. Thanks for having me here.
Well, on that note, it's time for us to head into a short break. But coming up next, a new report by Stride Venture shows venture debt has grown sharply over the past few years. We have the founder of Stride Ventures, Ishpreet Singh Gandhi, on the other side. Stay tuned.
Welcome back. You're still with us on Startup Street. Private debt is fast emerging as a key pillar in India's startup funding ecosystem. A new report by Stride Venture shows venture debt has grown sharply over the past few years, even as growth credit is gaining traction among late-stage companies. What does this mean for the future of startup financing in India? Aishwarya Anand speaks to Stride Ventures' Ishpreet Singh Gandhi to decode the trends. Take a look.
Venture debt over the last couple of years has grown 16x and is now nearly accounting 9% of the venture capital in India. So when does it move from, an alternative to becoming a mainstream capital for founders in the country?
If you talk about more than $1 billion in venture debt and more than $1.5 billion in private credit, means that the appetite has changed than what it was over a period of 6 years. And the current amount is surprising to us. At the same time, it's very positive because that's what we actually started the initiative of doing this. And our AUMs is a reflection of how the growth has happened. So I'd like to make a case that it is, to an extent, mainstream.
The report also highlights that over 70% of founders today are looking at using the debt capital over the next 24 months. What's the rationale behind it, and what is actually driving that kind of commitment?
Again, going back to the example, 6 years back, this number would have been around 25, 30.
Correct.
So it is A, the awareness, B, the ecosystem knowledge about how it's worked positively for other companies who have done it. As you get into more profitable businesses and you want to have a better return, you want to protect your dilution, you start thinking more that what are the use cases and how it emerges. And in today's time, it's more important because only good businesses have survived in the last 24 months specifically than what it was.
Venture debt has seen nearly 187 deals with $1.3 billion being pumped into it. And growth credit has seen far fewer deals, which is around 32, I think that's the number. But the capital deployed has been $1.6 billion. Is this signaling that the capital is getting concentrated at the very top now?
Which is true for, to an extent, good late stage venture capital money or early stage private equity money.
Yeah.
It will always be concentrated because the numbers will become bigger.
Yeah.
And this means that these companies are closer to Series D, Series D or E or pre-IPO. They're ready to go pre-IPO, and the quantum requirement will be large. An average of venture debt, because early and growth venture debt also will be average of $6-7 million. So it will always be like 4 times, 5 times, and because the stage is very different, the economics are different, they're more IPO-able companies, and that's how it becomes a growth stage debt.
And now average ticket sizes are also sharply different. About 3.5 million is what we have seen for venture debt versus $52 million is what we are seeing for the growth credit. So are we seeing a barbell market emerge between small early checks and late large stage funding?
It is by the definition, right? If you say early or venture debt as a word and you say growth debt as a word, they operate in different spectrums. Venture debt will operate in a spectrum of being venture-oriented companies who have not been able to break out to become mature companies. So the requirements will always be, as debt provider, you can give as much to their balance sheets. Whereas as a growth debt is a company which is fully ready to scale at a different level, exponential growth. They would be knocking on the doors of private equity firms. So the requirement of, and that's why the term is growth debt, right? The quantum will always be different. And that's why it looks bubble, but actually by definition, they are supposed to do those kind of ticket sizes. And what we were trying to mention is we traditionally covered venture debt. The growth debt has really emerged specifically after tech companies have started getting listed. That use cases has emerged stronger. So it's important to cover that now.
So what is the plan with growth credit now for Stride Ventures? What does it look like in the next couple of years? And how much of it will go into companies that are very IPO ready? Because the market is ripe for it.
We typically deploy from 2 funds at any point of time. And every fund can consume 100 crores per company, right? So we can traditionally go up to 200 crores per company. We've already done it with 4-5 companies in the last 12 to 18 months. And we think that this requirement will even grow further as the companies become more mature.
So from sector perspective, what are you very bullish on, which will drive the venture debt market very, very strongly?
From a venture perspective, I always say that anything which we are in a different geopolitical scenario right now. Anything which is fundamental to the growth of the economy is critical to deploy. So fintech remains important. We call it climate in terms of capex heavy businesses which require capital to grow beyond equity capital will remain important. So everything which is around infrastructure, and then there is a demand of ever-growing consumer population in India, which has seen huge brands.
If you're looking at AI from any perspective, because every company today is an AI company, but is there any particular metric that you have to figure out that, okay, this is a company which is actually working probably on an application layer or whatever it is that interests you a lot?
So we've been proponent of funding companies who are differentiated, trying to do some AI application layers, or trying to enable something which has a corporate use case, because we need to come in at the revenue stage. But either whether it's AI-oriented company or something which is going on defense or even at space, we are looking at all of them. Wherever there is a revenue orientation, we are in the game.
All right, moving on. Global provider of digital infrastructure Equinix announced its 4th International Business Exchange Data Center in Mumbai. This center will support high-performance workloads and hybrid multi-cloud deployments across India. Rachna Dhanrajani speaks with the company's Asia-Pacific President Cyrus Adagara to understand the power challenges around data centers. Listen in.
One of the things that's really important to understand is Equinix doesn't compete on just a pure power basis. Actually, what our customers come to us for is interconnection. And when they come to us, yes, they might need power, but what they really need is the ability to connect to the clouds, to networks, to content providers, to their customers and suppliers. And so that is what differentiates us from the larger data center builders who are building purely for the purposes of just dumb compute. What I would also say is that Equinix globally has a range of initiatives in place to make sure that we are driving the most efficient power usage inside our data centers. Last year, we invested over $50 million just in projects to increase the efficiency of our data centers.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates continue right here on CNBC TV 18.
We do have a very special guest today, Warren Buffett, the chairman of Berkshire Hathaway, former CEO of Berkshire Hathaway. And this is the first time that we are sitting down with him since he stepped down from that CEO role. Warren, welcome. It is wonderful to see you this morning.
It's fun to be on.
Warren, this is the first time that we're sitting down with you since you stepped down from the position of CEO of Berkshire Hathaway.
Yeah.
It was a long, long run, very successful run. How is your life different today?
Well, it's not much different, except for I mean, I go in every day.
To the office?
Yeah, I go in every day to the office. I don't accomplish hardly anything. I mean, in terms of, it just takes me way longer to do things. And Greg is so good. It was kind of embarrassing how good he is because he has covered, you know, we've got about 200 businesses within Berkshire, you know, that came about. And I can't name the managers' names or their wives' names, and I haven't seen them, you know, in a long time. It was easier just to write the letter once a year and kind of do my own thing. Greg covers more ground in a day than I would in a week, even when I was at my peak, let alone my present condition. So it's a move that, in many ways, I could have done it earlier, and Greg would have been better than I was. But, you know, I can still contribute just a tiny bit. But
well, are you still involved in making investments at all?
Yeah. Yeah. But I won't.
I think the fact is, this is one of the few. They've handled the problem with memory. I think this is one of the few that really has a.
We do have a very special guest today, Warren Buffett, the chairman of Berkshire Hathaway, former CEO of Berkshire Hathaway. And this is the first time that we are sitting down with him since he stepped down from that CEO role. Warren, welcome. It is wonderful to see you this morning.
It's fun to be on.
Warren, this is the first time that we're sitting down with you since you stepped down from the position of CEO of Berkshire Hathaway.
Yeah.
It was a long, long run, very successful run. How is your life different today?
Well, it's not much different, except for I mean, I go in every day.
To the office?
Yeah, I go in every day to the office. I don't accomplish hardly anything. I mean, in terms of, it just takes me way longer to do things, and Greg is so good. It was kind of embarrassing how good he is, because he has covered, you know, we've got about 200 businesses within Berkshire, you know, that came about. And I can't name the managers' names or their wives' names, and I haven't seen them, you know, in a long time. It was easier just to write the letter once a year and kind of do my own thing. Greg covers more ground in a day than I would in a week, even when I was at my peak, let alone my present condition. So it's a move that, in many ways, I could have done it earlier, and Greg would have been better than I was. But, you know, I can still contribute just a tiny bit. But
well, are you still involved in making investments at all?
Yeah. Yeah. But I won't make any that Greg thinks are wrong. Mm-hmm. And he'll run. He's starting to get a few calls, and he'll call me about them, and like me, he doesn't like them, you know. but
calls for deals, you mean?
He'll keep me posted. Yeah. Well, it's investment bankers calling him.
Okay.
And they'll sell them, you know, they'll try and sell anything, but I cut them off in about 10 or 15 seconds, and he spends more time with them, but I don't know where he gets this time, because he plays hockey with us. I mean, it isn't like he's as fanatic as I was, you know, in terms of running the place, but with no more apparent effort, he just covers so many bases.
Well, in terms of what you're doing with investing, I mean, it's a huge amount of money. How much cash does Berkshire have on hand at this point?
I don't know the exact number, but it's not much different than before. So, you know, it's probably north of $350 billion in cash and treasury bills.
Yeah. So
we bought $17 billion this week.
$17 billion of T-bills?
Of T-bills.
Berkshire's the largest owner of T-bills?
I think we're probably the largest bidder, and ironically, I got involved in Sullivan because they bid for too many bills, and I don't think they'd get mad at us now if we bid for too many. But you're not supposed to go over 35% or something in the auction, and of course you bid through the primary dealers. But I don't even know the mechanics that well. But